Okay. Hello. Work agada. Great. Recording ஆரம்பிச்சலாமா? பாரு. பிரேக்ல பார்த்துடலாம். Settled? Okay. Good morning, warriors. என்ன சாப்பிட்டு வரலையா? Fine. Yes. My treat only, yaada. எப்போ பார்த்தாலும் என்னோட ட்ரீட் தான். When will that day come when you pass and you tell me I'll give you a treat? அதுதான் பார்த்துட்டு இருக்கேன். Anyway, we are doing all that for today only, no? Yeah. Anyway, great. A very good morning, everyone. Thank you for joining in. I know I have a lot of similar faces. பக்கத்துலேயே உட்காந்துருக்காங்க தெரியுது. Yes, a lot of unfamiliar faces also, but yes, it's always, good to see some good faces and in the morning, definitely, yes. Something which lights up for me is to see new faces, some saddened faces, some brought down faces, all depressed in life, everything happens. We have already come to that stage already, no? Yeah. When we started CA Foundation, idanda course, நாங்க தோக்குறோம், நாங்க இது பண்றோம், அது பண்றோம். Intermediate ஆரம்பிச்சா கூட foundation pass பண்ணிட்டா எல்லாமே முடிஞ்சிச்சு. And then suddenly, last 2 months left off. The faces fall down, eyes are soaring, black eyes, everything coming, girls forget about makeup, what is happening in the world, no one knows. No worries, yes. Keeping all that aside, my point is very simple. When you enter my room, whatever you had in your life is all down, yes. For the next, I don't know how many hours is this class, 7 to 5, until 5 o'clock you are with me, we are going to enjoy the best of it. Yes, we will have absolutely no worries in life. Who happened, who died, who passed away, who got married, someone else is enjoying Hawaii life, it doesn't matter at all. Yes, we will be here for the next, 10, 12 hours, whatever it is, and you're going to enjoy life along with me. I will play jokes with you, you play jokes with me. Yes, that is how it always works. For those who don't know me yet, yes, for those who kind souls and all, who saw the DP in the group but still are asking who is this faculty and all. I know. Yes, my name is Rahul Agarwal. I am a qualified chartered accountant. Close to around 6 to 7 years of experience in direct taxation. Seeing my face, it doesn't look like I can teach direct tax, but yes, after this couple of 2-3 hours, you will understand why I am here and why you are there. Yes, that is what is happening with every kind of batch which I have. The moment I enter the premises itself, someone will come and say, "Idhu dhaan pesa porana." The moment I leave the premises, even da pesanunda inimalana irukum. Yes, that is how my impression is always when I start a class. Keeping all that in mind, let's start today's. Yes, I will give you a brief understanding of what the course is. For those who have a doubt, Rahul, are we covering concepts and all? You can understand the time frame, it's not possible. Yes, we are going to do a quick revision of what the whole subject is with the intention of very simple. My old students would already know. We have a concept in our classes that the moment you are in your exam hall, the only thing which should flash in your mind is the book, that's all. Yes, and for that to happen, you have to at least have 2 to 3 revisions before the day of exam. How many? 2 to 3 revisions. Those people who enter the exam hall before that would only have 1 revision of DT, 1 revision of IDT, come and say I don't remember anything, not possible. Yes, you will not be able to crack this paper, you have 2 laws to cover. Clear? So the intention is very simple. The day of preparation, how many days do you have for your preparation? This time you have 2, no? Fortunately this time you have 2. The intention is very simple. In that 2 days you should be able to cover the subject 4 times. How many? 4 times. Yes. The goal which I always set for my students is that you take this material which I have in your hand and you have to complete the whole material in a minimum span of 6 hours. That's all. You cannot take anything more than 6 hours for the first reading. For what? First reading. First reading you have to complete in 6 hours, after which the next reading only happens in a matter of 2 hours and the last reading only happens in a matter of half an hour. That's all. Yes, that is all the goal which we have in mind. That is why the reason of this marathon, we are going to do the same amount of time. Yes, I'm going to do the same amount of 6 to 7 hours which we are going to do today. Either you can use the same marathon on the day of your exams. You can read through this marathon, listen to my voice. I don't know if it's good or not, but whatever it is, you don't have a choice. Yes, you can either listen to my voice and you can prepare for your exams, or you can do it on your own, whatever suits. Yes, whatever works for you is what the goal is, very simple. When I'm doing this recording, I will ensure that I'll cut out all these useless parts. Yes, so that the day before exam, you only have to do whatever is important. All these kadhe and all is only because I have too much extended time today, nothing else. Yes, all that in mind, we will ensure that we complete the whole syllabus in 6 hours. Yes, to do that, we will obviously not be covering any kind of conceptual understanding in the classes. We will be quickly going through the provisions. I will be telling you what is important, what is not important for your exams. And at the same time, we will try to do some shortcuts and everything. We will try to do some shortcuts for the ones who are new here. For the ones who are new here, for the ones who are old already should know. Should know. Will know illa. Should know. Yes, that is how it will be. Clear? The next thing which I'm going to clarify to you is that we are also running YouTube live right now, which means I can see chats of online people as well. Yes, the intention is very simple. We will be doing the marathon here, but at the same time, if you have any kind of query in any concept, anyone outside also, inside also, whatever it is, you have a query on a concept, let's discuss it here itself and close it. After you end up with this class, there should be no second thought about direct tax. The next time you should be touching is only the day of exam. Yeah, I can see the face. Yes, the next time you should be touching is only on the day of exam, but yes, if you are doing any kind of mock test and all, that's the other day which you have to do it. But otherwise, you should not be touching this paper once again. Clear? Yes, can I hear a voice? Yes, sir. Great. Yes. Second thing which I wanted to clarify is, I have given this material as a free copy to you on a soft copy. Yes, the soft copy material will look black and white. The ones who have purchased the hard copy will, the soft copy will look color, and the ones who have purchased it hard copy will look black and white. Do not come and tell me, Rahul, you're cheating with me, 2 different materials, nothing. Yes, the only thing I've done is I've taken some additional efforts and the color coding has changed to black and white coding, that's all. The purples and all will not be there, amendments will be in dark, highlight and all that stuff. That is the only difference which you'll have, because if you have a material in your hand, you should know what is your amendments properly. Correct? So all those are important. So the ones who have purchased your hard copy material, the codings will be a little different than what I have. That is why, starting now, once we enter the subject, no matter how good I'm looking today, no matter how bad I'm looking today, no one sees my face. The only thing you see is the screen. I look good only da. Yes, what you are going to do is very simple. The ones who have hard copy are going to focus on your hard copy, because this is what you have to get familiar to. The ones who do not have a hard copy but have purchased but have taken the soft copy can look at the screen, only watch the screen. I will talk, screen will move. You watch the screen, you get familiar with the book. That is how the concept is. If you have not done any of this, you already have a material in your hand, go ahead, no problem at all. Just that I will tell you, I am preparing from my material. Your material might have a different sequence, that's all. Yes, whatever faculty you have learnt with might have a different sequence than what I am going to teach you. That might be a little challenging for you, but otherwise, if you can get familiar with the material, that is all the concept is. Clear? Yes. Second thing, we are right now only discussing provisions. We are right now only discussing provisions. If there is someone who's sitting here having the thought, can we discuss concepts and all? Right now, not possible. But yes, we are also floating a fast track course by starting of the 1st of October. Starting of the 1st of October, the whole syllabus will be covered in the conceptual clarity and everything, and we'll try to cover as much as possible there. I don't have this concept of cheating people saying fast track na 80%, 70%, nothing. 100% of the syllabus will be covered in the fast track thing. Just that it won't be as detailed and as, what do I call it? I torture my students a lot with a lot of questions. Yes, that is the one thing which I will be avoiding in my fast track class. Apart from that, the concepts will be purely given to you. 100% of the syllabus will also be covered. The point is, this marathon will also be uploaded on the YouTube. Yes, so if you do not have a concept clarity, no worries at all. You can attend the fast track course, and after that you can go through this marathon once again. Same material, nothing is going to change. You can go through this once again so that you have a strong grip on it. Clear? Yes, anyone in doubts before we start? No? Shall we? Yes? Yes, I think the time slots is between 7 to 5. The time slots is between 7 to 5, but 7 to 5 comes to how many hours? 5 plus 5, 10 hours. 10 hours is something which is a pure luxury for us. The reason why it is 10 hours is because for those who know me already, my classes never run smoothly. Yes, power outage, laptop hanging, something or the other will go wrong, and that is for some reason my lucky charm. The day that happens, only my classes work well. Yes, so all that keeping in mind is where the buffer of 10 hours is there, but otherwise we are ensuring we'll complete it in 6 hours. You will have a break of lunch, you will have a break of breakfast, everything will happen when you ask for it. When you ask for it. I am that kind of person who can talk for 14 hours, you can listen to me, you can love it. Yes, but when you ask for it is when you will get your break. Ideally, it should be 9:30 and then it should be 1 o'clock. Ideally, it should be 9:30 and 1 o'clock. I will not be looking at my watch. Someone else is also not looking at your watch, but there is a time there. You look at the time and you tell me at 9:30 or 1 o'clock, sir, stop, I will stop. Clear? Yes? Great. Keeping all that in mind, let me go forward with the material. Yes, let me give you a simple synopsis of what the soft copy looks like. The soft copy is all colorful with all flow charts, with all images and all that stuff. You will see some motivational quotes also coming in here and there. That's the only reason why people are running till now. Yes, but otherwise this material is something where people come and say income tax na gali da poche, paper fail da agapona. That is why somewhere 1 or 2 chapters I will have some motivational quotes for you. Go through the material, you will find it automatically. As we go forward, we'll be doing that as well. But otherwise, the material will be color coded fully. The material will be color coded. All your headings will be in pure purple. All your content will be in black because that is the same pen which you have to use for your exams. Apart from that, everything will be in red. Apart from that, everything will be in red. What is this red is basically this material. The whole income tax which you have for 1000 pages in your study material has already been concised to 179 pages, 179, 185 pages. Okay, kittadata 185 pages is what I have consigned this material to. In the 185 pages also, if you ignore the black and just read red, that will become 60. Ignore the black and just read it, that will 60. That 60 is what you have to read for your exams. Okay, you don't have to read all the stories and all. In the kadela irukku the black and all, do you have to read for your exam? Did you pass out for CA foundation? Nothing is important. Yes, so all these black things are all completely useless for you. Red matto parcha, you can always clear your exam. That is why the red concept is there. Basically, summarized version of the full text. Clear? And then the most important thing for your exams of May and November will be in green, which is amendments. All your amendments for this subject will be in green. This is one thing which we have to put special focus upon because this is what everyone keeps testing. Yes, May also so the pitch November da irukku vera vali illa. Yes, so November so green is what you have to do. As I go forward with the class, I will keep repeating one question. Which attempt are you writing for? Does someone have any doubts that you're writing up beyond November? Is someone having a doubt here? Everyone here is for? Finally, no? November 20. That is what I was looking for. You are here for November 22. That's all is your final attempt. After that, there is no second attempt itself. Yes, you do here or you do there. That's all. Yes, either R or par. That's what we say. You are here only for November, and that's the only attempt which you are giving going forward. Yes or no? Yes, sir. Yes. No, you have to give one more attempt for finals. Inge uttrada. Adu vera vishayam. Yes, you have to give one more attempt, but that only happens for finals. As of now, let's look at the hard stop, which is your CA Inter November 22. When I started the class itself, one thing which I called everyone is warriors. For my old students, they already know this. Yes, the new ones are only pending here. The warriors is very simple. You can look at your faces and you have understood yourself that the battle which you have gone through is not easy. Yes, sir. You have done through a lot of battle to come here. It takes a lot of guts and efforts to sit, wake up at 5 in the morning, come here and then sit to look at someone else's face and see what he is talking. Provisions nalla irukka, book nalla irukka, in the concept nalla irukka, everything is difficult. I know, understand. Yes, everything is challenging in life, but you have taken up that challenge and you are still standing here. Yes, that itself is a pride moment, nothing else. Yes, so as much as you might not be the soldiers on the field, you are still a warrior in the battle. Just that the difference is there they are using their physical body, here you are using your mental body. Unakku mental peace da porudhu vera edume illa. Yes, so keep all that in mind and start with the class in such an honor that you are here as a warrior and you are here to win the war. Are we in a war? Yes, war is with whom? Huh? There is no war with ICI. They are only correcting your papers. Yes, the war is with the person sitting next to you. No other options. Yes, it is not just important for you to clear your exam. It is also important to do better than the other person. Hey, when I say sitting next to you, not this class da. You're all friends here. You're all friends here. Sitting next to you is in the exam hall. Yes, in the exam hall there will be one person sitting next to you. He will be scratching his head, crying. He'll sleep in half the class itself. Exam mudichumoda half an hour itself he'll sleep off because he doesn't know everything. At that point of time, the thrill which you will have on your face that you know all the paper, and the excitement with which you will be writing your paper, no, he will feel depressed. So half the crowd will leave there itself. Yes, that is the half crowd which you have to stick in. You have to be that half kind of crowd who is excited in that exam hall and is ready to write your paper, rather than the other half who feels depressed seeing someone else and leaves the paper in halfways and goes. Yes, you should be in the second half because obviously the percentages are low. The percentages are low, there is no option about it. It is not a thrill to have a good percentage, okay? Never have I ever told someone that you should have an ICI with a percentage of 40, 50 and all. There is no good about it. You having a challenge of completing in that 4 or 5% is what the thrill is. Yes, if you can go and tell the world saying that I have cleared in that 4% of the crowd which was there, that is when people respect you more rather than the 40%. Yes, because if it's a 40% clearing, that's only garbage in, garbage out. Yes or no? Yes, the intention is to clear, but the intention is to clear with pride also. Clear? Yes, with that said, let's start with the syllabus. Let's start with the syllabus. I'll show you the whole content material first. My whole material is divided into 24 chapters. My whole material is divided into 24 chapters. In this 24 chapters, chapter number 24 is out. Chapter number 24 is out. 2 pages already gone for you. Yes, nothing to be done in this chapter. This chapter was relevant 2 years back, not relevant anymore, but ICI still has it, so even I have it. That's all. 1 page chapter, nothing great about it. 24 number chapter is out. We are going to start with the same sequence which is there in the material. Yes, we're going to start with the first chapter called Basics. We are going to start with the first chapter called Basics. No one is looking at my face, you are looking at the materials. அங்கே வந்துருமா. பிளர்னா நான் ஃபோக்கஸ் பண்ண முடியாதுமா. யூ ஹேவ் யூர் மெட்டீரியல் எடுமா அப்புறம். Yes, we're going to start with chapter number 1. Intention is very simple. I will be repeating what you talk. So which means I will be asking you MCQs. You have to give me the final answer. Yes sir? Yes, we're going to start with that logic in mind. Question number 1. Tax can be levied by anyone in the world. Oh, who levies the taxes? Government. Government gets authorization for levying taxes by Constitution of India. Constitution of India only gives you the powers to levy taxes. Not every Tom, Dick and Harry can levy taxes. No Rowdy Rathore is coming in the mixture here. Yes, only your government has the power to levy taxes by way of Constitution of India. Article number 265 of the Constitution of India gives you the powers to levy and collect taxes. Levy and collect taxes only by the authority of law. If you want to levy and collect taxes, you have to create a law. The law is created by article number 246. Article number 246. Article number 246 gives you the powers to levy or collect income tax. Levy or collect income tax. In income tax we have in 246 we have 3 lists: union list, state list, concurrent list. GST is falling under concurrent list. Income tax falls under, agriculture income falls under state list. This is how it works, which means agriculture income is exempt from tax. It's exempt from Income Tax Act. But in Income Tax Act you have a special concept for it called partial integration. Very good. As we go forward, we'll discuss partial integration also. Yes, this is what your summary is. Then you have to get into direct tax and indirect tax. Which is levied directly on the person? Which is levied as an indirect charge on the person? Which one is on income? Which one is on goods? Which one can shift burden? Indirect taxes. Which one cannot shift burden? Direct taxes. Direct taxes cannot shift burden. Customs fall under indirect taxes. Equalization levy. Equalization? Direct tax. Where did you learn? Income tax and equalization levies. Falls under final portion. Yes, I'm getting you ready for finals, nothing else. Yes, this is what your income tax and, direct tax and indirect taxes. Then we have something called as Income Tax Act and Income Tax Laws. Which one is bigger? Mannangatti. Laws is bigger. Income tax laws is bigger than your Income Tax Act. Income tax laws has 5 components. In that falls Income Tax Act, then Income Tax Rules, then Annual Finance Act, circulars and notifications, judicial precedents. One thing which is very stagnant for you is Income Tax Act 1961. It applies to whole of India. It applies to whole of India with effect from 1st July. Very good. It applies from 1st April 1962. Why 62? We are in Income Tax Act, which talks about previous year and assessment year. This applies from assessment year 62. Then we have Annual Finance Act. For your exam, Finance Act is 20, 21, 22, none of the above. 21. Finance Act is 21. Applicable for assessment year. That is for the attempt. That is all that is important. Yes, you are doing November 22, applying for Finance Act 2021. Assessment year is 22, 23. This is what your Finance Act is. As much as Income Tax Act is static for you, Finance Act is dynamic. That is what is keeping on changing your amendments. So all your greens which you are looking at here will be forming part of Finance Act along with the circulars and notifications. Circulars are binding on departments. Circulars are only binding on department. Notifications are binding on both assessee and department. You have to make an amendment in the rules. You make it by way of make an amendment in rules done by notifications. Make an amendment in act done by Finance Act. Yes sir. You have to make an amendment in notification. It is done by make an amendment in rules. It is done by notifications. You have to clarify something to the officers. Circulars. This is what your whole synopsis is. Last thing is judicial precedents. Have to do in final. Judicial precedents not relevant for your exam. Have to take care of it in finals. Yes. After this we come into the understanding of page maatmama. Adan sonna book paranga. After this we have to look into the definitions of assessee. After that we have to look into the definition of assessee. Nothing of this is important for your exam. Absolutely nothing is important, but just to get a good idea, I will give you a short synopsis of what the assessee definition is. It basically comes and says that any person who is liable to tax, if he is not liable for tax, he should be assessing his income. If income is not there, he should be assessing his losses. If losses is also not there, he should be assessing his refunds. So you can either be liable for your tax You can be liable for your income. You can be liable for your losses. Nothing works out, you're liable for your refund. Is there any other option? No, these are the only 4 which one person can have. But apart from this, if you are someone who's an assessee in default, then in that case also you are treated as an assessee. Who is an assessee in default? Sorry? Any person who does not fulfill his TDS obligations. We were looking at from the income receiving angle. Now we are looking at from the expenditure payer angle. Expenditure payer is paid by TDS and advance tax concepts. So in that case, if you do not pay your TDS and advance tax in time, you will be called as an assessee in default. In that case also you will be treated as an assessee. In that case also you will be treated as an assessee. Should you be only liable for taxes or any kind of penalties and fees also? So the definition is widened enough to say that it is not just for your income which is liable to tax, but it also includes any kind of fees or any other sum which is payable under this act. Apart from this, nothing else is important for you. Nothing else is important for you. Nothing of the income definition all is going to come for your exam. But it's a simple understanding. There is a difference between the term called as a capital receipt and a revenue receipt. Which one is taxable? Question kelunga. Which one is taxable? Both can be taxable. Which one is always taxable? Revenue receipt. When is a capital receipt taxable? When it is covered into this act. When it is covered into the act. Which? Section 2. 24 na? Clause or subsection? Subsection. Why? Very good. When it comes to section 2, things are not related to each other and therefore it is clause. Now I am suddenly going into law. Interpretation of statutes la poitu iruken. Where will you? Yes. So you are into section 2, clause 24, which talks about income definition. In that they have clarified that if something falls under the capital receipts definition, then only it is taxable as capital receipts. For now it is not taxable as capital receipt. Something which is done by aid of a fixed asset is called as a revenue receipt. Something which is done by selling of the fixed asset itself, it's called as a capital receipt. Which is one time? Which is recurring? Revenue receipt. Yes. You have shut down your business. That was the only source of butter, bread and butter for you. That will be treated as revenue, capital? Capital receipt. You had multiple sources of business, shut down one business, called as revenue receipt. This is what the definition is. You get a gift. Do you get gifts, sir? Kurta nala. Yes, no gifts for you, but any case, if you get gifts, that will be treated as a form of capital receipt. Will be taxable under which head? It can be taxable in 3 heads. It can be taxable in salaries also, can be taxable in PGBP also, can be taxable in everything is changing suddenly, no? It can be taxable in any of the heads. It depends on who is giving you the gift. If it is given by an employer, it is taxable under. If it is given by way of business, if it is coming by any other source, you get gift on account of wedding. You get gift by way of wedding because you made an assumption it is IFRS. If you get a gift from your employer, taxable under taxable, not taxable. Salaries exemption irka wedding ku. Again, I started with the same thing. The point is you have to understand who's giving the gift and not the occasion of the gift. First to understand who's giving the gift, classify into heads and then only go into the taxability. Ada golden rules. Identify the question, then identify the person and his residential status, then determine whether the income is taxable or not. Step number 4. Classify into heads, then provide for exemption. Do not provide exemption and then look for head. Wrong answer. Correct? Yes, you have to understand where your head of income is first, then only you have to go for which taxability it is. Again repeating the question. Giving gift on account of wedding. Check with me who is giving the gift. If it is received from an employer, taxable under. Some of your client comes and gives it to you. Anything other than that? So if it is under PGBP and salaries, it becomes fully taxable. If it is under IFOS only, it does not become taxable. Clear? Yes, sir. Yes, sir. Coming to the next part. Now we are into the charge section. Doesn't matter. Nothing of this is important for your exam. Just to quickly understand, income tax is levied in the assessment year. Basis the income which is earned in the previous year at the rates in force. Assessment year is always for a period of 12 months. True or false? Assessment year is always for a period of 12 months. True. Previous year may or may not be for 12 months. True. When is it false? When is it less than 12 months? If your earning part is starting only from the current previous year, if the earning part is only starting from the current previous year, you started your business just now, you were born only just now, all those cases and all, previous year will start from the middle of the year. But there are exceptions where previous year becomes same as assessment year. For the students who have not learnt with me, you want to discuss the 5? Do you remember the 5? Students who are not with me. Students who are not with me. Can anyone help me? Not with me, Nani. Ma, you are my student, ma, don't make me disrespectful like this. Okay, we have a simple synopsis at how we remember all this in our classes. We have created a storyline for this. The storyline works very simply. You are who? You are the favorite person, the most loyal person of India called Vijay Mallya. You are the most loyal person of India called Mr. Vijay Mallya, who has tried to get into F1 racing. You have entered into a contract with Nirav Modi, second most loyal person in India. Yes. So Mr. Vijay Mallya and Mr. Nirav Modi have entered into an AOP, brought an F1 racing. Suddenly F1 racing they went into and they incurred losses. They incurred huge losses. Now because they have incurred huge losses, they do not have money to pay to people. So they are deciding to close down business and leave India. For you to close down your business, you have to sell all your assets. You have to close down your business, sell all your assets. You have sold all your assets, closed down your business also, tried to leave India, tried flight, did not work out, tried car, obviously did not work out, called your friend Doraemon, he brought a ship from Japan, came to India, took you and left. What are the provisions here? First of all, you are AOP or BOI who has formed for a particular purpose, discontinued business in the current year. Second one, your business or profession in the current year is likely to be discontinued. Third one, likely to sell away your assets by way of disposal, with an intention to avoid taxes, Then your non-resident shipping person coming to India, leaving India. Last is you are leaving India with an intention to not come back. 5 scenarios, all the 5 scenarios being covered into your provisions. Clear? These are the 5 scenarios which you have to remember for the purpose of a case where your previous year could become the same as assessment year. Chapter 1 is over. Swaha. Yes, chapter 1 is done with you. How many time will it take? 5 minutes. Yes, coming into the next part of the chapter which talks about the rates in force. The next part of the chapter called rates in force. Now we are getting into the details of it. Next coming chapter is a full silent adjustment chapter. You ask the right question, you will have to do everything on your own. Correct? I will only give you certain facts. The certain facts is fact number 1. I will give you who is an person. Then if the person is an individual, you will have to ask me next question, what is his age? Next question you will have to ask me is what is his age? I give you the age, then you have to ask me whether he is a resident or not resident. If you have to ask me whether he is a resident or not resident, after that is when I will give you the kind of incomes. You will have to take those incomes and then you have to compute 3 things. One is called basic tax, second is called surcharge or rebate, third is called cess. These are the 3 items which you have to do. But before you start this chapter itself, you have surcharge na margin relief automatic vardama. Yes, before you start this chapter, there are 2 golden rules for this chapter. First is that half a mark comes for this. Your total income should always be rounded off to nearest to 10. Your final tax liability which you give to the examiner should always be rounded off to nearest 10. These are the 2 golden rules to follow. After you follow these 2 golden rules, only can you proceed with the chapter. Yes, you have to get into the chapter in that format. First thing is to understand the rates of taxes, for which you have to split the people into different kinds of person. How many persons do we have in Income Tax Act? Individual, HUF, firm, AOP, BOI, local authority, AJP. Local authority and AJP, starting with the first and the most important thing for your attempt. Individuals, starting with the most important thing called individuals. The provisions are very simple. They have told that there is a slab rate concept. For the first 2,50,000 tax will be 0. For the next 2,50,000 it will be For the next 5 lakhs, it will be 20%. Balance, everything will become 30%. This is only applicable if you are an individual. If you are an individual, HUF, AOP, BOI, AJP. But in that individual, there are further classifications. 2, 3, 4. How many more classifications? 2. More 2. What is this? It is if you are a resident individual. Aged 60 and above. If you are a resident individual aged 60 and above, then in that case 2,50,000 limit will become 3 lakhs. So it will become for the first 3 lakhs it is 0. For the next 2 lakhs it is 5%. For the next 5 lakhs it is 20%. Balance, everything will become 30%. But that does not stop there, because it is not just resident individual above 60. It is resident individual above 60 less than 80, which means now you have resident individual above 80 years. If you are a resident individual above 80, what will happen? First 5 lakhs will become 0, next 5 lakhs will become 20%, after that will become 30. There is no 5% here, directly jump to 20. Here is where the circular comes in, and they come and say that if your age is somewhere around 1st April, if you are born on 1st April, then in that case what will happen is it is assumed that you have completed your age on 31st March itself. For your exam, you are writing assessment year, which means you have to look for 1st April 1962 and 1st April 1942. If you touch on 1962, you are treated 60. If you touch on 1942, you are treated 80. Whenever they give you a birth date, the intonation is very simple. They are asking you for the age. You have to compute the age. They will not give you the age. Yes, sir. When they are giving the birth date, they are asking you to compute the age. If it falls on 62 or 42, then you have to check for 60 and 80. Clear? Yes. After this is when you have to classify your individual into poor or rich. If you are a poor person, you will get rebate. If you are a rich person, you will get. I can use terms like poor and rich and all. I don't care. I have passed out. No one cares. Yes. No one is going to come and question me. How can you call me rich and all? You are. That's all. Yes. I am not rich. You are also not rich. I am middle class. You are poor right now because you are not earning. That is how the assumption is. Yes. Anyway, keeping all that in mind, if you are a poor person, what will happen? You will be eligible for a rebate only if you are an Indian child. If you are an Indian child only, you will get to foreign child and all, no benefit for you. Yes. If you are a resident individual, I will have to check if you are a poor or not. How are you poor? If your what income is, total income is up to 5 lakhs, you will be eligible for a rebate at the rate of 12,500 or your actual tax liability, whichever is higher, lower, whichever is lower. It is actual tax liability. Hey, I have one thing to talk wrong answers. You have to give me right answer. Okay. It is actual tax liability or 12,500, whichever is lower. Not eligible for LTCG under section 112A. These are basically your share market incomes. Any kind of share market income which you have from a listed share will not be allowable for 87A. I have already classified you as poor. Now I am classifying you as rich. You have 1 slab, 2 slab, 3 slab, 4 slab, 5 slab. 4 slabs. You have 4 slabs. If you are having an income less than 50 lakhs, no surcharge. If it is 50 lakhs to 1 crore, 10%. If it is 1 crore to 2 crores, 15%. If it is 2 crores to 5 crores, 25% or 37%. If it goes beyond 5 crores, you are eligible for 37%. But you have 2 of these not applicable for certain. These are called as enhanced surcharge. Surcharge of 25 and 37 do not apply on certain incomes. This has changed after November. You have to clear in November. When I have to come back again and read something new. Yes, sir. Come. You want to come back? No, sir. Don't come back to me. Yes. I mean, come back to me for finals. Come back to me for finals. Don't come back for interrogals. Yes. What are the provisions? Enhanced surcharge of 25 and 37 are not applicable on 3 kinds of income. What are the 3 kinds of income? 2 of share market. One is 112A. One is 111A. Both are share market for you. Long-term capital gains 112A. Short-term capital gains of 111A. And then you have the last one called dividend income. For all these 3 cases, you will not be allowed for 25 or 37%. But that is not the only challenge. They've also come and told you that when you are computing the surcharge on the other incomes, these should not be considered. How to remember this is very simple. I've created a chart for you. What do you do is you look at your total income. You look at your Total income. If your total income is less than 2 crores, if your total income is less than 2 crores, do you have a concept of enhanced surcharge? No. When you don't even have a concept of enhanced surcharge, do you have to split? Do not split. Do not split when you don't have an enhanced surcharge case. So in that case, what will you do? You will directly take your total income and compute the surcharge rate, which can either be 0, 10 or 15. 0, 10 or 15. If you have your total income beyond 2 crores, if you have your total income beyond 2 crores, will you have a concept of enhanced surcharge? Yes. With that concept of enhanced surcharge coming into picture, what you have to do? Split your incomes. Split your incomes into normal incomes, these 3 incomes, normal incomes and these 3 incomes. For these 3 incomes, surcharge will always be 15%. Surcharge will always be 15%. For the balance income, standalone. For the balance income, look at it standalone. Minimum you have to levy 15, maximum you have to levy 37%. How to understand this? Let's do some sums. Panlama? Panla sir. Yes. You have an illustration. I have given you the scenarios. I have given you the scenarios. The first scenario is where you have a specified income. What is specified income? 112A, 111A and dividend income. Other incomes are basically your all other incomes. Other incomes are basically your all other incomes. Look at the first case. Everything is in lakhs. Everything is in lakhs. Scenario number 1. Your income is 15 lakhs. Which income? Specified income. Your specified income is 15 lakhs. Your other income is 25 lakhs. Total is it more than 2 crores? Less than 2 crores? Less than 2 crores. Do you have to split or not split? Don't split. Look at it individually. Are you a middle class family? 40 lakhs. You are 40 lakhs. Middle class family less than 50 lakhs. Therefore, surcharge rate will be 0 for both. 0 for both. Yes, sir. Then let's go to the third. Let's go to column number J. Let's go to case number J. Your other income is 130 lakhs. Your other income is 130 lakhs. Your normal income is 55 lakhs. Total panna 185. Less than 2 crores, more than 2 crores? Less than 2 crores. Do you have to split or not split? Don't split. If you are not splitting, the surcharge rate on this will become 15 for both. 15 for both. Come one step above. Come one step above. It is 60 and 135. 60 and 135. Your specified income is 60. Your other income is 135. Total panna 195. More than, less than 2 crores. Do you have to split? No, don't split. Therefore, surcharge will become 15%. Come to this scenario. You have 130 and 280. You have 130 and 280. 130 plus 280 totals to 410. More than 2 crores, less than 2 crores. Meaning it is 4 crore 10 lakhs. 4 crore 10 lakhs, more than 2 crores. Split pannama panagudada. Pananum. If you have to split it, what will happen? Specified income rate will always become 15. So this will become taxable at 15. Look at the other income standalone. Look at the other income standalone. Standalone it is coming as 2 crores 80. Falls within the slab of 2 to 5. Therefore surcharge is very good. Surcharge is 25%. Surcharge is 25%. Next one. It is, sorry. Next is surcharge of 25. Next case. Your other income, your specified income is 130 and your other income is 450. Total pana 580, which is 5 crore 80 lakhs. More than 2 crores. Yes or no? Do you have to split? Split your incomes. If you split your income, specified income will become taxable at 15%. This on a standalone basis is 2 crores to 5 crores. Therefore, should you tax it at 37 saying total income is 580? No, that is what the split concept is. Although the total income has come more than 5 crores, because you look at it standalone basis, it is coming less than 5 crores and therefore it is 25%. Last case mata help pannidunga. Answer vanda correct. Yes, last case. You are having a specified income of 520. You are having a specified income of 520 and your other income is 55. Total comes to 580. More than 2 crores. Split panama panagudada. Pananum. If you are splitting it, it becomes 520 taxable at 15%. 520 taxable at 15%. 55 taxable at less than 1 crore. The moment you cross 2 crores, minimum surcharge is 15%. It does not matter whether it is specified or other income. Minimum pay 15, other will have 25 and 37 also. This will come as 15%. This is your short MCQ question. Short MCQ question, no second thought about it. They will straightforward ask you whether it is taxable at what rate. Do not fall into the trap where you come and say that this will be taxable at 10%. If the income was 4 lakhs, then it will become taxable at 0, nothing. It will become taxable at minimum 15 because you had an objection with enhanced surcharge. You never had an objection with the highest surcharge. 15 was minimum what the government expects from you. Yes or no? Yes or no? Yes. With this, we will first take a hard pause and try to understand what are my heads of income. What are my heads of income? There are 6 heads of income. There are 5 heads of income. Income from salaries, income from house property, profits. Profits and gains, profit or gains? Profit and gains of business or profession. Someone is all fired up. Profits and gains of business or profession. Next is capital gains, and the last one is income from other sources. 5 heads of income. In that 5 heads of income, let's split. If you have a normal case which is called as in salaries, do you have any special incomes in it? No. You have HP. Do you have any special incomes in it? No. If you have PGBP, do you have special incomes in it? No. If you go to capital gains, you have to split into 4. LTCG under 112A, LTCG under 112, STCG under 112A, and normal STCG. All have special tax rates. Come to the last page of this chapter. Page number 11. Page number 11. In this page number 11, you will find the special tax rate. 112A is taxable at the rate of 10% in excess of 1 lakh rupee. 112 is taxable at the rate of flat to 20%. Then STCG is taxable at the rate of 111A is taxable at 15%. Others are gone into slabs. In this cases, if you look at it, this is not eligible for 87A. What is 87A? Do you have to remember section numbers? No, don't remember section numbers. I am showing off, nothing else. Yes, so you do not have to remember any kind of rebate. You do not have to remember any kind of section numbers. 112A is not eligible for rebate. 20 and 15 are eligible for rebate. Yes, sir. 20 and 15 are eligible for rebate. In this cases, which ones are not eligible for enhanced surcharge? 112A and 111A. No enhanced surcharge. This is having enhanced surcharge only for November attempt. Only for November attempt. Do not come and ask me later. Do not come and read a new finance act and come and say me you are teaching me wrong provisions. For November attempt, not applicable. For what May attempt do you want to know? Don't know. You don't know. Yes, you also don't know. I also don't know. Yes, for November attempt, 112 does not have, 112 has an enhanced surcharge. 112A and 111A do not have an enhanced surcharge. With me? Yes. Next one, you have some kind of capital gains over. Then you go into IFOS. Then you get into IFOS. In IFOS, you have to split into 4. You have to split into 4. First one is your casual income. First one is your casual income. Casual income means winnings, lottery, crossword puzzles and all that stuff will be taxable at the rate of flat 30%. You are eligible for expenditures. No eligibility for any kind of expenditures. You are eligible for rebate. Yes. You are You are eligible for rebate. The only thing which is not eligible for rebate is 112A. Everything else becomes eligible for rebate. Surcharge will apply at the enhanced rate also. Yes. Surcharge will also apply at the enhanced rate of 25 and 37%. What was one more thing which I had in mind? Can you set off losses against this? No losses set off also permitted against this. This is the first kind of income called casual income. Second thing is called illegal income or unexplained income. Illegal income or unexplained income, taxable at the rate of, it is 78% including cess. It is 78% including cess. Without cess, it is called as 60% tax, 25% surcharge, 4% cess. 4% cess. Surcharge 25 is flat, change flat. Even if you are a poor person or you are a rich person, it will be 25%. Even if you do, when you are doing an illegal business. Are you eligible to set off losses? No. Are you eligible for rebate? Yes. You are eligible for rebate. Nee endi illegal panalo, if you are a poor person doing illegal business, then also I will give you benefit, no problem at all. Yes, you are a poor person doing illegal business, still you are eligible for benefits, no problem at all, because you are still poor only. Yes, so even if you are having an illegal business, you are still eligible for rebates, but you are not eligible for any kind of set off of losses or any kind of expenditures. Then you have to get into the last kind of special income called dividends. Why is it special income? It's basically simple that the rates might be the same. But the only thing which is not same is the enhanced surcharge case. You have a special restricted enhanced surcharge at the rate of 15%. You have a special enhanced surcharge at the rate of 15%. With all these incomes in mind, one question to you, simple question ma. If your basic exemption limit has not been breached by your normal incomes, if your basic exemption limit has not been breached by your normal incomes and you have these incomes, what incomes? You have 112A, 112, 111A, unexplained income and casual income. Can you set off against your basic exemption limit? First of all, understand that it has to be split into two brackets. One is capital gains, one is others, which means any kind of casual income and unexplained income cannot be set off against your basic exemption. You mandatory have to pay tax on them. True or false? True. Coming to capital gains, you have to check whether you are an Indian child or a foreign child. If you are an Indian child, you are eligible for gulab jamun. If you are an Indian child, you are eligible for gulab jamun, kaju katli, enna dash vachiko. Yes, if you are an Indian child, you are eligible to set off the basic exemption limit provided the guests have not utilized it. Meaning, Finance Act, if the Finance Act has not utilized the basic exemption limit, you can go ahead and utilize the basic exemption limit only if you are an Indian child, meaning only if you are a resident individual. If you are a resident individual, you can set off against your basic exemption limit if it is not utilized by the other people. But if you are a non-resident individual, no set offs permitted. You have to still pay tax on it separately. Yes or no? Yes or no? This is primarily your tax rates in this chapter. This is primarily your tax rates in the chapter, but you have some other tax rates for MCQ purposes. For MCQ purposes. So going into the other people, if you are not an individual, HUF, AOP, BOI, AJP, you could be firm. If you are a firm, the tax rate is flat 30%. Surcharge applies at the rate of 12% in excess of 1 crore. 12% in excess of 1 crore. After that, you could become a cooperative society. If you are a cooperative society, you have 10,000 balance. What? 10,000 balance. 10,000 is 10, 10,000 is 20, balance is. Yenada pesra? First 10,000 is 10%, next 10,000 is 20%, balance everything will become 30%. Balance everything will become 30%. Surcharge will apply at the rate of 12% in excess of 1 crore. 12% in excess. Hey, I don't have the habit of moving my screen. If you have a problem, please look it in your phones. That's not a problem. Okay. Now flow la pona enik varadu. Yes. So surcharge will come at the rate of 12% in excess of 1 crore. 12% in excess of 1 crore. If you are not a cooperative society, you could end up becoming a company. If you are a company, you have to split your company into two: domestic and foreign. If you are a foreign company, tax rate is 40%. If you are a domestic company, tax rate is, check for your turnover. Turnover of, how did you decide? Your current previous year length 2 years back. Your current previous year length 2 years. Which previous year are you writing example? 21, 22, 20, 21, 19, 20. This keeps changing every attempt. Do you want to know? No, you don't want to know. Yes, it's previous year. 19, 20. Turnover has to be up to 400 crores. Turnover has to be up to 400 crores. Tax rate will become 25%. If it is more than 400 crores, it will become 30%. It will become 30%. Surcharge applies at 0, 7, 12. 0, 7 and 12. 0 meaning 0 to 1 crore. 7 meaning 1 crore to 10 crore. 10 crore kamala pona 12%. 10 crore kamala pona 12%. If you are a foreign company, it will become 0, 2 and 5. It will become 0, 2 and 5. One concept which I missed out, I know ma. The concept which I missed out is marginal relief. The concept which I missed out is marginal relief. What is this concept is very simple. They are coming and saying if your income is very close to a slab at which the surcharge changes. If your income is very close to a slab at which the surcharge changes and the surcharge changes, then in that case you will be eligible for something called as marginal relief, and you will be eligible for something called as marginal relief. What is this marginal relief? Is what they are coming and saying is look at your income increase. Look at your income increase. Meaning, let's say for example your income was 2 crore 2 lakhs. What is your income? 2 crore 2 lakhs. First of all, if you look at an income like this 2 crore 2 lakhs, first thing which should hit our head is definitely there is something coming up called as marginal relief. There is something coming up called as marginal relief. What you have to do is check for the nearest slab. What is the nearest slab? 2 crores. Check for the nearest slab. What is the difference between the nearest slab? 2 lakhs. What is the difference between the nearest slab? 2 lakhs. So the first thing what you have to check is step number 1. Check for the difference in income. Check for the difference in income. Next you have to check for the difference in tax. Meaning first compute tax for this, then compute tax for this. First compute tax for 2 crore 2 lakhs, then compute tax for 2 crores, and then check for the difference in tax. Check for the difference in tax. Assuming the difference in tax is 3,56,000. Assuming difference in tax is 3,56,000. For earning an extra 2 lakhs, will you pay 3,56,000? Why will you not pay? If you have earned only 2 lakh rupees, why should you pay 3,56,000? So what will you tell the department is, sir, keep the 2 lakhs with you. I will not pay 1 penny extra. Keep the 2 lakhs with you. I will not pay 1 penny extra. Meaning what you will do is, in the tax of 2 lakhs, you will add, in the tax of 2 crores, you will add 2 lakh rupees, add cess, close the answer. Add cess and close the answer. Option number 2. 3,56,000 minus 2 lakhs comes to 1,56,000. That 1,56,000 will be reduced from the tax of 2 crore 2 lakhs. It will be reduced from the tax of 2 crore 2 lakhs, and after that will you levy cess. After that will you levy cess, which means the last concept of this chapter is called cess. Last concept of the chapter called cess. In your exam it is called as health and education cess, levied at the rate of 4% on basic. It is basic plus surcharge minus marginal relief minus rebate if any. Minus rebate if any. All these things have to be factored in. Basically, cess is the last thing which you levy. Cess is the last thing which you levy. It should not be levied before that, which means rebate will also be given before cess. Surcharge will also be given before cess. Margin relief will also be given before cess. Okay, done. This question is done. Yes. Now we are into the last part of this. Let me clarify. Basic tax is levied on the income. Surcharge is levied on the tax. Surcharge is levied on the tax. Cess is levied on tax plus surcharge minus rebate minus marginal relief. Cess is levied on basic plus surcharge minus rebate minus marginal relief. Clear? Yes. Last thing, just for you to know in your exam. Let's say for example you have your incomes. Let's say for example you have your PGBP income of 2 lakh rupees. What do you have? PGBP income of 2 lakh rupees. 112 is given as 50,000 rupees. 112 is given as 50,000 rupees. 112A is given as let's say over 2 lakh rupees. 112A is given as 2 lakh rupees, and then you have something called as unexplained income of 5 lakh rupees. How much is the total, ma? 9,50,000. Your total income is 9,50,000. With this total income of 9,50,000, I am asking you to compute taxes. With that, what is the first question you will ask me? Ask me first question called who is the person. I told you it is individual. Then you are asking me for age. I told you it is 65. Resident or non-resident? I told you it is resident. Very good. Last question we have to ask is whether it is opting for 115 BSc or not. I said it is opting for 115 BSc. I said it is opting for 115 BSc. The moment I tell you that it is opting for 115 BSc is where the problem comes, because now the age also does not matter, the status also does not matter. The age also does not matter, the status also does not matter, because now you have a new tax rate regime. For an instance, let's ignore that and let's go with this. I told you it is 115 BSc. How do you approach this question? First of all, look at your total income. Are you rich, middle class, poor? Middle class. You are more than 5 lakhs and therefore you are a middle class person. Will you be eligible for rebate? No. Are you liable for surcharge? No. Which means basic tax rates are what are looking at you. Next step is to understand which of these are special incomes. Tell me. Unexplained income. Special or not? Special. PGBP? Not special. 112? Special. 112A? Special. 112A is special. If 112A is special, now this is what you have. Now what you will do is you look at your basic incomes. Look at your basic income, not special income. Number is 2 lakhs. Your basic exemption limit itself is 2,50,000. Have you exhausted your basic exemption? No. Which means you can still use benefit. Now you'll use benefit from 3. Which 3, pa? Can you use unexplained? No. I told you unexplained incomes are not eligible for basic exemption limit. So which means this has to be directly taxed at the rate of 60 plus 25% surcharge. 60 plus 25% surcharge. I will not levy cess right now because that is anyway going to be levied at the bottom. Next thing, I have 112 and 112A. I have 112 and 112A. Which one to use? 112. Why? Very good. What you have to do is you have to use 112 because the tax rate for 112 is 20% and the tax rate for this is 10%. If you use it is 20%. Yes, if you utilize the 20% off in the basic exemption limit, the tax will become 0. So it is better to utilize this than utilize this. If you utilize 112A, what will happen? 112 will become taxable at 20%. Will you like that? No. So what you'll do is you'll utilize your 112. You'll utilize your 112 with your normal incomes. If you utilize that, the full 50,000 will become taxable at 0. Therefore, nothing is taxed here. Balance left off is 2 lakh rupees at the rate of 10% in excess of 1 lakh rupee. Therefore, 10,000. Male irukkudu or 60 plus 25. 5 lakhs into 60% will give you 3 lakh rupees. 3 lakh male 25% will give you 75,000. So it is 3 lakh 75,000. Understand, people, I have already levied the surcharge on the top itself. As much as you are a poor person, you are still doing illegal business. Middle class family, you are still doing an illegal business, and therefore this will become 3,75,000. Total pana it comes to 3,85,000. If it is 3,85,000, you will levy 4% cess number 15,400. Total pana 400. You have to use the number pota patiya. Yes, this is what your final tax rate will come. Do you have to round it off to the nearest 10? No. Why? Already rounded off. It is already rounded off. This is how you have to approach a question. Yes, when you look at a question of rates of taxes, the first question you have to ask is who is the person. Second, ask for age, then ask for status, then ask for 115 BSc or not opting for 115 BSc. After you get all the answers is when you have to look at your income, check for your income. If it is a poor, rich or middle class, if it is a poor person, you will be eligible for rebate. If it is middle class, no rebate. If it is a rich person, you will be eligible for surcharge. When you go for surcharge itself, check if the income is nearest to a slab in which you will get a marginal relief. Clear? Your chapter is done here. You have basically completed the first chapter of your ICI study material now. Yes, while we are at this chapter itself, let's quickly understand what is your new tax regime. What is your new tax regime called as 115 BAC. I am only discussing the tax rates right now because the provisions of that will be discussed in the subsequent chapters. Yes, what are the tax rates for 115 BAC? Keep adding 2,50,000. Keep adding 2,50,000 up till you reach 15 lakhs. Keep adding 2,50,000 up to you reach 15 lakhs. It basically works like this: 2.5, 5, 7.5, 10, 12.5, 15, 12.5, 15, add 0, 5, 10, 15, 20, 25, everything else becomes 30. Where will you find this tax rate? In your material second last chapter, second last or third last chapter, if my memory serves right. In your material, third last chapter will be the 174. Unnoda material vera, ennoda material vera. Ennoda pages maro. Yes, it will be in the second last, some chapter called special tax regime is there ma. Third last chapter. Keach tiya book, sandosham. Which chapter ma this is? 20th. Chapter number 20 will have your tax rates. Clear? Clear? With this we are done with your basic tax rates also. In your ICI study material, you will have one more chapter clubbed along with this, which is called as unexplained income. One other chapter which is clubbed along with this called as unexplained income. Open it in your material. I am not going to open it. In your material, it is chapter number, page number mattum sollirada. Chapter number 22. Chapter number 22 in your material. Quickly, people. Chapter number 22 in your material. Quickly understanding this provision in exactly 2 minutes. In exactly 2 minutes, we are talking about taxation of unexplained income. Here is where we have come and clarified that the tax rate is 60 plus 25 plus 4 without any set off of losses, without any set off of basic exemption limit, but allowability for rebate. Now here is where you have to understand what do you mean by an unexplained income. The provisions are like this. They have come and told that you have to go and explain the officer. Which officer? Assessing officer. Go and explain the assessing officer what he asks from you. If you are able to explain the officer and he is convinced, good. If he is not convinced, what will happen? He will treat everything as unexplained income. If you do not even go and explain to him, he will treat it as unexplained income. That is what the concept is. Whatever provisions we learn, all the provisions, one simple logic, the provision comes and says that you have to go and explain the officer what he is asking from you. If you are able to explain the officer, he is happy, good. If he is not happy, what will he do? Tax it as unexplained income. If you have not even furnished your explanation, then also it will be taxed as unexplained income. How does this work is that first of all they will come and say that you have any kind of unexplained cash. If they enter your house and they find any kind of cash in your hand, they will ask you for the source. You give the source, great. Don't give the source, taxed as unexplained income. Scenario number 1. Scenario number 2, you have some kind of credit in your books. He asked you for a source, you don't know the source, it is taxed as unexplained income. Scenario number 3, he saw an asset in your books. Worth 50 rupees. What example are we talking about? We're talking about a diamond chappal. Which person? You shout, I will not shout on the camera. You shout. I don't want anyone from a political party here. I always ask this question. Anyway, yes? No political parties, no? Okay. Nee ennoda class? You. Right, anyway. Yes, if you find a chappal in your asset side, which is showing at worth 50 rupees, but the chappal has diamond studded on it and it comes to around 5,000 rupees. It comes to around 5 crores. Around 5 crore rupees. In that case, what will happen? Assessing officer will ask you for the difference. You explain the source to him, he will leave it off to you. You don't explain the source to him. He will tax how much? Difference, meaning 4 crore 99 lakh 99,950. He will not tax the whole 5 crores, he will tax the 4 crore 99 lakh 99,950 as unexplained asset in the form of unexplained income for you. Second, they are coming and saying you have an asset, you never even recorded it. You did not even record it. Chappalo kamikla, and the 50 rupees kuda kamikla. What will happen? Motto 5 crores will become taxable for you. Last two scenarios are where they are coming and saying that in case you are giving a partial disclosure, that is what we discussed right now. The next thing which we are discussing about is unexplained expenditure. He will basically tell you that you have spent somewhere. One favorite question of examiner is that there is a daughter whose wedding is happening. You have spent around 5 lakh rupees for the wedding. Assessing officer asked you for the source of the income. Where did you get this money to spend 5 lakh rupees? You told you got it from your salary. He opened up your salary slip, found out that the salary is only fetching you 1 lakh rupees every year. And your expenditures normally itself is 80,000 rupees, which means every year you maximum saved only 20,000 rupees, and you have been working only for 5 years, which means max to max you could have only saved, but you have spent. In that case, he will come and say, you have a source worth of 1 lakh rupee, you don't have a source worth of 4 lakh rupees. Therefore, the expenditure taxable for you will become 4 lakh rupees. Alternatively, too, he is coming and saying, sir, the expenditure, then you do one thing, you allow it as an expense and at the same time you give it as an income. Net effect 0. Permissible, not permissible? If you have claimed any kind of expenditure, the expenditure will be fully disallowed. Any kind of expenditure which is unexplained will be fully disallowed, and then the income will become taxable for you. If you never even claim the expenditure, good, directly tax the income. Clear? Yes. If you have claimed an expenditure, simple pa, you have a P&L. Look at the left side of the P&L. If the expenditure says 100, assessing officer asked you for reason. You did not explain the reason. What will you do? He will say bus, disallow, and then income 100. Second option, you did not even claim. Assessing officer said, give me the reason. You said, sir, income podli, expenditure claim panla. Enna sir ungalku prachane? I want the source. You did not explain the source. Nothing is there here. Directly tax at 100. Mudinju pochu. Clear? This is what is your chapter called Unexplained Income. Ado swaha mudinju pochu. Done? Yes. Coming to the next chapter called residential status. Coming to the next chapter called residential status. Tired up, huh? Yes, coming to the next chapter called residential status. This chapter is the most important chapter from your 4-mark question perspective. One question definitely will come as a 4-mark question of your residential status. Directly they will come and ask you what is the residential status, compute the number of days to stay, this stay, that stay, period of origin, everything will come in. Yes, one straightforward 4-mark question will come either as an MCQ or as a written paper, either as a written paper or as an MCQ. MCQ vanda no mosam. Just in case someone is thinking MCQ vanda nalla irukum, anga oru logic kuda thappa pochuna gaali paper. Yes, inga achu neenga provisions enna step marks kuduthruvaru vera vali illa. Yes, so be very very careful about your MCQs. Anyway, all that aside, we are into the chapter called residential status. Again, you have to split all your persons into various parts, but for your exam the most important person is individual. Do you want to read theory? Do you want to read chart? Let's read charts. Hey, this chart will be tilted in my material. I don't have an option. You see in your materials. You see in your materials, there is a special chart for the whole residential status covering in a single shot. Covering in a single shot. You have to start from the most basic definition. You have to start with the most basic definition, condition called stay in India for 182 days or more. If you stay in India for 182 days or more, you will directly be treated as a resident. Come to the right side of the chart. Come to the right side. My right side. My right side. Yes, my right side of the chart, you will be treated as a resident. If you do not stay in India for 182 days or more in the previous year, you have to come to the left side of the chart. When you come to the left side, you have to split yourself into 2, 3, 4, 3. Split yourself into 3. If you are an Indian citizen who is crew member of an Indian ship, or you are an Indian citizen leaving India for employment, if you are leaving India for employment, in these two cases the condition number 2 was anyway not applicable to you. First condition of 182 days not satisfied, directly treated as a non-resident. Directly treated as a non-resident. Come to the second part of the chart. You are an Indian citizen or a person of Indian origin. What do you mean by a person of Indian origin? Your parents and grandparents should be born in undivided India. Your parents or grandparents should be born in undivided India before independence, after independence. Before independence. Before independence, they should be born in undivided India. Undivided India meaning India, Pakistan, Bhutan, India, Pakistan, Bangladesh, Nepal, Sri Lanka, Myanmar. Yes, India, Sri Lanka, Pakistan, Nepal, Bangladesh, Myanmar. Yes, all these cases are your undivided India. You have to be born here. Who has to be born here? Parents and grandparents. They should be born here in undivided India, in which case you will be called as a person of Indian origin. You will be called as a person of Indian origin. If you are an Indian citizen or a person of Indian origin, I will ask you one question. Tell me whether you are outside India. Tell me whether you are outside India. If you tell me yes, you are outside India, I will ask you one more question. What is the question? I will ask you whether you are visiting India. If you tell me you are visiting India, I will ask you one more question. Hey, don't visit India. Da. What will I ask you? I will ask you whether your Indian income is more than 15 lakhs. If you tell me that your Indian income is more than 15 lakhs, I will ask you one more question. What is that one more question? Tell me what have you stayed in India in the current year for? If you tell me that you have stayed in India for 120 days or more in the current year, can you stay for more than 182? That is what the condition was. That is what the condition was. If you had stayed for more than 182, you have already gone on the right side. You are here less than 182, which means you have stayed in India for 122, 181. You have stayed in India for 122, 181 in the current year, along with 365 in the last 4. Along with 365 in the last 4 years, in which case you will be treated as directly RNOR. You will be directly treated as an RNOR. No ROR, no NR, nothing. Directly treated as an ROR. Come to the top. Come to the top. You are an Indian citizen outside India. You are an Indian citizen outside India. Now I am telling you, you are an Indian citizen inside India. You are an Indian citizen inside India, in which case you will come merge with the third side of the chart. Merge with the third side of the chart. Let's discuss separately. Come to the other part. You are engaged outside India, not visiting India. Merge with the third part of the chart. Merge with the third part of the chart. You are an Indian citizen outside India, coming to India, Indian income less than 15 lakhs. Indian income less than 15 lakhs. Condition 2 became ignored for you. Therefore, you will directly be an NR. Directly you will become an NR. That is what the provisions are. You read through the whole additional conditions, you will understand. Yes, adha mottama chart potirukken. You will directly become an NR. Here, Indian income means Indian income means that income which is taxable for RNOR. Indian income means that kind of income which is taxable for an RNOR. Now tell me, what is the income taxable for an RNOR? Income received in India, income deemed to receive in India, income accruing or arising in India, income deemed to accrue or arise in India, income accruing or arising outside India from a business controlled in India or a profession set up in India This is what is called as your Indian income. Now we'll come to the third side of the chart, where we have told that you are not doing an Indian citizen crew member, you are not an Indian citizen leaving India, you are not an Indian citizen coming to India, you are nothing of those. In that case, you will come to the third side of the chart and I will ask you whether you have stayed in India for 60 days in the current year, less than 181 days, stayed between 60 to 181 days and 365 in the last 4 years. If you tell me yes, you will be called as a resident. You will be called as a resident. Tell me no, it will become non-resident. Tell me no, it will become a non-resident. Now, in the third side of the chart, you have a resident. Right side of the chart, you have a resident. Merge together, and you have to ask 2 questions. Are you a non-resident in 9 out of last 10 years? Are you a non-resident in 9 out of 10 years? If you say me yes, your answer is RNOR. If you tell me no, I will ask you second question. Have you stayed in India for 729 days or less in the last 7 years? In the last 7 years. If you tell me yes, you will again become RNOR. Tell me no for both, it will become ROR. In the left side of the chart, wherever you had a non-resident, you will club everything together. Left side of the chart, wherever you had a non-resident, you will club everything together and you will ask one more question. Were you an Indian citizen? If you tell me yes, I will ask you, were you not liable for tax in any other country? If you tell me yes, I will ask you, is your Indian income more than 15 lakhs? If you again tell me yes, I will deem you as a resident in India and you will directly become RNOR. You will directly become RNOR. Here is one thing which ICAI makes a mistake, but I want you to be extra careful about. All these questions where you are a deemed resident, the answer will be deemed resident. Meaning, in your study, in your most of the MCQ questions which I have noticed, what they do is by mistakenly they give ROR, RNOR, deemed resident, none of the above. Now, technically that person is RNOR. But because a specific option called a deemed residency is given, I want you to be extra careful and only take deemed resident. Unless and until there is no answer itself called as deemed resident. In which case the answer will directly become RNOR. Varna, the answer is always the deemed resident. For some reason, ICAI is not correcting itself, so adanal you don't have an option. For the next 3 years, 5 years, for the next 3 years, you don't have an option. He is only your God. Whatever he says is the right answer. Yes. After that, you can come in my position and you can criticize whatever you want on the public channel. Do whatever you want. Yes. You also go on YouTube. You also shout on the crowd saying ICAI is worst. Yes. Clear? For your exam purposes, it is always called as a deemed resident. What is the condition? You have to be an Indian citizen, having Indian income more than 15 lakhs, should not be liable to tax in any other country. You will be treated as a deemed resident. In this position, we have to clarify 2 more things. First thing is that your date of arrival and your date of departure will be assumed as in India. Your date of arrival and date of departure will be assumed as in India, even if you were in that day for 1 minute also. That day will be assumed as in India. But yes, if you are a ship member, if you are a crew member who is leaving outside India, the moment you enter the ship and you sign a document called continuous discharge certificate, that is the day I will assume you are outside India. The next time when you become in India is the day when you come back and you sign off. What is this continuous discharge certificate? This is what this is what this does not look like India. Anyway, something India. Yes, you have an India. Let's say, for example, you board the ship on Visakhapatnam. You board the ship on Visakhapatnam. The ship is going from Visakhapatnam to Mumbai, then leaves for Singapore. The moment you boarded Visakhapatnam itself, it was treated as you are outside India. Till the time you reached Singapore, you were always outside India. From Singapore, when you come back, come to Mumbai, come to Visakhapatnam. On Visakhapatnam, when you sign off, is the day when you will be treated as in India. Is the day when you will be treated as in India. Okay, clear? Ipo work ago patiya. Pesnadaka apra work ago. Clear? This is your whole summary of your residential status of individual in a single shot. No provisions reading, no nothing. One chart along with 2 extra provisions, and your chapter is done. There is nothing difficult about this residence status. The whole kadai which is there in my material, the first 2 pages can be fully ignored. Directly read the chart and you're done with the exam. That's all. Yes, keep a clear idea of this chart. Go through the chart once or twice. Stick it on your whatever board you have at your home and all. Yes, one wall will be there. Just stick it on that wall. Every day once you come in the morning, look at the chart once for 5 minutes and then it will stick in your head. Yes, because when you enter the exam hall, when you see a person like a resident status, you imagine the chart and you should come and say left side or right side. Left side na first charta, second charta, third charta. Yes, if you can get that kind of grip in your exam, resident status is already done for you. Clear? Yes, this is your resident status of an individual. After that, everything is cakewalk. The second thing is resident status of HUF. Resident status of HUF. You have to check for control and management. If the control and management of the HUF is wholly or partly in India, then in that case you will be called as a resident. If it is wholly outside India, then it is called as a non-resident. In HUF also you have to split between ROR and RNOR. Basis Karta. Karta oda additional conditions paakano. If the Karta was a non-resident in 9 out of 10 years, or the Karta was staying in India for less than 729 days, then in that case HUF will become RNOR. If not, the HUF will become ROR. Can there be a scenario where the Karta is having a non-residency but the HUF has a residency? Possible. Can there be a scenario where the HUF is a resident but the Karta is a non-resident? Possible. In all those scenarios, what you will have to do is you will have to again, in that scenarios, what you will have to do is you have to check for the HUF soda ROR and RNOR basis the Karta, irrespective of whether he is a resident or a non-resident. Clear? Yes, I have one question on this. I will take a screenshot of the question and post it on the WhatsApp group which we have, just so you can remember it. Yes, in our material I have one question for the old students. For the students who have not been with me, I have one certain question which came in the past exam. I will take that question, post it on the WhatsApp group so that you can understand that provision better. Clear? Yes, this is what is the resident status of an HUF. After that, you have to get into firm, AOP, BOI, local authority, AJP. All those cases, straightforward one provision. Check for the control and management. If the control and management is wholly outside India, you are a non-resident. If it is partly also in India, do you have to split between ROR and RNOR? Only splits for ROR and RNOR for individual and HUF. Others do not have a split. Then you have to get into company definition. There are 2 types of companies, foreign and domestic. Foreign means incorporated outside India. What is a foreign company? Company which is not a domestic company. What is a foreign company? A company which is not a domestic company. Adu velila indalo enna India la indalo enna yaar kekku poradilla. Yes, a foreign company is a company which is not a domestic company, which is when you have to ask yourself what is a domestic company. Domestic company means that kind of company which is an Indian company or any foreign company which is giving dividends in India, What is an Indian company? A company incorporated under India. Whether it can be Companies Act, it can be Daman and Diu Act, it can be Dadra and Nagar Haveli Act, enna or act indalo. As long as it is incorporated in India, it is a Indian company. As long as it is incorporated in India, it is called as an Indian company. If you are an Indian company, you will always be treated as a resident. If you are any other company, you have to check for the poem. What poem? What poem get a full form? It's called place of effective management. Do you have to know what is a poem? No. Final level portion. What is a poem? Final level portion. For your inter level, if the poem is in India, then in that case it is taxable. Sorry, it is treated as a resident. If the poem is outside India, it is treated as non-resident. Why is it called poem in India and why is it not called poem partly in India? There is a word called effective into the question. The other cases and all we learnt as control and management wholly or partly in India. We learned wholly or partly in India. Here we are only learning poem in India. The reason is very simple. They have told it's not place of management, it is place of effective management. If effectively itself you are in India, there is no concept of wholly or partly in it. That means you are effectively outside India also. It doesn't matter. If your poem is in India, then in that case you are treated as a resident. Treated as a resident. First part of the chapter, Mununjichu, Swaha. Residential status, we started at 8:11. Na note panna. We started at 8:11. We are at 8:27. 16 minutes. Residential status also is done for you. Yes, sir. Then we have the next part of this chapter called as scope of total income. You want to set a target? You want to set a target? When are we completing? Let's discuss. In the second part, yes. The next part is scope of total income. The next part is scope of total income. You have to split your person into three: ROR, RNOR, NR. ROR, RNOR and NR. If you are an ROR, your global income is taxable. If you are an ROR, global income is taxable. If you are an NR, you have four incomes which are taxable: income received in India, income deemed to receive in India, income accruing or arising in India, income deemed to accrue or arise in India. If you are an RNOR, 4 plus 1. If you have RNOR 4 plus 1, that is called as income accruing or arising outside India from a business set up in India, from a business controlled in India, profession set up in India, but whether you are all these people, it doesn't matter. The moment you have any kind of money coming into India in the form of remittance, that is never taxable. Any kind of money outside India brought into India will never be taxable at the instance of remittance. It can be taxable at the instance of earning, cannot be taxable at the instance of remittance, because it is not an income but a receipt. It is not an income but a receipt. All receipts are income. All incomes are receipts. Not all receipts are income. All incomes will definitely be receipts, but not all receipts will become income. Clear? Yes. But this is what your table is. So this is what the final table is. மேலே இருக்கிறது கதையை தேவையில்லை. இந்த டேபிள் மட்டும் படிக்கணும். இந்த டேபிள் மட்டும் you have to read, where you have to split into ROR, RNOR and NR. 4 heads of income plus 5 head of income, and the last one is income remitted outside India. இந்த டேபிள் மட்டும் படிச்சா போறோம். கிளியரா? எஸ். அதான்ப்பா 175 pages சொல்றதுக்கு இருக்கு. உள்ள போய் கதை பார்த்தா ஒண்ணுமே இல்லை. Yes, only tables are there. You have to just read those 5 tables and the whole chapter is done. Residence status la ஒரு chart படிக்கணும், scope of total income la ஒரு table படிக்கணும், முடிஞ்சு போச்சு chapter. அவ்வளவுதான் chapter காலி. Yes, now coming to the most interesting part of the chapter. Called income deemed to accrue or arise in India. We told income received in India basically meaning the money should be received in the bank account in India or in the hand of India. Income accruing or arising is basically a case where the business is in India. There is no problem at all. The source generation itself is happening in India. Income deemed to receive in India is basically all those cases where you are contributing to PF, NPS and all those cases. Who's contributing? Employer is contributing. The last case is where you have income deemed to accrue or arise in India. The best way to remember is to remember your heads of income. So starting from the first head of income called salaries. Salaries they come and say any kind of money which any kind of salary which is paid by the government of India will always deem to accrue or arise in India. Any kind of salary paid by government of India always deemed to accrue or arise in India. But if the salary is paid to a embassy person, in which case what will happen? Any kind of allowances and perquisites will become exempt from taxes. Meaning direct money alone will become taxable. Bonus, basic salary, all those cases will only become taxable. Any kind of allowances and perquisites which you give to that embassy person will always become exempt from taxes. Second thing, they are coming and saying, if you come to India and you do a service here, basically any kind of employment in India will become taxable India. Any kind of tax employment in India will be deemed to accrue or arise in India. This is for salary. This is for salaries. Next thing is house property. Next thing is house property. Straightforward provision. If the house is located in India, it is taxable in India. If the house is located in India, it is taxable in India. Next one. Next one is PGBP, starting with the first and the most important part called agents. First and the most important part called agents. They have basically come and said that you have to establish yourself as a business connection. You have to establish yourself as a business connection. எந்த கதையோ தேவையில்லை, மொத்தம் கதை அப்படியே கட் பண்ணிடுங்க. இருக்கிறது கீழே இருக்கிறது 2 லைன் மட்டும் தான் முக்கியம். இருக்கிறது 2 லைன் மட்டும் தான் முக்கியம். மேலே இருக்கிறது எல்லா கதை is only final level portion. Okay, கீழே இருக்கிறது 2 லைன் தான். Basically they are coming and saying if you are an agent of the non-resident, if you are a agent of the non-resident, split yourself into 2. Dependent agent, independent agent. If you are a dependent agent, business connection established. If you are an independent agent, no business connection established, not taxable in India for non-resident. Not taxable in India for non-resident. Agent and all is always a resident only. Agent and all is always a resident only. So this is what the provisions are. What are the provisions? Straightforward. If you are an agent, check whether you are a dependent agent or an independent agent. If you are an independent agent, not taxable. Dependent agent, you will establish business connection and become. This is what the agency provisions are. Apart from that, you have your amendment for the current attempt. Apart from that, you have an amendment for your current attempt. Yes, this is what is your amendment for the current attempt called SEP. Significant economic presence. Significant economic presence. This is most likely an MCQ question. This is most likely an MCQ question. The provisions are basically coming and saying that if you are a non-resident, who is engaging in India, by whatever means, whether you're doing online, offline, you're calling someone, you're talking to someone, you're calling anyone else, what doesn't matter. If you are engaging with India, and your turnover in India is more than 2 crores, how do you remember this 2 crores? See, how do you remember this 2 crores? Presumptive taxation, 44 AD. 44 AD, presumptive taxation has the same turnover of 2 crores. There only we told, no, if you are a poor person, you don't have to create a whole PGBP balance sheet. Directly come and do the 6% and 8%, same provisions. Only if you are a rich person is when India wants tax from you. If you are a non-resident, not even earning 2 crores from India, what is the tax I'll collect from you? Correct? So the same provisions, link it there and read. 2 crores is basically what? Same as your presumptive taxation. Alternate number 2, they are coming and saying if you are engaging with at least 3 lakh people in India. 2 options, either you should have a turnover of more than 2 crores. Second option is you should have a more than 3 lakh users in India, in which case you will be treated as a significant economic presence. In India, and your income will become taxable in India to the extent it is attributable to the operations you carry out in India. Attribute to the operations you carried out in India. But when it comes to business connection, they have given 5 exceptions. Exception number 1, they have come and said is that if it is an income which is not even coming from an activity in India, not taxable. Second one, you are only purchasing goods from here. For the purpose of doing export. Meaning what you're going to do is you're going to take the raw materials, go outside India, manufacture outside India, sell outside India. Do you want tax in India? Purchase of goods for the purpose of exports, not taxable. Next thing is, if you are into news agencies, if you are into any kind of, if you are into any kind of news agencies, any kind of collection of news and views in India will not become taxable in India. And pakkathe poku kudadu. Yes. Don't even go and next Arnab Goswami da pakkathile irupar vera onnilla. Yes, never even go into the news agency part of the life. Yes, any kind of collection of news or views for transmission outside India will not be taxable. Any kind of cinema people coming to India and shooting films in India, not taxable. Last one is any kind of display of uncut diamonds. Any kind of display of uncut diamonds in India will not be taxable for the purpose of display alone. If you are going to sell, then it is taxable. But yes, again, if it is for the purpose of exports, not taxable. This is what is your provisions for PGBP. Next 2. What are the other 2 heads? Capital gains. The other 2 heads are called as capital gains. Capital gains basically come and say that if the asset or the property was in India, then in that case it will become taxable in
India. Then in that case, final level portion. Even if for the asset and property which is situated in India, it will always be taxable in India. Na sonnanda final level portion. Yes, asset or property situated in India will always be taxable in India. That is the simple provision for capital gains. And last is IFOS. Our last one is IFOS. Split IFOS into multiple brackets. First thing is gift. They have basically come and said is any kind of gift which a non-resident receives will become taxable in India provided it covered under IFOS chapter. And then the most important three is interest, royalty and FTS. All the three will be checked from payer angle or recipient angle. Will be checked from the payer angle. What the payer does will impact the recipient. Simple provisions they are coming and saying if the payer is government of India, he is going to use it for Indian purpose or foreign purpose. Then in that case the income for the recipient will become taxable in India. All the three scenarios. Next two. Paid by a resident. If a money is paid by a resident, the intention is always to use in India or outside India. Which means should it be taxable always or not taxable always? Should be taxable always. So the next part of the provision is coming and saying if you are a resident, who are you? Resident. If you are a resident, then generally the recipient's income will become taxable in India unless and until it can be proved that the resident is using it for outside India. And the last thing is paid by a non-resident. If a non-resident is paying to a non-resident, intention is generally to use in India or outside India. Should it be taxable? Not taxable. So if it is paid by a non-resident, the income for the recipient is generally not taxable unless and until it can be proved that the non-resident is using it for India. In this there are two splits. If it is interest, then it is only for business in India. If it is other royalty and FTS, it is business or any other purpose. I think in your materials, the black and white material also, it be highlighted. Interest part, if you go and check, you will find this. If you go to the interest part, you will find that in the non-resident, it would be said as only for business or profession. But if you go to royalty and all that cases, it will be said that carrying on business or profession or earning any other income in India Simple example I'll give you. Let's say you are a non-resident. Who is coming to India for doing business. Let's say if you are a non-resident coming to India for doing business, you take a loan from another non-resident. And you use that money for business in India. The interest paid by this non-resident to that non-resident will become taxable in India. Option number 2, you come down to India. Who are you coming down? Non-resident. If a non-resident is coming down to India and he purchases shares of India, what does he do? He purchases shares of India by taking a loan from a non-resident. Now, this shares which he purchased, income will become taxable under the head IFOS or capital gains. It will be taxable under the head IFOS or capital gains. Is it relating to your business or profession? No. Since it is not relating to your business or profession, the interest which you paid to the other non-resident will not become taxable in India. So if a question comes in exam where they come and say that you are a non-resident receiving interest from another non-resident, check what the other non-resident is doing. If he is using it for his business, then it is taxable. If he is not using it for his business, then not taxable. But if the same scenario is for a royalty or FTS, whether he uses it for business or he uses it for other sources, everything will become taxable. மொத்த கதையை தேவையில்லை, ஒரு சார்ட் கடைசியில் போட்டிருக்கேன், முடிஞ்சு போச்சு. Everything which we discussed in a summarized form is there in this chart. Summarized form is in this chart. You just have to read this chart and go for your exam. Basically in the chapter irukku 3 chart. Individual chart and the taxable non-taxable chart. In the chart 3 மட்டும் படிக்கணும். படிச்சா chapter முடிஞ்சிச்சு. Clear? Yes. Where did we end? 8:40. Correct 10 minutes. Yes. We have completed how many part of the chapters? 3 chapters we have done. When did we start? When did we start? 7:30. Exactly 1 hour 10 minutes. Exactly 1 or 10 minutes. We are done with 3 part of the chapters, in which rates of taxes was the most biggest chapter and the resident status was the second most. Inga 4 mark, anga 6 mark. 10 marks already done in 1.5 hours itself. Yes, balance, how much do you have? How much do you have? 50 marks. Balance 50 marks is what we are going to cover with the most important parts called heads of income. We will start with salaries and then we'll go for a break. We'll start with salaries and then we'll go for a break. Salaries mattum mudichittu we'll go for a break. Yes, I can promise you 9:30 kulla mudichiruvom. Try pannalama? Let's start with the biggest chapter in your syllabus called salaries. Biggest chapter for your syllabus called salaries. We're going to start with this chapter and try to complete it in another 45 minutes. That's my promise to you. Yes, this chapter, sit at home and try, no? 1 hour? Super. Sorry, ma? 30 minutes, huh? In class with device in 30 minutes, huh? Appo 30 minutes vechittu oduvom. Here we are going to take 45 because we are going to discuss 115 BSc also. We'll discuss both together. Yes, the chapter will work like this, people. Simply put, I will take this chapter, take one provision. You will tell me the provision. You will tell me the provision and then I will ask you second question. Is this applicable for 115 BSc also or not? With this, we will be covering 115 BSc as well as salaries together. What I want you to do is, if you have not been in my classes and you have taken a material in my hand, I generally tell people that if it's something not applicable for 115 BSc, make a note there itself. Yes, if you have a new material in your hand and if I tell you that this provision is not applicable for 115 BSc, I want you to make a note then and there itself in that material itself, so that on the 115 BSc chapter paaka thevilla. Inge padichittu muchita. Yes sir. Yes, whenever I tell you that there is 115 BSc not applicable, these provisions will become noted down in your material at the same part of it and you will come and say that these are not covered under 115 BSc. Basically, in this marathon, I am not going to touch the chapter itself. Is that okay for you people? You don't have an option. Yes, can we? Great. We are into the chapter called income from salaries. For you to be under this chapter called income from salaries, there is a basic condition which you have to satisfy. The basic condition is that there should be an employer and employee relationship. There should be a master-servant relationship, an employer and employee relationship, and the payment should come to you because of that relationship. Just because your manager is happy tomorrow and she gives you something out of her pocket does not get taxable under salaries. Just because your manager pays something out of gratitude to you does not become taxable under salaries. It has to be forming part of the employer-employee relationship is when it is taxable under the head salaries. If you are a salary person, you have to check from whom are you receiving salary. If you are receiving from an employee, it is taxable under salaries. If you are receiving from an employer, it is taxable under salaries. If you are receiving it in the form of MPs and MLAs, it is taxable under IFOS. It is taxable under IFOS. At this point itself, I will cover the exemptions also for you. They basically will come and say that any kind of daily allowance and constituency allowances which are given to MPs and MLAs are exempt from tax. Say, Varunda. I will ask you the question. You should wait for it. Yes, we are into right now MPs and MLAs. MPs and MLAs or the income will become taxable under the head IFOS. Any kind of daily allowance and constituency allowances will become exempt from taxes, provided you do not opt for 115 BSc. The reason I am not discussing it is not there in this material. It is there in IFOS chapter. IFOS padipom. Yes, when we go to IFOS, we will discuss that. As of now, the provisions are like this. Second, if you are receiving salary as a partner, be taxable under the head PGBP, will not be taxable under the head salaries. Here is where you have to understand one more concept called application of income and diversion of income by overriding title. The concept is very simple. If you are liable to receive the money, and then give this money to someone else, that is called as an application of income. Simple example, today you were ready to receive 5 lakh rupees as salary. But you went to your employer and you came and said, sir, I don't want that 5 lakh rupees in my pocket. Do one thing, donate it to Adani Foundation. That is the only reason he's becoming rich, no other option. Yes, donated to Adani Foundation. In this case, were you liable to receive that 5 lakh rupees? Yes. Who made the decision to transfer it? This is called as an application of income. Is that 5 lakh rupees taxable for you, not taxable for you? That 5 lakh rupees is taxable for you. Separately, because you made a donation, you can claim it under 80G. You can claim it under 80G. Second option, you were supposed to receive 5 lakh rupees. You were supposed to receive 5 lakh rupees, but your contract for some reason comes and says, even if you are liable to receive 5 lakh rupees, 2 lakh 50 will go only to your wife. First of all, this is called as a diversion of income by overriding title. This is called as a diversion of income by overriding title because unfortunately you were not even liable to receive that money. When you entered into the employment itself, it was very clearly said that you have to give 2 lakh 50 to your wife, which means you never had a control over that money. Okay, do you have control over the balance 2 lakh 50? You anyway don't have control over the full 5 lakhs. Academically, 2 lakh 50 is what you have control over right now. Yes, so 2 lakh 50 is what you have control over right now. Balance 2 lakh 50 is in the hands of wife. This is called diversion of income by overriding title. Technically, this would have not been taxable for you. Technically, this would have not been taxable for you, but clubbing might apply. Why will you say clubbing is applying? Sorry, ma? Huh? I have not even given you the conditions. There are a lot more conditions to satisfy in clubbing. Just like that, Motiite will not come into clubbing. There are a lot more conditions to satisfy. When we get there, we will discuss. Yes, right now, diversion of income will not become taxable. Diversion of income will not become taxable. Clear? This is the one concept which you have to remember in your concepts of salaries. With this is when we will get into the chapter called income from salaries. Again, one rule in my material, you will have a format for every chapter. You will have a format for every chapter. Religiously follow the format, you will always get the right answer. Religiously follow the format, you will never get a wrong answer. Following the format starting from basic pay. Following the format starting from basic pay. Taxable, not taxable. Always and fully taxable. Always and fully taxable. Second is called dearness allowance. Understanding here, in your exam, this could be called as a dearness allowance or it can be called as a cost of living allowance. Both are the same thing. Both are the same thing. It is either called as a dearness allowance or it is called as a cost of living allowance. When it comes to dearness allowance, it is in two formats. It can be either in terms of employment or it can be not forming part of your termination benefits. If it is in terms of your employment, it is taxable. If it is not in terms of your employment, still it are still taxable. Both are taxable. What is this classification for? When you get into the exemptions. When you get into exemptions is when you look into it. As of now, dearness allowance is fully taxable. After the dearness allowance comes your bonus. After the dearness allowance comes on your bonus. The provisions in bonus is that bonus is taxable only on receipt basis. It is not taxable on accrual basis. Then comes commission. Commission can be in two formats. It can be a fixed commission or can be a percentage of turnover. If it is fixed commission, it is taxable. If it is commission as a percentage of turnover, it is still taxable. Why the split? Again, exemptions la varum. Again, exemptions la varum. Now is when we start with the exemptions called allowances. Start with the exemptions called allowances. The first exemption in my material is called as leave encashment. In my material, it is called as leave encashment. Leave encashment or the provisions are like this. You have to check for yourself whether you are getting this leave encashment during your employment or post your employment. If you are receiving your encashment during your employment, it is fully taxable. If you are receiving it post your employment, split into two: government employee, non-government employee. Government employee fully exempt. Non-government employee 4 or 3 year 4. Whatever is your leave encashment, you have to claim least of the 4. Claim least of the 4. First one will obviously be actuals. Second one will be a notified limit of 3 lakhs, notified limit of 3 lakhs. Then it will be average salary per month for 10 months. Average salary per month for 10 months. And then the last one will be average salary per month into leave unutilized. Leave unutilized. It is average salary per month into leave unutilized. 2 questions for you. What is average salary? You have to take basic pay plus DA forming part plus commission as a percentage of turnover. Vanducha. So it is basic plus DA forming part plus commission as a percentage of turnover for the last 10 months. For the last 10 months, you will have to check that is as an average salary for the last 10 months. Multiplied by 10, you will get the third one. Multiplied with the leave credit unutilized, you will get the fourth one. Fourth one, it is called as leave credit unutilized. What is leave credit unutilized? Check for the total leaves which you got during your employment. Check for the total leaves which you got during your employment, subject to a maximum of 30 per year. Subject to a maximum of 30 per year. If you get a maximum of 30 per year, great. If you get anything beyond 31, it is restricted to 30. So maximum leaves which you can get is 30 per year. Reduce whatever leaves you have utilized. You reduce whatever leaves you have utilized, you will get the number of days and number of months. Number of days, that has to be multiplied by average salary. So you should need number of months, which means divided by 30. Divided by 30. So it is basically total leaves granted to you during your employment restricted to 30 days per year minus the leaves which you have been utilized, the whole thing divided by 30. The whole thing divided by 30. This is what is called as your leave encashment. This is what is called as your leave encashment. The provision here is that if you exit one employment and then you go to a next employment, the 3 lakhs will keep coming down. The 3 lakhs will keep coming down every time you claim an exemption. Every time you claim an exemption. This is the first exemption called leave encashment. Is it eligible for 115 BSc? Yes. This is a retirement benefit obligation. Therefore, it is eligible for 115 BSc also. You only have to note down if it is not eligible. Confuse manadinga. Only note down if it is not eligible. So leave encashments are eligible for you. Clear up? Yes. Next, going into the next one called HRA. Going into the next one called HRA. HRA meaning meaning ketta full form solringa. Idhaan pa English class. HRA full form is house rent allowance. Meaning is any kind of allowance given you for the purpose of you incurring rent, which means the basic condition is that you should incur rent. Basic condition is that you should incur rent. How does this work is that you will be eligible for least of 3. You will be eligible for least of 3. Actuals HRA received. Second one, 50% of salary or 40% of salary. 50% in case you are in Chennai, Mumbai, Kolkata, Delhi. Chennai, Mumbai, Kolkata, Delhi. It will be 50% of salary. If it is any other place, it will be 40% of salary. Last one is rent paid minus 10% of salary. Salary means basic plus DA forming part plus turnover commission for the respective month. Meaning if there is a month for which you have not paid rent, no HRA for you. For the month which you have paid higher rent, higher HRA for you. Clear? Yes, that is what the provisions are when it comes to HRA. Eligible for 115 BSc. Not eligible for 115 BSc. Meaning if you have an HRA, that will become fully taxable. With me till here? Yes. Next, after HRA comes special allowances. For your exams 3. First is transport allowance for disabled people. Maximum exemption is 3,200 per month. It is maximum 3,200 per month for disabled people. If you are a healthy person, what will happen? Fully taxable. If you are a healthy person, fully taxable. Next comes child education allowance. 100 rupees per month per child for 2 children, provided the education is in India. Third one, child hostel allowance, 300 rupees per month per child. 2 child education should be India. Education should be India. மூணு மட்டும் தான் முக்கியம் எக்ஸாமுக்கு. And the last ones is that if you have any other allowances, look at whether the allowance looks office premises specific. Look at if the allowance looks something related to office. If it relates something to office, exempted provided you spend it. Exempted provided you spend it. Look at it, no? It says daily allowance or per diem allowance. Who will get daily allowance? Office people. Who will get conveyance allowance? Office people. Who will get helper? They will not give you for personal home and all. Yes, who will get helper allowance? For office only. Then research allowance and then uniform allowance. Everything looks office specific, correct? So idella ஞாபகம் வச்சுக்க தேவையில்லை. Examல போயிட்டு if a new allowance comes to you, check on the allowance, look if it is office purposes or not. If it is office purposes, exempt. Amount spent will become exempt. Balance everything will become taxable except for one called as telephone allowances. Except for one called as telephone allowances. When we go to perquisites, we will discuss. And the second thing is called as food allowances. Second thing is called as a food allowances. Any kind of lunch allowance and telephone allowances will become fully taxable. If you want, note it down. If you want, note it down. That has come in exam multiple times. That has come in exams multiple times. We will discuss it when we go to perquisites. But if you want to note it down, note it down. Yes, any kind of lunch allowance and food allowance will become fully taxable. Question to you, are you eligible for 115 PAC? Transport allowance continues to become exempt. Any kind of child education taxable. Any kind of hostel allowance taxable, meaning the child education and hostel allowance will continue to become fully taxable, In the other list also, daily allowance alone has been exempted, everything else becomes fully taxable. Okay, so summarizing it for you, if you go on the top, there is transport allowance. Is transport allowance taxable? No. Transport allowance is not covered under, transport allowance is still covered under 115 BSc, so that continues to be exempt. Education allowance has been removed from 115 BSc, which means in 115 BSc that is taxable. Education allowance is taxable. Then underground allowance, tribal allowance, personal allowance, everything is taxable. Travel allowance is also taxable. What is not taxable is daily allowances. Daily allowances alone is not taxable. Conveyance, research, helper, uniform, everything is taxable. Everything is taxable, which means in this, what is exempted from tax is only the transport allowance, daily allowance. Transport allowance and daily allowance. Yes or no? Yes, sir. Everything else is already covered under 115 BSc also. These are the only two items which are exempt under 115 BSc. Everything else will become fully taxable for 115 BSc. Clear? Yes. With this, your allowances are also done. And we go back to the format chart where we look into retirement benefits. Starting with gratuity, meaning any kind of amount given for any kind of employee of yours for the long-term service which he has done. This is called as gratuity. When it comes to gratuity, you have to split into two. During employment, post employment. If it is received during employment, fully taxable. If it is received post employment, Shara. If it is received post employment, check for whether you are a government employee or a non-government employee. If you are a government employee, it is exempt. If it is non-government employee, again split into two, covered by POGA, non-POGA. If for those outside people who are thinking what the hell is this POGA and all, it is payment of gratuity. Moonji pakadinga, I am not teaching any bad words and all. Yes, it is covered by POGA and not covered by POGA. If you are covered by POGA, you will have to go to Gratuity Act. And the exemption there is given as least of three. Actual salary received, actual gratuity received 15/26 into salary per month into number of completed years of service or rounded thereof. It is number of completed years of service or rounded thereof. If it is beyond 6 months, it will become next year. It is 15/26 into salary per month into number of completed years of service or rounded thereof. And the last one is 20 lakhs. Salary here means basic plus full DA, basic plus full DA. Coming to the non-POGA cases, you will have to again do 3. First is actuals, next is 1/2 into average salary per month into number of completed years of service, no round off. Number of completed years of service, no round off. Part of the year will be fully ignored. Part of the year will be fully ignored. Here we are discussing about average salary. Therefore, it is salary for last 10 months. What is the salary definition? Basic plus DA forming part plus turnover commission. Where did we learn this? Leave encashment. Same as leave encashment. Basic plus DA forming part plus turnover commission for the last 10 months. For the last 10 months. This is what is your provisions for gratuity. What is your provisions for gratuity? Next is your provisions for pension. Next is your provisions for pension, where they are coming and saying again, pension, will you receive post employment or during employment? Pension will always be received post employment. So they are telling you, do one thing, take your pension and tell me whether it is a monthly pension or if it is a lump sum pension. If it is a monthly, yearly pension or it is a lump sum pension. Basically this is called as a uncommuted pension and commuted pension. Which one is monthly, ma? Uncommuted is monthly. Commuted means lump sum. Commuted means lump sum. Commuted means computed. Commuted means computed. What will you compute? Lump sum only you will compute, correct? So commuted means lump sum. Uncommuted means monthly. In this case, what you will have to do is first take for uncommuted. Uncommuted will become fully taxable. Uncommuted will become fully taxable. Commuted, what you will have to do? Check whether you are receiving gratuity or not. When it comes to pension, again split into government and non-government. Split into government and non-government. Government cases exempt from taxes. Non-government cases split into 2. Are you receiving gratuity? Not receiving gratuity. If you are receiving gratuity, should you give more exemption, less exemption? If you are receiving gratuity, should you receive more exemption, less exemption? Less exemption. Therefore, it is exempt amount equal to 1/3 of your total pension. Exempt amount is 1/3 of your total pension. If you are not receiving gratuity, it is half of your total pension. What does the total pension mean? Whatever is your committed pension divided by the percentage which they have given to you. Whatever is the pension divided by the percentage which they have given to you. Clear? Next two provisions ignored. No VRS, no retrenchment. No VRS, no retrenchment. Nothing is for exam. Nothing is for exam. Last and the most important thing in your salaries chapter with an amendment in mind is PF. Is what? PF. This provision basically comes and says that if you have any kind of PF, then we will do any kind of exemptions for you. Here is where your amendments are there, so I want you to be extra careful. Yes, we have 4 kinds of PF. Statutory Provident Fund, Public Provident Fund, Recognized Provident Fund, Unrecognized Provident Fund. Yes, statutory, public, recognized, unrecognized. If it comes to a statutory provident fund, what you have to do? Employer's contribution, exempt from tax. Employee's contribution, 80C. Employee's contribution, 80C. Interest on employer's contribution, Manangati. Interest on employer's contribution, exempt. Interest on employee's contribution, amendment for the current attempt, you have an taxability. You have an taxability, refer it to as note 4. Refer it to as note 4. Refer it to as note 4. Any kind of withdrawal which you take will become fully exempt. Any kind of withdrawal which you take will become fully exempt. Coming to public provident fund, employer contribution, not even possible. Public la employer cannot contribute. Employee contribution, 80C. Employee contribution, 80C. Interest on employee's contribution, not possible. Interest on employee's contribution, exempt from taxes. Any kind of withdrawal, exempt from taxes. Any kind of withdrawal also exempt from taxes. Coming to the most important provisions called RPF. Called RPF. If it comes to employer contribution, it is exempt up to 12% of salary, subject to, very good, subject to 7.5 lakhs. If the salary, if the contribution is less than 7.5 lakhs, you will get an exempt up to 12% of salary. If it is anything beyond 7.5 lakhs, fully taxable. Anything beyond that, fully taxable. It is referred to as D. It is referred to as D. Yes, it is referred to as D. Any kind of employee's contribution will be 80C. Any kind of employee's contribution will be 80C. Any kind of interest on employer's contribution, whatever is the interest on the beyond 7.5 is fully taxable. Any kind of interest less than the 7.5 will be eligible for an exemption of 9.5% per annum. It is not salary, it is 9.5% per annum, meaning 9.5% of what the bank is giving you. 9.5% of what the bank is giving you. After that comes the withdrawal part. They are coming and telling, boss, if the withdrawal is within 5 years, it is taxable. Beyond 5 years, not taxable. Within 5 years, also not taxable if it is you have been having an ill health, adanale withdrawal. Second, you have been thrown away from the company. Next, you transfer it from one fund to another fund. You transfer it from one fund to another fund. And the last thing is called a URPF. URPF basically comes and says, at the time of contributions, everything is exempt. At the time of contributions, everything is exempt. At the time of withdrawal, one lump sum cost for you. One lump sum cost for you. Employer's contribution will become taxable under salaries. Employee's contribution ignored. Fully ignored. It is fully ignored. Interest on employer's contribution will also be taxable under salaries. Interest on employee's contribution, IFOS. Interest on employee's contribution will become IFOS. Now let's understand the amendments. Two are there. One is called as Part D, one is called as Note D. Sorry, one is called as Part D, next is called as Note 4. One is called as Part D, next is called as Note 4. What does this Part D basically come and say is that if it is an employer's contribution, to RPF, if it is an employer's contribution to RPF, it has to be up to 7.5 lakhs. If it is anything beyond 7.5 lakhs, that excess contribution will become fully taxable, But here is where they did not stop. They came and said, and the 7.5 lakhs ka mela varudhu, interest will also become taxable. Can you help me with the formula? How to compute the interest on the taxable contribution? Does someone know the TC1 plus PC1? People outside. New friends of mine. My new friends, can you help me with the formula? Hey, not a book la varuma. People who have come from outside, can you help me with the formula? Yedo one PC1 plus TC1 into nane marandira. I got the answer somewhere. Taxable contribution is equal to PC1 plus TC1 into R plus PC by 2. Abidana? Adala kadhe thevella. And the koothome thevella. We will do four columns. Simple. What you have to do is left side will be average fund. What is average fund? Opening plus closing by 2. Opening plus closing of what? Provident fund. Opening balance of the fund plus closing balance of the fund divided by 2. Right side will be the total interest earned from the PF. Correct? Total interest earned from the PF. If your fund is fetching you 100 rupees, if the fund is 5 lakh rupees and is fetching you 100 rupees, how much will the fund fetch you if the interest taxable component was 1 lakh rupee? That's all straightforward. Yes. What is the left side? What you have to do is, this also will be average of the contributions taxable. Adanda average. Average of taxable contribution. Basically what you have to do is, male on the top will be opening balance of fund plus closing balance of the fund divided by 2. Right side will be the total interest which has been earned during the year. Bottom left will be what? Bottom left is opening taxable contribution, meaning last year if there was something taxable, plus closing taxable contribution divided by 2. This is where the PC2 by automatically will get classified. Let's for instance assume that the opening balance taxable was 0. If the opening was 0, what would happen? Closing alone will be there. Closing will be nothing but your current year taxable. So current year taxable by 2 will be nothing but by PC by, clear up? It will be nothing but your PC by 2. Other thavara, if you are talking about the opening contributions, what will happen? Opening will be part of the closing also. So opening plus closing divided by 2 will be what? 2 opening divided by 2 is nothing but opening. Straight down mudijirum. Clear up? Yes. So what is the 4-table chart? You have to do the opening balance of fund plus closing balance of fund divided by 2, which will be called as average of the fund. Average of the fund. Right side will be the interest which is earned during the year. Right side will be the interest earned during the year. Left to bottom will be what? Average of the taxable contribution. Average of the taxable contribution. Right side will give you the answer. Right side will give you the answer by doing. That's all. By doing the cross multiplication. What is the logic? What is the story behind it? Later. Fast track. Yes, we will do it in fast track. Clear? Yes. You want to do one sum along with me? Yes, sir. We don't have time. Yes, we have this as a taxable contribution from the employer perspective. Now coming to the amendment for the current year, which is called as an employee's contribution. Coming to the employee's contribution, they have basically come and said that when it is an employee's contribution to statutory provident fund or recognized provident fund, any kind of employee's contribution to statutory provident fund or recognized provident fund, you will be exempted only to the extent of 2.5 lakhs. You will be exempted only to the extent of 2.5 lakhs. Any kind of interest which contribution earns up to 2.5 lakhs will be treated as the normal. Other than that, everything will become fully taxable. This 2.5 will apply a double up if you are not contributing by employer. If there is no contribution by employer, very unlikely to happen. When you have a recognized provident fund and a statutory provident fund, employer has to contribute, which means for your exam purposes, the only contribution is 2.5 lakhs. So if there is a contribution up to 2.5 lakhs by the employee, what will happen? Interest will be either not taxable for statutory provident fund or exempt up to 9.5% for a recognized provident fund. But if it is anything beyond 2.5 lakhs, straightforward taxable. How do you compute? You don't compute, exam will give it to you. Employees Kamato, they have not given any kind of nonsense logic. No nonsense logic for employees contribution. Exam itself will come and directly tell you what is the taxable interest. You have to tax it under the head IFOS. It is employees contribution has to be taxed under the head IFOS. All the way discussing it in salaries, this is a IFOS contribution taxable. If the matter mudinjichu machiko, avladha, we are done with the chapter. Now we are getting into perquisite. Straightforward, simple mudipo, 15 minutes dot. Yes, exactly 15 minutes we are completing perquisite, starting from the first perquisite called as leave travel allowance. It's okay, you don't have to mug up the sequence. That's okay. If you don't have to mug up the sequence, I will give you the provision. Now our heading solra neenga provision sonna porom. Yes, we are going into the first thing called leave travel allowance, meaning any kind of reimbursements which is given by the employer for your travel. Which travel? Official, personal? Personal travels. Any kind of personal travels. Business travels are anyway exempt from taxes. I'm going to Bangalore tomorrow, business purpose only. Don't tax me. Yes, any kind of personal travels will be exempt from taxes. How do you exempt it? Is that you have to first check for whom are you getting exemption for. You can get exemption only for self or family. Ada family da. Self and family. What does self and family mean? Self, spouse, children, subject to restriction of 2. But if the first born was twins, then in that case 3. If the first born was twins, restricted to 2. If the second borns were twins, restricted to 3. Self, spouse along with children, 2 or 3 depending on the scenario and your capability. That's a different story. Yes, it is restricted to that. How does this work? Is that for these people you will get the exemption. How will you get the exemption? Check how you are traveling. If you are traveling by flight, flight la first class kudukranga. There are 2 things in flight: economy class, business class. Exemption granted for economy class. In flight there is only economy class. For cheap people it is train pays. Next thing is for trains. Next thing is for trains. In a train, you will be eligible for first class. In train, you will be eligible for first class. If you're traveling by bus, it will be eligible for first class. Again, for bus, it is first class. If it is any other route, same first class fare. Same first class fare. You're eligible for 2 out of 4 trips. You're eligible for 2 out of 4 calendar years. In calendar years of 4, you are eligible for 2 trips. You are eligible for 2 trips. But if in the first 4 calendar years you have not utilized both the trips, you can carry forward 1 trip to the next calendar year and utilize it. And utilize it in the first year itself. This is what is your leave travel allowances. After that, I will give you the heading. I will give it. Hey, take away. Retirement benefits 115 BSc. They are all retirement benefits. Everything is covered under 115 BSc. Exemption will still continue. Leave travel concession. Not eligible. Leave travel concessions are not eligible for 115 BSc. Everything will become fully taxable for you. Yes or no? Yes. Coming to the next part of the heading called as medical treatment. Coming to the next part of the heading called as medical treatment. Here is where they have come and told us, first tell me whether you are getting the treatment in India or outside India. If you are getting the treatment in India, I will ask you 4 things. I will ask you 4 things. Are you getting the treatment in a government hospital? If yes, exempt. If not, I will ask you whether you are getting it for a specified disease. If yes, exempt. Last thing is, are you getting into the employer's hospital? If yes, exempt. If nothing happens, taxable. If nothing happens, fully taxable. If you are getting a treatment outside India, then I will come and tell you that you can travel along with 1 attendant. You can travel along with 1 attendant, and the expenditure can be for self or with family. Self or family. Family here means spouse, children, dependent parents and dependent grandparents. Is grandparents there? No, it's not there. It is dependent parents along with siblings. Dependent parents along with siblings. Spouse, children, restricted to? No restriction. A child once in a while only will fall ill. Okay, you cannot decide which child you want to prefer and which child you don't want to prefer. You cannot do that. Yes, so it is self, spouse, child, dependent parents and siblings. Dependent parents and siblings. If you are traveling outside India, you can take along with yourself 1 attendant. If you are taking along self 1 attendant, any kind of treatment and stay will be allowed up to RBI exemption. Any kind of travel cost will be exempted provided your total GTI is less than 2 lakhs. If it is more than 2 lakhs, யாருக்கு தான் GTI கம்மியா இருக்கும் தெரியல. Whom are you going to send for 2 lakhs less than GTI? Anyway, is this medical treatment 115 BSc? Allowed. It is fully allowed. There is no problem in 115 BSc for medical treatment. Hey, these are all good causes, ma. Don't exempt all this. Don't tax all this. Yes. Next thing is called as an RFA. Next thing is called as an RFA. Here is where they are basically coming and saying, I will not give you any kind of allowance for your rent. I will instead give you the house itself. RFA works in 2 models. You can either get a furnished accommodation or an unfurnished accommodation. Let's discuss the unfurnished part. If you are getting an unfurnished accommodation, you have to split into 2. Government, non-government. Government exempt. Government will become taxable up to license fee. Government will become taxable up to license fee which the government decides. Government will decide their own taxes. Yes, license fee which is determined by the government. If it is a non-government employee, then what you have to do is check whether it is the house owned by the employer or hired by the employer. If it is hired by the employer, you will do actual hire charges or 15% of salary, whichever is lower. Whichever is lower. It is not higher, it is whichever is lower. If it is a house which is owned by the employer, it is population specific. For your exam, the only population relevant is 15%. The only population which is relevant is 15%. Most of the questions in exam will come for Chennai, Delhi, Mumbai, yes, every place and all will be more population only. No 7.5, no 10 direct. 20. That's population. Don't remember population, directly tax 15%. Directly tax 15%. So there it is. If it is hired by the employer, it is actual rent charges or 15%, whichever is lower. If it is owned by the employer, it is directly 15% of the salary. 15% of salary. Salary means basic plus DA, forming part plus bonus plus commission. Which commission? All commissions, both the commissions plus all taxable allowances. Meaning what is not covered is your retirement benefits. What is not covered is your retirement benefits. What is not covered is your other perquisites. What is not covered is your DA not forming part. Yes, sir. You want to remember exclusive or you want to remember inclusive? Inclusive. Let's remember inclusive. It is basic plus DA forming part plus all commission plus bonus plus all taxable allowances. Next thing is if you receive a furnished accommodation. If you receive a furnished accommodation, for furniture they will ask you two questions, whether it is hired or owned. If it is owned, 10% of cost of the asset. It is not 10% of salary, it is 10% of the cost of the asset. If it is hired, directly higher charges. Understand, higher RFA alone has whichever is lower. After that, going forward, whichever provision you read will only have the actual higher charges. Will only have the actual higher charges. Clear? Clear? Yes, this is what the provisions are when it comes to RFA. No notes and all is required. Everything else is irrelevant for you. Yes, coming to the hotel accommodation, they are basically coming and saying if you receive any kind of hotel accommodation from the employer, it is actual higher charges. Can someone own a hotel? It is actual higher charges, because if someone was owning a hotel, that is a house. Did we not learn it in house property? Someone owning a house is someone owning a hotel is also as good as a house. So that will basically mean house owned by the employer. Hotel accommodations are only those scenarios where you are not owning a hotel, but you are directly going to some other hotel and you are giving any kind of charges. Therefore, there will not be a concept called owned by the employer. There will only be a concept of hired by the employer. The concept is that if you are hiring any kind of hotel accommodation for your employee, in that case it will be actual higher charges, or 24% of salary, whichever is lower. Salary here means same as RFA. With the hotel accommodation getting over, question to you, is there any kind of 115 BSc involvement here? Why no? We are not discussing about exemptions, we are discussing about taxability. 115 BSc kicks in only when it is about exemptions. We are into perquisites. Perquisites only talk about taxability, does not talk about exemptions. Yes, coming to the next part of the perquisites, called as a loan, given as a loan. Basically what they are coming and saying is any kind of loan which is given by the employer to the employee will be checked for the interest. Benchmark standard for you is SBI interest. Check for the SBI interest. If the SBI interest is more, you will get a perquisite. If the SBI interest is less, will you get losses? No, it is not losses. Perquisites only come into picture when you get any kind of benefit. If you are receiving any kind of losses, it is your loss, you take care. You will take care. Government will not give you any kind of benefit on this. Yes, so concessional loan basically comes and says whatever is the SBI interest rate as on the first day of the previous year, SBI interest rate as on the first day of the previous year, less the interest which is received by the employer, will be multiplied by the loan outstanding as on the last day of each month. That will be treated as your taxable perquisite. No taxability if the loan is less than 20,000 rupees. No taxability if the loan is given for a disease. Do you have 115 BSc? This is for taxability, not for this. Next thing is called food coupons. Here is where I will clarify to you. Any kind of food allowance and a lunch allowance becomes fully taxable. Any kind of food coupons will become exempted up to 50 per meal. Any kind of food coupons will become 50 per meal exemption. But yes, if you give any kind of alcohol, fully taxable. Any kind of beverages, tea, coffee, any kind of beverages exempt. You travel any outside place because of the employer and there you get food, exempt. Traveling to a remote location and getting food items will also become exempt from taxes. Here is where 115 BSc kicks in and comes and says food coupons will also become taxable under 115 BSc. So the food coupons which is exempt under this will become taxable under 115 BSc. That is one provision to remember under 115 BSc also. Yes, sir. Any kind of food coupons which is granted to you will become fully taxable under section 115 BSc. Coming to the gift part of it, here is where you are getting a gift from employer. Split into two. Cash, kind. Cash vanda taxable, kind vanda There are two ways to do an exam. You can claim exemption up to 5,000 and tax balance, or if it goes beyond 5,000, fully becomes taxable. My preference personally to tax everything. The reason is very simple, because the same provision is there in IFOS. Here, if you remember something else, there you remember something else. You can make a mistake here, you cannot make a mistake there. Don't take the chance. Yes, the provision is very simple. If the gift is beyond 5,000 rupees, fully taxable. Gift is less than 5,000 rupees, nothing is taxable. That's all. That is what the provisions are. That is how you have to remember for your exams. You want to remember something else, your choice. Just don't spoil IFOS. That's all I will say. Yes, this is what your gift provisions are. Next, coming to ESOP and all straightforward cases, they're basically coming and saying whatever is the market value of the shares less whatever is the amount which you recover will become fully taxable. Mudinju pochu. Next one, transfer of movable property. Why are we not discussing transfer of immovable property? It will be taxed under capital gains. We are discussing about transfer of movable properties. You have to split into three. First one, computers and electronics. If you receive any kind of computers and electronics on account of transfer, what you have to do is you have to do cost minus 50% depreciation WDV for completed years. Part of the days will become ignored. Next, any kind of motor car, not motorcycle. Motorcycle will come in the last. Motor cars, if you receive any kind of motor cars, cost minus 20% depreciation WDV for completed years. Last case is where cost minus 10% depreciation SLM method, 10% depreciation, SLM method, completed years of service is what you will have to consider. Yes, then you have to get into use. Ella useless now. Then you have to get into use. Again, split into three. First one is use of electronics. Generally used for business purposes, therefore fully exempt from taxes. Then use of next chapter. Next topic. And the last one is any kind of use of any other movable properties. 10% of the cost if it is 10% of the cost if it is owned, actual hire charges if it is hired. Coming to the motor cars, you have to split into 4. Fourth is not a benefit. Fine. The first three is not coming. For example, yes, use of motor car has to be split into 3. Fully official, fully personal, partly official, partly personal. If it is fully official, exempt. If it is fully personal, check whether it is owned or hired. If it is hired, higher charges. If it is owned, 10% of the cost of the car. Add your repairs and maintenance, add your running and maintenance, recover any kind of money which is taken back. Not coming for exams. Last and the most important thing which is coming for exam is partly official and partly personal. Adula 4 irukku. Marathon. There is 4 in that. You have to check who is owning the asset and check who is giving the repairs and maintenance. If the employer is owning the car and the employer is giving the repairs and maintenance, you will have to split into 1600 cc or more than 1600 cc. Less than 1600 cc will become 1800 per month. Beyond 1600 cc will become 2400 per month. Beyond 1600 become 2400 per month. If the employer is owning the car, and the employee is incurring the repairs and maintenance, in that case it will become 600 and 900. If the employee is owning the car and the employer is giving repairs and maintenance, take the repairs and maintenance and tax it fully. From that you will reduce 1800 or 2400. Depending on the CC. And the last one is if employee is owning the car, employee is maintaining the car, where is the benefit? No benefit at all. With this, your last provision for the chapter is called education facilities. The provision basically comes and says that if you are doing any kind of education for the employee, it is fully exempt. If you are doing the education for the family of the employee, then in that case you have to split into 2, whether it is done for children or for others. If it is done for children, they will ask you one question: tell me where is the education happening. If the education is happening in the employer's own school, If the education is happening in employer's own school, then they will ask you one more question. Check whether the cost is less than 1000. Which hospital? Which school will have 1000 less than cost? Anyway, check for the similar cost of education. If the cost is less than 1000, it becomes exempt. If not, it is fully taxable. If not, it is fully taxable. And the next thing is they are coming and saying if you are doing for anyone other than self or children, then in that case, whatever is the cost which you have incurred for normal others, that will become the perquisite for you here also. That will become the perquisite for you here also. Transport facilities is not relevant for exam. Perquisite is exempted. The only thing which you have to remember is this one. Reimbursement of telephones and mobiles. Reimbursement of telephones and mobiles is what you will have to remember. The second one we already discussed when we did residential status. Yes sir, any kind of allowance and perquisites given to embassy people will be exempted from taxes. That is point number B. Everything else is not relevant for your exam. And the last provision is your deductions. Last provisions is your deductions, where basically they are coming and saying that whatever salary you have will be allowed for a standard deduction of 50,000 rupees. This is a silent adjustment, mandatory to be given, provided the question does not say it is computed. If the question says income from salary, that means it is computed. If the question says salary computed, it means it is computed. If the question just like that says that the salary is 10,000 per month, if the salary is 10,000 per month, obviously 10,000 will not have standard deduction inside it. So you have to do 10,000 into 12 minus standard deduction. This is one place where everyone is missing out very badly. This is one place which is missing out very badly. People are avoiding to give standard deduction because they lose it in their exams. I just saw the suggested answers of May also. In the suggested answers of May, the comments that they have given, that almost 60% of the students failed to give standard deduction in salaries and therefore ended up with the wrong rates of taxes. Don't make that mistake. Yes, question 11, when you see salaries, first question you should ask yourself is it computed or not computed? If it is computed, you will leave it off. If it is computed, you will leave it off. If it is not computed or in the form of a monthly number, it will be allowed for a standard deduction of 50,000. Will be allowed for a standard deduction of 50,000. Second one is called as a professional tax. They're basically coming and saying that if the employer gives any kind of professional tax, tax it as perquisite, allow it as a deduction. If the employee is directly paying professional tax, directly allow it as a deduction. Directly allow it as a deduction. And the last thing is called as an entertainment allowance. Government only government are allowed to do entertainment. We are allowed to study. That's all. Yes. The last person which is there is called as an entertainment allowance, allowed only for government, allowed only for government employees, where they are coming and saying actual entertainment allowance 1/5 of the basic pay, 1/5 of the basic pay or 5,000 rupees, whichever is lower. கொடுத்த போது கூட allowance 5000 ரூபாய் தான் கொடுத்தான். Is not taxable is what they have given to you. Clarificatory here, the whole section 16, standard deduction, professional tax, entertainment allowance, none of them are eligible under 115 BSc. None of them are eligible under 115 BSc. Last provision is called as relief under 89, has never come in exam, will never come in exam. Has never come in exam, will never come in exam. The provision is basically coming and saying that if you have received salary for old years, if you have received salary for old years in the current year, in that case what you can do is you can compute the salary for old year, compute the salary for the new year, add this number in both the things. Yes, first to compute salary standalone for old year, salary for current year standalone, salary for current year standalone, then add this arrears in the last year salary, add the arrears in the current year salary, compare both, adhigama inda, give the deduction. That's all. Munju pochu. Never has come in exam, will never come in exam also. Clear? Yes, we're done with 9:34 because we did one extra illustration in middle. We did one extra illustration in middle. In your material, the salaries order definition has been given as a summary also. We have given the definition of salaries as a summary also. These are your salary definition summaries. This is what you have to remember for your exams also. Yes. Let's cut for a break and we will be back by we will be back by 10:05. Dot 10:05. Yes, go ahead. Settled, everyone?
மெட்டீரியல் போட முடியுமா? போடுறியா?
நான் போடணுமா?
அந்த அங்கே இருக்கான்.
சங்கீதம் மேம் காமிச்சிருக்கேன்ல. நல்லா கூகுள் டிரைவோட ஆக்சஸ் பண்ணிட்டு அதுக்கு வீடியோ டவுன்லோட் பண்ணலாம். Shall we? Yes, everyone, shall we? Yes, sir. Heavy சாப்பிட்டீங்க, தூங்க போறீங்களா? Since everyone has had their food, Since everyone has had their food, I would expect that everyone shouts on the top of their voice right now. Yes, sir. Varna, you are going to sleep. Okay. If I find someone sleeping, I will sleep off. And I can stand and sleep, I can guarantee you that. You cannot see another person, I can stand and also sleep. If you see me sleeping, gone for a class today. Yes, I want you to use up all your energy because the next batch is coming on 1. The next break is coming on 1. Yes, so you have a good amount of time, 2.5 hours, 3 hours. Sorry, whatever it is. Yes, I want everyone to be on the top of their voice because after this everything is easy. Yes, salary was the only complicated part which I felt personally. Apart from that, everything is quite easy. We'll shout on the top of our voice and we'll clear everything off. Clear? Pass agringla? Yes, sir. Yes. Let's start with that thought. Yes, let's start with that thought. We are into the second head of income called HP. We are in the second head of income called income from house property. The chapter very simply comes and says that any kind of annual value of the house property which you have will be taxable under this head. At the same time, they have clarified to you that boss, if the property is something which is used for your business or profession, it is not taxable under this head because it will be covered under PGBP. It will be covered under PGBP for you. Anything which is not a business part is only what is taxable under this head. It's taxable under this head. At the same time, there should be a house. There should be a house, meaning there should be a land and a building. Land and a building attached there too. If it is something which is a pure land without any other thing, it will be taxable under the head. The rent will be taxable under IFOS or PGBP depending on what is your nature of business. Having that said, we'll have to go into the next part of the chapter where we'll try to understand what is the meaning of this definition. It basically comes and says, annual value of an house property of which the assessee is the owner, which means the ownership is most important in this because if it is a subletting concept, that will be not taxable. If it's a subletting thing, it will be taxable under the head PGBP or IFOS depending on the nature of income, except for one exception where they have come and clarified that if someone has taken the lease of this property for more than 12 years, then the second person will also be deemed to be the owner of the property, in which case it will become taxable under this head. Other than that, it is always taxable under PGBP or IFOS. Apart from that, you have two more deemed ownership concepts which you have to remember for this exam. Basically, it's first one, transfer of your property to your spouse. Transfer of your property to your spouse with an intention to inadequate consideration. With an inadequate consideration. If you do it with an inadequate consideration, then in that case, it will be taxable under. Yeah. So what will happen is you will be deemed as the owner. Who will be deemed as the owner? The original transferor will be deemed as the owner. We are not discussing what will happen to the income. We are discussing what will happen to the property. Why are we not discussing the income and not the property? We will go to clubbing and we'll understand. As of now, just understand that if you transfer your property, which property? House property. If you transfer your house property to your spouse for inadequate consideration, in which case what will happen? The transferor will be the deemed owner of the property, except in a scenario where it's a divorce. Basically, if there is an agreement to live apart and the house property has gone as a form of alimony, in that case, it will not be taxable under the transferor hand, it will be taxable in the transferee's hand. Suppose if you do not give it to your spouse, you can give it to your minor child. Never give it to your major child. If you give it to your major child, Bhagban only today. Bhagban only today, he will throw you out of the house, he will live in the house tomorrow. Yes, never give it to your major child, always give it to your minor child. If you give it to your minor child, transferor will continue to become the deemed owner. Transferor will continue to become the deemed owner, except in a scenario where you give it to your minor married daughter because she's going to transfer to another house. She's going to transfer to another house, so therefore don't give it to her. Again, it become a problem for you. But yes, if you give it to your minor married daughter, it will be covered under clubbing provisions. It will be covered under clubbing provisions. These are the two deemed ownership concepts which you have to remember for your exam. Other than that, nothing else is important. Yes, having said that, now we have understood what is a house, what is a owner, what is a taxability, with which we have to go into what are the classifications of your houses. We have to classify our houses into two. Let out property, self-occupied property. When it comes to let out property, it will always be taxable under this head. But when it comes to self-occupied property, you have to again split it into two. SOP and DLOP. How does this work is that basically they are coming and saying if you have a house property, you can maximum have up to two house properties at the option of assessee. At the option of the assessee. At the option of the assessee, any two house properties will be treated as your SOP house. Balance everything will go under deemed let out property, where it will be assumed that you have taken the rent from yourself. It will be assumed that you have taken the rent from yourself. Same logic which I told you. Every chapter will have its own format. Every chapter will have its own format. Keeping that format stagnant, we are going into the three tables, which is SOP, DLOP and LOP. SOP, DLOP and LOP. When it comes to an SOP property, annual value is always 0. Annual value is always 0. The only thing which you can claim from that property is interest on housing loan. Interest on housing loan, which means SOP at any given point of time can either be 0 or a loss. True or false? It can either be 0 or it can be a loss. It can never be a profit. Correct or not? Yes. When it comes to DLOP, what will happen is you will take the expected rent directly as your GAV, but when it comes to your actual let out property, you can consider the actual rent also. How does the format work is that you have to start from municipal rent or fair rent, whichever is higher, compared with standard rent, whichever is lower. That will be called as your expected rent. That expected rent will be compared with your actual rent, ignoring vacancy loss. Actual rent, ignoring vacancy loss, but claiming unrealized rent. Actual rent, ignoring vacancy loss, but claiming your unrealized rent. That will be compared with your expected rent, whichever is higher, which will give you the answer called as GAV. Which will give you the answer called as GAV. But when you get a GAV, if your actual rent ignoring vacancy was higher than your expected, you will also get something called as a vacancy loss. You will also get something called as a vacancy loss, which basically means that if you are genuinely trying to give additional income to the government, but because of vacancy alone you were not able to do it, government will let you claim the vacancy loss. But unfortunately, if the expected rent ends up becoming higher than your actual rent, you will have to pay tax on the full expected rent, ignoring your vacancy. Ignoring your vacancy. This is what the provisions are. After you arrive at that, you will arrive at your GAV, reduce your municipal taxes actually paid during the year by the owner. Actually paid during the year by the owner, in which case you will get something called as an NAV. In which case you will get something called as an NAV. From the NAV, you will directly allow 30% as a standard deduction. This 30% is same as your 50,000. This 30% is same as your 50,000. There you are allowing 50,000. Here you have to allow 30%. Same logic. If the house property is given as computed, you will leave it go. If the house property is given as rent per month, you have to allow for 30% also as a standard deduction. After which you will allow for the second item called as interest on loan. After that you will allow something called as an interest on loan. But in the middle of this, what you have to do is you have to add your unrealized rent or your arrears of rent and claim another 30% on that also. Claim another 30% on that also. This whole format will give you the taxability called as income from house property. Income from house property. What are these? Municipal rent means that rent which is given by the municipal authorities. That rent which is given by the municipal authority. This is the rent on which the municipal tax is also computed. Which means whenever they give you a percentage for municipal tax, it is percentage of municipal value. It is not a percentage of the actual rent, or it is not the percentage of GAV. It is percentage of the municipal value. Fair rent is the rent which is generally given in the market. Fair rent is the rent which is generally given in the market. Standard rent is the rent which is decided by the Rent Control Act. And then when you go to actual rent, you have to do actual rent minus unrealized rent. Actual rent minus unrealized rent, provided the conditions are satisfied. Provided the conditions are satisfied. What are the conditions to be satisfied? First of all, you should have one reasonability that you have
exited that person. First step, what will you do? If someone is not paying you rent, what you should do? You have to first go and ask him for rent. If he does not give you the rent, you should try to vacate the property. If he is not ready, he is muscular more than you, he is like me, and the all is like gym builder body, what will you do? You will at least try. Either you should vacate the property or you should at least try to get the property vacated. Let's say the person vacates the property, what you should do? Don't come in and say leave from house A, go to house B. If you're leaving from house A, go permanently out. Anyway, he's not going to pay rent. Why will you move it from A to B? Yes, sir. So they basically gave you 4 conditions. Condition number 1 is that it should be a bona fide tenancy. Second is that you should have tried your steps to recover the rent. If you have not tried, third step is you have to take a reasonable step to throw him out or at least try to get him out. And if you have already got him out, you should ensure that the other person should not take another property. If you satisfy all these conditions, unrealized rent will be reduced from your actual rent in the current year, and will become taxable in the year in which the rent is received. Should you be the owner in that year? Ownership is not important. You can become taxable that year even if the ownership is not there. The only thing which you will allow from that is 30% of your standard deduction. 30% of your standard deduction. This part of the chapter will call you about the vacancy loss, where if your expected rent ends up being higher than your actual rent, then in that case the whole expected rent will become taxable. But if the actual rent ignoring the vacancy is higher than your expected rent, you can claim the vacancy loss. Coming to the next part of the format, which is your municipal taxes. The provisions are like this. You have to have the tax paid in the current year. It can either be the tax of the current year or it can be the tax of past years also or the future years also. Whatever you pay in the current year will be allowed in the current year. That's all it is, the concept. Yes. And the second thing is that it should be paid by the owner. If the tenant pays it, what will happen? If it is paid by the tenant, check whether you are getting it reimbursed or not. If you are getting it reimbursed, then you can claim it. If you are not getting reimbursed, you will go and ask the tenant what is he doing with that property. If the tenant is coming and saying that I am using the property for personal purpose, lost. If he tells that he is using it for business purpose, he will go to PGBP and claim it under 43B. He will claim it under 43B. Municipal taxes is a form of tax, has to be paid within the due date of filing the return of income. If he claims it within the due date, if he pays within the due date of filing of return of income, he will get the deduction in the current year. If not, he will get it in the year in which he makes the payment. That is what the format is. See the chart. Whenever it comes to municipal taxes, you have to ask yourself what is happening with the property. If the property is used for business purpose, by whom? By the owner. Then in that case, owner itself will call under PGBP. There is no HP coming in. If the owner is using it for self-occupation, what should you do? You have to zero. It will become fully zero because your annual value itself is zero. But if the property becomes DLOP, then you can claim the deduction. What happens is, if the property is let out, then in that case what you'll have to do is you'll have to go and check whether who's paying the tax. If the tax is paid by the owner, then in that case the owner will get the deduction. If the tax is paid by the tenant, check whether the tenant is using it for business or personal. If he is using it for personal, lost for both. If he is using it for business, in that case it will be taxable under, it will be covered as per 43B. Clear? So the first 43B item which we have discussed till now is taxes. There are 6 more items we will discuss as we go forward. Yes, the first item is taxes. With that, municipal tax gets over and you start with NAV. NAV Kapro comes 30% of NAV, and then comes interest on loan. This is the most important thing in this chapter, and so you have to remember this extremely well. Interest on loan basically happens in two format. You have to ask yourself whether the property is an SOP property or an let out property. When you say let out, DLOP also gets covered. If the property is an let out property or a deemed LOP property, what will you do? Full interest is allowable. No restrictions, no conditions. When it comes to an SOP property is where you have a challenge. They have told that you have to satisfy 4 conditions. You satisfy the 4 conditions, that property you will get 2 lakh. You don't satisfy that 4 conditions, that property you will get 30,000. Why is it showing 3 here? There is a 4th condition, I will tell you. There are only 3 here which is relevant for exam purposes. Yes. So what are the 3 conditions? First is that the loan should be taken after April 1999. should be taken after April 1999. If the loan is taken anything before April 1999, it will be 30,000. Loan should be taken after April 1999. Condition number 1. Condition number 2. Loan should be taken for construction or purchase. Should be taken for construction or purchase. If it is taken for construction and purchase, you will stick here. If it is not directly 30,000. What else can you take a loan for? Repairs and renovation. Can you take a loan for paying taxes? You have taken a loan for paying municipal tax. Are you eligible for the interest? No. You have taken a loan for repaying the old loan. That is eligible. You have taken a loan for repaying the old interest. Not eligible. It should be a loan taken for the purpose of the house. It can either be for the purpose of the house or for repaying the loan for the house. Yes sir, these are the only loans which are permitted for you. Either the interest is eligible for you as a deduction. So 2 conditions. Condition number 1 is that it should be for after 1999. Second condition, should be for a purpose of purchase or construction. Third condition is after you have taken the loan, house should be done within a period of 5 years. Satisfy all the 3, you will get 2 lakhs per person per house per annum. Per person per house per annum. Do not satisfy, it is 30,000 per person per house per annum. But since you have 2 SOPs with you, together also you cannot claim more than 2 lakh rupees. So therefore for the full year also you can only claim 2 lakhs. So it is not just 2 lakhs per person per house per annum, it is 2 lakhs per person per annum. 2 lakhs per person per annum. 30,000 you have to go individually. 30,000 you have to go individually. With this provision coming in mind, the first thing which you have to keep as a checkpoint is that this deduction of interest starts only from the year in which the house is ready. Starts only from the year in which the house is ready. The moment you complete the house, that day the HP will start. That day the HP will start. Before that the HP cannot start. But if the house was ready for even one day in that year is fully considered. If the house was ready for even one day in that year, the house is fully considered. Meaning, let's say you took a loan. Let's say you took a loan and the loan was taken before you started the house itself. Loan was taken before you started the house. Say for example, you took the loan in 2016. When did you take the loan? 16. I don't know if green pen will work, but let's try. You took the loan in 2016. Yes sir. After you took the loan in 2016, you were keeping the loan and you were paying the money. Paying what money? Interest money. You are paying the interest money. In 2019 September, the house became ready. In 2019 September, the house became ready. Question to you is, if the house was ready in September 19, will the HP start from September 19 or will start from April 19? It will start from April 19 itself, which means current year full interest can be claimed. Current year full interest can be claimed. Appa, what happens to the 2016 to 2016 to March 2019. What will you do with this? This is called as a pre-construction interest. Very good. This is called as a pre-construction interest. This is the interest which what you will do is you will take the full interest from the date on which you started the loan till the date on which the last year of the previous year, last day of the previous year, compute the total interest divided by 5 and you will add it to your current year interest. I am not saying you will claim it. Understand, there is a difference. You will add it to your current year interest. After that you will check for the 2,30,000, which means the interest which you can claim in the current year is 2 lakhs including pre-construction interest. Including pre-construction interest. With me till here? Yes, this is how the example looks like. Let's say you have taken a loan of 25 lakhs at the rate of 10% per annum on 1st October 2018 for constructing the house property. Construction was completed on 30th June 2020. Hey, question wait pandra. We are completing the construction on 30th June 2021, which means the property is ready from previous year 21-22. The property is assumed to be ready from April 21. The property is assumed to be ready from 1st April 21. Upon the pre-construction period will be called as from the date to date. From date to date. It will be starting from October 18 to 31st March of 21. It will be starting from October 18 to 31st March of 21. Yes. So how many months will that come to? That comes to around 30 months. That comes to around 30 months. You will compute the interest for those 30 months and you will find that the interest is coming somewhere around 6.25 lakhs. The interest is coming somewhere around 6.25 lakhs. This 6.25 lakhs will be divided by 5. Will be divided by 5. Comes to around 1.25 lakhs. comes to around 1.25 lakhs. This 1.25 lakhs will be added to your current year interest. What is the current year interest? What is the current year interest? It is 25 lakhs. It is 25 lakhs into 10% into 12 by 12. We'll do that. Just giving an example. The point is very simple, that the interest which you're talking about will be for the full financial year. The interest will be for the full financial year, but here what has happened is, fortunately, the loan is repaid on 30th October, which means the interest stopped for you here. Yes, for the current year, will you start from June, or will you start from April? Start from April. So April, May, June, July, August, September, October, 6 months. So what will you do? Into 6 by 12. April, May, June, July, August, September. என்னடா பிரச்சனை? சரி. For some reason I only know tax. Yes, so it is for 7 months. I am assuming it is right. I don't know. நீங்க book பாத்துக்கோங்க, bookல கரெக்ட்டா இருக்கு. Okay, assuming it is 7 months, what will happen is, this is the interest which you will have for the current year. This is the interest which you will have for the current year. The current year interest comes to around 1,45,833. In that 1,45,833, you will include the interest of pre-construction, which is 1,25,000. Comes to the total of 2 lakh. This is an SOP or LOP? Not given. If it was an LOP property, full 2,70,000 will claim. Full 2,70,000 will claim. If it is an SOP property, you will check for the 30,000 and 2 lakh limit. Here everything is satisfied. Loan was taken after 1999. Loan was taken for construction. Property completed in 5 years. Therefore, all conditions satisfied. 2 lakhs is what you can claim. In HP, very good. You have another section called 80EE and EE. You have another section called 80EE and EE. If you satisfy those conditions under Chapter 6A, you can claim another 50,000 or 1,50,000. You will claim another 50,000 or 1,50,000. When did you take the property, pa? You took the property in 18. It is neither falling under 80EE or EE. EE talks about 16, 17. EE talks about 19 and later. The property unfortunately took on the wrong day, and therefore no interest eligible for you. Only maximum interest you can claim is 2 lakh rupees. What happens to the balance? Ignored. Exhausted. It will become ignored. It will be fully ignored. This is what is the conditions for your interest on house property. With this, your chapter is kind of done. Now we have some special scenarios. Special scenario number 1 is what we already discussed, called as arrears of rent and unrealized rent. Second special scenario, what we have to discuss is about a joint ownership. Basically, two people coming together and having one property. What will you do in this scenario? The whole HP will be computed till NAV. NAV will be split into two people. Basis ownership shares, on the basis of their ownership share, and then you will allow for interest of 2,30,000 per house per owner. If that interest on that property was 4 lakh rupees, each owner will get 2 lakhs. It is not that the house is having 2 lakhs, it is that the owner is having 2 lakhs. That is what I told. It is 2 lakhs per owner per annum. This is the first concept, called as a joint ownership. Second concept is called as partly SOP and partly LOP. This partly SOP and partly LOP, you have to understand what part SOP and part LOP are we discussing. Are we discussing about the same property having a part SOP and part LOP together, or are we discussing about full year length, half SOP and half LOP? There are two different scenarios. Scenario number 1 is that there is one property. First floor is SOP, second floor is LOP. This is a scenario where you have to split the house. Assume the LOP separate, assume the SOP separate, compute GAV for SOP separate, compute GAV for LOP separate. Every kind of common expenditure will be split. The interest which pertains to the SOP part of the house will be claimed for 2 lakhs. LOP property will be fully allowed as deduction. But if you take a property If you take a property which is part SOP and part LOP during the year, which means in the same year one property half SOP half LOP, in that case what will happen is you will assume that the full property was LOP. You will assume that the full property was let out and the expected rent will be compared with the actual rent for the full year. Will be compared with the actual rent for the full year. It will not be compared with the actual rent ignoring vacancy and all. It will be compared with the actual rent for the full year because there was no vacancy here. There was a use of the property. There was a use of the property. The property was used for self. It was not for an SOP. And therefore, what will you do is you will compare that with the actual rent for the actual period. You will compare that with the actual rent for the actual period. Even though expected rent is for 12 months, actual rent is only for the respective period. That's your loss. You cannot help it. That's your loss. You cannot help it. That's why I generally suggest people to never have a property which is used for SOP and LOP together. Never do it. In income tax regime, we will never agree to that kind of regimes because that is very risky for you. Clear? Yes, with that your chapter is done. With that your chapter is done. There is something called a composite rent, has never been tested in exam also, never coming in exam also. Just to give you a simple background, composite rent basically comes and says a case where you have taken a house property along with some accommodation. Along with some accommodation. If you can split the accommodation, then in that case house will be in HP and others will be in somewhere else. Cannot split, everything goes to somewhere else. Never they do that. Every time they want it in HP only, IFOS is way easier. Yes, no? Ilya. IFOS is way easier, so they will never do that kind of split. Yes, so composite rent is never coming for your exam. The last provision is called your loss on house property. Loss on house property, understand when we are in losses chapter, it works in it works in this fashion. First you have to check for intra-head, then you have to check for inter-head, then you have to check for carry forward, then you have to check for carry forward. Rule is very simple. When you are carrying forward a loss, it will only be set off against the same head. When you carry forward a loss, it will only be set off against the same head except for unabsorbed depreciation, except for unabsorbed depreciation, everything else will be set off against the same head. So now we are into losses of house property. In losses of house property, they are basically coming and saying any kind of loss from house property can be set off against an income from house property, no conditions. Any kind of loss from house property can be set off against income from house property without any conditions. Any kind of losses of house property which was not set off with the income from house property can be set off against other heads. Can be set off against other heads, but the restriction is that in the current year you can only set off 2 lakhs. In the current year you can only set off 2 lakhs. If that condition does not get satisfied, you will carry forward for a period of 8 years and set off only against HP. Only against HP. You cannot set off against any other heads and carry forward, and the period is 8 years. Return filing on time is not mandatory. Return filing on time is not mandatory. Return filing is mandatory. Return filing is mandatory. Return filing on time is not mandatory. Even if you file a late return, they will still give you the kind of deduction. Now that we are into HP chapter closure, we have to also discuss 115 BAC. In 115 BAC, they have simply come and said one thing, that the interest on loan which you have, have to be split into 2. If it is the SOP interest on loan, 115 BAC, no deduction. Any kind of interest on loan which pertains to SOP property will not be allowed as a deduction under 115 BAC, which means under the 115 BAC regime, SOP will always be 0. True or false? True. Because there was only one deduction which you could claim, that was interest on loan. That also has been taken away, which means SOP will always be 0. SOP will always be 0. Second thing which they have told in 115 BAC is that any kind of loss which you have from house property cannot be set off against other heads. Cannot be set off against other heads, which means on the loss from house property, the second part irukala, against income of other heads subject to 2 lakhs. Anga vandittu you have to take a note saying that 115 BAC ka this is not applicable. 115 BAC ka this is not applicable. Yes, 2 provisions for HP under 115 BAC. First provision is that interest on SOP house will not be allowed as a deduction. Second is that any kind of losses from a house property can only be set off against house property and not against any other heads of income. With this, HP is also swaha. Doubts? Any? Yes. Pre-construction. This is how the pre-construction interest looks like. Yes. Look at the provision. It comes and says Vanshika is a person who has a house property. She's taken a loan for that house property. When she did take the loan? 2018. She took the house loan on 2018. After that, what happened is she completed the construction on 30 June 2021. She completed the construction on 30 June 2021, which means until last year was the property ready? No, the property was not ready. So what will happen is from 1st October 2018 to 31st March of 21. 31st March of 21, previous year. Yes, it will be assumed that you are having a pre-construction period. You will assume that you have a pre-construction period that you will multiply and find the interest. The interest comes to around 6.25 lakhs. That will be treated as your pre-construction interest. Has to be divided by 5. Has to be divided by 5. If you divide it by 5, whatever is the interest amount you get, that has to be allowed over a period of 5 years. How will you allow? You will add it to your current year interest. You will add it to your current year interest, and then you will check for the 2 lakhs or 30,000 limits. Clear? This is how the pre-construction works. Look at the provisions, you will understand. Done? Done? Yes. We are into my favorite chapter. Shall we? We are into my favorite chapter called Profits and Gains of Business or Profession. For those who are coming from outside and has got this unnecessary notion saying that this is the toughest chapter compared to salaries, mistaken. There is nothing worse than salaries here. Yes, one of the most easiest chapter because that can be understood in the pure logics. Purely logical chapter, there is absolutely no challenges there because salary has a lot of mugging up to do. This has nothing to be mugged up. Straightforward chapter can be easily closed off. Yes, how do you remember is you have to start with the chapter with a clear understanding that first of all it is for your business or profession. It is for your business or profession. Second thing you have to understand is there is a difference between the word called allowance, disallowance and reduction. There is a difference between the word disallowance and reduction. Sorry. There is a difference between disallowance and addition. There is a difference between the term disallowance and addition. What do you mean by a disallowance? Something which you claimed has to be disallowed. Addition meaning something which is not there itself. That will be called as an addition. Open up your P&L. If you find as an expense, be more expressive. Open up your P&L. If you find an expense called 100 and the section comes and says you cannot take it, this will be called as a disallowance. This will be called as a disallowance. Second option, they are coming and saying, no boss, nothing is there on the left side. Nothing is there on the left side, but I want you to add something. It will come on the right side as an addition. It will become as an addition. These are two English words you have to always remember for your exams. Never use disallowance for addition, never use addition for disallowance. Treatment will be the same. Examiner will look at you differently. Yes, there is a difference between the term disallowance and an addition. The more English you use, the better impressed he is. That is how you will see in the market and all. No, the more English a boy speaks, the girl likes more. Apdi na peswanga. You like foreign people better, no? Adan. This option is out, Ra. India is always out for you. Yes? Anyway, all that aside, you are into the chapter called PGBP. You are into the chapter called PGBP. First page is fully useless for you. That's marathon. First page is fully useless for you. You don't have anything to be read in the first chapter. Yes, first page is not relevant for you. You're discussing about the chapter called PGBP. They're basically coming and clarifying as to what are the kinds of income which will be taxable under PGBP. We've already covered this kind of. If you go to salary chapter, we already discussed that if it's a salary of a partner, if it's a salary of a partner, it will be taxable under the head. That is what is given here. Other than that, they're telling if it's a business income, it is PGBP. That's namakku theriyada. Theriyumla. Yes, any kind of subsidy which you receive from government for business will be taxable under. That's chapter la kuthirukku. Do you have to remember this page? Nothing. Ignore the page and go forward just for you to give us a charging section. Just for you to give it as a charging section. When we start with this chapter, you have to first understand the difference between normal business and speculative business. Normal business and speculative business. Provisions basically coming as saying that if you have any kind of transaction, where you don't have any kind of delivery happening, if you have done SFM and all, they would have FM. If you have done FM and all, there is something called going long, going short. Going long, going short, all derivatives and all that cases. Basically what happens is you are entered into a transaction. You have entered into a transaction where what is happening is you are not getting an actual delivery of the shares. Suppose you enter into a transaction where you come and say that I will in the future buy shares from you of worth 100 rupees. I will buy a shares from you in the worth 100 rupees. Tomorrow what happens is you don't buy the shares worth 100 rupees. You go check the market. If the shares are quoting at 120 and you are going to get 100 here, 20 is pure profit, you take it off. Did you do delivery here? Did you grant the shares to him? Did you buy the shares from him? This is called speculatives. These are called speculatives where you are not entering into a delivery transaction. You are not entering into a delivery transaction. Do you have to remember this? No. Exam la kuthruvaru. They will give you straightforward that this is a speculative transaction, or they will use the word called derivatives. They use the word called derivatives, both of them are speculatives. What are the provisions basically are that they're coming and saying speculative business keep it separate, normal business keep it separate, because speculative chances of losses are high. Chances of losses are high. So the losses of speculative should not be set off against income of speculative. Should not be set off against income from normal. Should not be set off against income from normal. Meaning speculative losses can be set off only against speculative income. If it is not eligible, you can carry forward for a period of 4 years. Return filing is always mandatory. Return filing on due date is return filing on due date is mandatory. In this, what you have to remember is the exceptions. What you have to remember the exceptions. In the exceptions, the only thing you have to remember is the point number D. What you have to remember is point number D. Basically, what they're coming and saying is if you have any kind of commodity derivatives, if you pay the commodity transaction tax on it, it is not a speculative case. Varna, it is a speculative case. But if it is an agricultural commodity, whether you pay commodity tax or you don't pay commodity tax, it will always be non-speculative. It will always be non-speculative. Idu mattum nyamagam vechikano because this has come in exam once. Adu thavara the question itself will come and say you it's a speculative transaction. Clear? Yes. With this, we'll get into the format. Same logic. Yes, every chapter will have its own format. How do you start the format? Is now you are into PGBP. Now you are into PGBP. We are going to follow indirect approach, which means you are going to start from net profit before tax. You will start from net profit before tax. You can start from net profit after tax and then disallow that. Means the same. You can start from net profit after tax, but you will have to disallow the tax. You have to still compute taxes. You don't even know your taxes. So you can disallow the tax, but it's better to always start from net profit after tax. Most likely in inter-level at least they will never give you the tax. In inter-level they will never give you the tax, which means you will always be starting from net profit before tax. Then what you have to do is you have to first disallow something which was claimed. Then add something which was to be offered. Then you will claim something which is already offered. And then you will allow for something which is beyond what they are asking you. This is what the format is. Straightforward format. Nothing of this is important. We are getting into the specifics now. What is the specific work is? I will ask you the logical question. You will give me the logical answer. Can you do that? Yes. I have a plant and machinery which I am using it for my business. I have to hire that plant and machinery, so I paid 10,000 to someone. Can I claim it as a rent? Am I allowable for expense? Yes. I have to incur some kind of tax on that. Can I claim it as an expense? Yes. I have taken a loan for it and I have incurred interest on it. Can I claim it? Yes. If you have not taken a plant and machinery, but if you have taken a building, this Sankara coaching center is basically a building which is rented. It's not clarifying. Yes, it's anyway something which is a rented. Now, because I want to conduct classes here, I am paying rent to someone. Can I claim this as an expense? Yes. I have taken sudden a big repair. Yes, because I felt that everyone is going to come here. I have taken 4 or 5 big furnitures and all, big projectors and all. I have put some heavy level expenditure I have done. That's everything which is going to increase my efficiency. Can I claim it as an expense? No. Why? It's a capital transaction. What will you do? You will add it to your block of the asset and you will claim depreciation. But if the repairs was a normal repairs, I gave someone gardener for sweeping charges and all, would you want to capitalize it? It's a normal revenue expense, can be claimed as a deduction. So the first 2 sections which are there is basically coming and saying any kind of expenses which have incurred on your land and building or your plant and machinery. If you pay rent, you can claim. If you pay interest, you can claim. If you pay any taxes, you can claim. If you pay any kind of repairs, you can claim, provided it is current repairs and not capital repairs. This I don't need to tell you, it's there in accounts. If you have debited your capital repairs into your books, your accounting itself is wrong. Yes sir, that itself is wrong. Income tax, the only place it can come saying that the capital repairs is debited in P&L is ICI material, that's all. You cannot do it anywhere else. Yes, in the market and all, if you go and debit your capital repairs into your P&L account, your auditor will come and kill you off. Yes, so capital repairs will always have to be added to the block of the asset. Having that said, now we are getting into the block of the asset concept, which means we are getting into the most important section called depreciation. We are getting into the most important concept called depreciation. Can someone help me with the meaning? There is something called as a normal wear and tear. Any normal wear and tear which happens on your capital asset will be called as a depreciation. There are some rules before you enter into the depreciation itself. The first rule is that you should be the owner of the asset. Second rule is that you should put the asset to use. You should put the asset to use in the current year You should put the asset to use in the current year. But you have a fire extinguisher at your home. These are passive use assets. Passive use assets can be claimed as a depreciation in the year in which it is ready to use. Also, I do not have to light my house on fire to claim the expenditure deduction. Yes, no need to light my house on fire for claiming the fire extinguisher as a deduction. These are passive use assets, can be claimed as a deduction today itself. Yes, two things. You have to claim the asset only when the asset is put to use or ready to use in case of passive. In case of passive, you will never get any kind of depreciation when it comes to land or the amendment for the current year, which is goodwill. The amendment for the current year, which is goodwill. You cannot claim any kind of depreciation on the land or an goodwill. Having said that, now you have to get into two concepts. Understand whether what method of depreciation you are following. You can either follow SLM or WDV. SLM can only be followed by power sector, which means it is not coming for exam. Power sector is never going to come for your exam. Yes, so the only method which you can follow for your exam is WDV method. The only method which you're going to follow is WDV method. Just to give you a quick overview of the SLM method, they are basically coming and saying every asset individually identified, individually depreciation granted. If you try to sell that asset, and you incur a loss on that asset, that loss can also be claimed under PGBP. If you earn any kind of profit on that asset, to the extent of the cost of the asset, you can claim under PG. You have to offer under PGBP. Balance will go under capital gains. That's the provision. Nothing is coming for your exam. Yes. Coming to the main provisions, which are talking about your WDV concept. They have established a rule called a block of asset concept. They have established a rule called a block of asset concept, where they are coming and saying similar kind of assets with similar depreciation rates will be added and become a block. For which you will grant a depreciation. Once you add to the block, it will lose its value. It loses its identity. In the block of the asset. How many blocks do we have? You have building, you have plant and machinery, you have intangible assets, you have furnitures. You have four. Yes, you have buildings, intangible assets, plant and machinery, and furniture. When it comes to buildings, the rate is generally it is 10%. But if it is used for your employees and all, it is 5%. In exam, it will always going to come 10% only. In exams, it is always going to be 10% only. 5% and all has never been tested till now. Yes, so buildings is 10%. Next, you get into plant and machinery. In plant and machinery, they are coming and saying if it is a vehicle, 15%. If it is a vehicle, 15%. If it is a general plant and machinery, 15%. Any kind of aeroplanes and all that, 40%. Any kind of things which will destroy immediately will become 40. Books. Yes, any kind of material which you can when you go to the exam hall itself, see the material which you have before you preparing for it. 40 தான். Yes, so the material which you have will always be 40%. Books are always depreciated at 40% because the life of the asset is very low. After that, will you get into intangible assets, where the rate will become 25%. If you have any kind of office furnitures, 10%. Any kind of office furnitures will also be liable for 10%. You have some additional things called motor vehicles and all, where it is 30% and 40%. The timeline has expired, so I don't think it's relevant for exam anymore. Yes, so you can ignore it and go, it's not so relevant. So the moment you have to remember is buildings, 10, furniture, 10, plant and machinery, 15, vehicles, 15, intangibles, books. Yes, this is what your provisions are when it comes to normal depreciation. The moment I am talking about normal depreciation, comes a concept called additional depreciation. Eligible only for manufacturing sector. On new plant and machinery, provided you follow WDV method. You will not be eligible for it in SLM method. You will have to follow WDV method. Provision comes and says that if you have a new plant and machinery, I will give you additional depreciation at the rate of 20%, provided you put the asset to use for more than 180 days. If you put to use the asset for less than 180 days, 10 current year, 10 next year, 10 current year and 10 next year. This concept applies for the normal case also. The depreciation which we discussed right now will be eligible only for assets put to use for more than 180 days. If the asset was put to use for less than 180 days, only half of it will be eligible for you. Coming back to the additional depreciation, they come and say 20 in the full year or 10 in the current year and 10 in the next year is what the depreciations are. The rule is very simple, that you should have a new plant and machinery, meaning it should not be used inside India or outside India. It cannot be a second-hand asset. Second thing is, it should be installed in the factory premises. Should not be installed in office premises. Cannot be a vehicle except for a forklift, and the last thing is you should not claim 100% of that as a deduction. Cannot claim 100% of that as a deduction. This will arrive at your depreciation. Now we have to discuss the concept of the block of the asset. What is the format? What is the format? You have to start from the opening WDV. Start from the opening WDV. Add additions more than 180 days, less than 180 days, not put to use. Additions put to use for more than 180, less than 180, or not even put to use. Then you will reduce something called as sale value. You will reduce something called as sale value, not the cost, not the loss, not the profit, sale value. Directly reduce the sale value of the asset from the block of the asset. You will arrive at a gross block. You will arrive at the gross block. Take this gross block, split. Take this gross block and split. If it is an asset which is put to use for more than 180 days, depreciation will be full. If it is an addition less than 180 days, depreciation will be half. If it is an addition less than no put to use, anything else will directly go into additions plus minus sales. Anything else will go into opening minus sales. You will give depreciation at full rate. You will give a depreciation at full rate, and then you will additionally include something called as an additional depreciation. Arrive at the depreciation number for the current year, and then close the block by reducing the opening minus actual depreciation allowed in the current year. Actual depreciation allowed in the current year. Meaning, let's say you have an asset. Let's say you have an asset called a motor car. You have used this asset for 20% of personal and 80% for official. 80% for official and 20% for business. What you have to do is, if the asset is worth 100, depreciation rate is 15. Vehicle 15, depreciation rate is 15. But can you claim 15 as a depreciation? No, because 20% of that was used for personal. So which means 3 rupees was used for personal. 3 rupees was used for personal. So the depreciation which you can claim in the current year is 12. Depreciation which you can claim in the current year is only 12. What will you reduce from the block is 15 or 12? 12. You will reduce from a block 12. Because that is the depreciation which you actually claim. You can only claim that as a deduction. In case you did not understand, the example is there in page number it's in page number 54. It's in page number 54. Okay, this is what the example is. You have to ensure that you only claim the actual depreciation which you claimed as a deduction. Do not claim for the whole depreciation, which is where I am clarifying to you. If the examiner comes with a question, and the favorite question for them is motor car. Favorite question for them is a motor car. They will give you motor car 100% nila additional information, and there will be the fact that it is used for part personal and part official. Part personal and part official. The moment you see that, you have to go back to the P&L and you have to check where and all have you done motor car. It can be in the form of depreciation, it can be in the form of interest on loan, it can be in the form of maintenance cost also. All the cases have to be split between personal and official and then claimed. All the cases have to be split between personal and official and claimed. I am giving you a hindsight because if the question comes, definitely it will be there. Likhe vachiko. Clear up? Yes, this is what it comes for motor car. Once we are done with the depreciation is when we have to split the depreciation into absorbed and unabsorbed. Basically, they're coming and saying that if your PGBP ends up in a loss, what will you do is take the PGBP and check how much of that PGBP loss is pertaining to depreciation. To the extent of the PGBP loss which pertains to depreciation, you will carry forward for a period of unlimited years. You will carry forward for a period of unlimited years. Return filing on time is not mandatory. Return filing on time is not mandatory. Everything else is getting absorbed. Since we have completed depreciation, let me clarify. 115 BAC comes and clarifies additional depreciation is not eligible. Additional depreciation is not eligible under section 115 BAC. Yes, 115 BAC does not permit for your additional depreciation. With this section number 32 being done, everything else is carry forward mokke from this. Before we complete the section 32 itself, there are some special scenarios which you have to clarify yourself. Yes, what are the special scenarios? I will ask you. Yes, question is like this. You have taken a property. You have purchased a property. For purchasing the property, you give cash also, you give permissible modes also. What will you do? Check if the cash which you gave is more than 10,000 per person per day. 10,000 per person per day. If it is more than 10,000, the cost will be ignored. The full expenditure will be ignored. Balance, everything will become added to the cost of the asset. You have taken an asset and you have claimed scientific research deduction on it. Cost of the asset for the purpose of the block will become 0. You have taken an asset, claimed 35 AD on it. 35 AD? Specified business. You have claimed specified business on it. Cost of that asset will become 0. You have taken a building for your personal purpose. Brought it into business and started using. Assume that the building was there in business from the start of the day. Assume that the asset was there from the start of the business and compute the depreciation. Whatever is the depreciation, ignore it off. Balance is what you will bring into the business. So which means cost minus notional depreciation. But yes, if you bring any other asset, exact cost will directly be brought inside. Exact cost will directly be brought inside. This is how it looks like. Where is it? Point number G. Building used for personal purpose brought into business. It is actual cost of the building minus notional depreciation from the original acquisition till date, but it is only applicable for building. If it is any other asset, you will directly bring the cost of the asset. Second question, you have taken a loan for this asset. And you are going to pay interest on that. What will you do? Go back to your AS. Borrowing cost 16. Go back to your AS 16, borrowing cost. Provision comes and says any kind of interest which you have incurred on the loan till the date on which the asset is qualifying. Will be capitalized to the asset and balance will be claimed. Same provisions. The difference is qualifying here means put to use, not ready to use. Accounts says ready to use. Income tax is better. They talk about put to use. Your accounts faculty, you can tell he is wrong. Tax is better. Yes. So in tax it is up to the date on which the asset is put to use. The interest will be capitalized and will be added to the block of the asset. Balance everything will be allowed as a deduction subject to 43B. Subject to 43B. So this is the second 43B. First one is talking about taxes. Second one is talking about interest. With me? Yes, we have completed section number 32. No 33, no 34 for exams and all. Directly jump to 35. Nothing of this nonsense is required for you. Directly open the page. Cut out the whole page. Take the page, scratch the whole page out. One provision I will give you. That's all. Scientific research, 100% of the deduction allowable except for land. That's all is the provision. Any kind of scientific research expenses you incur, whether it is capital or revenue, as long as it is other than land, 100% of the deduction will be allowable. Nothing else to read. That's all. Chapter itself over. Nee contribution panalo enna, nee expenditure incur panalo enna, everything is 100% as a deduction. Nothing to be remembered. One single short provision will come for your exam. Clear? Yes. After the section 35 comes. After section 35 comes 35 AD. Before we get into 35 AD, again the provision which I have asked is 115 BAC. 115 BAC, the reason why I have split and shown in my material is because the part A which is there, no, which is called as in-house R&D, that is allowable under 115 BAC, but contribution is fully not allowed, which means in your 115 BAC, expenses can be claimed, donations cannot be claimed. So the second chart which is there, the point number B chart which is there, has to be fully disallowed under 115 BAC, but the first part can be fully claimed. Clear? Yes, the whole chart in a single shot, 100% of the deduction can be claimed as 100% of the expenses can be claimed as a deduction except for land. 100% of the contribution can be claimed as a deduction except for 115 BAC. Section number 35 is done for you. Clear? Yes. Now we are getting to section 35 AD. Talks about specified business. The provision basically is coming and saying that if you have done some kind of special businesses, only certain things to remember. First one is hotel 2-star and above, hospital with 100 beds, storage facility for sugar or agricultural produce does not include edible oil. Yes, edible oil cases and all will be fully taxable as per normal business. Any kind of agricultural produce for sugar and agriculture, any kind of produce for sugar and agricultural, as long as you have a warehousing facility, will be fully covered under 35 AD. Provisions again are the straightforward. Revenue expenses 100% allowed, capital expenses 100% allowed, except for land, goodwill. Except for land and goodwill, there is no building and all. Building and all is fully permitted, except for land and goodwill. But since you are in 35 AD, the provisions are basically coming and saying that if you have any kind of loss from specified business, it can be set off only against revenue from the specified businesses. Revenue from specified businesses, not from the eligible businesses. Revenue from specified businesses. Even if the business is not eligible for 35AD, you can still claim. You can still claim. So loss from a specified business can be set off against an income from a specified business. If you are not able to set off, you can carry forward for indefinite period. You can carry forward it for indefinite period. Return filing on time is mandatory. The only two things which are not having a mandate is unabsorbed depreciation and HP losses. HP losses. Shorta solta. House property loss. Yes, house property loss and unabsorbed depreciation. Other than that, whatever losses you have has to be mandatory filed on time. Has to be mandatory filed on time. This is what is your specified businesses. This is what is your specified businesses. Any doubts till now? No. The last provision in the specified business, they are coming and saying, if you had a specified business and you sold, if you had a specified business which you have sold, in which case what you have to do is you have to check whether you have sold this property within a period of 8 years or after 8 years. If you have sold the property after 8 years, then in that case cost is 0, only if you're bringing into the other side of the business. Basically, when you have a specified business, what you have to do is check whether the property was taken for in-house for another business or was it sold outside. If it was sold outside, what will you do is whatever is the sale value will become fully PGBP, except where the sale value exceeds your cost also, in which case it will become capital gains. But if it's a property which was brought into another business, check whether the property was brought within a period of 8 years or after 8 years. If the property was brought within 8 years, cost will become cost minus notional depreciation. Cost will become cost minus notional depreciation, because that is the same amount you are going to offer as income also. Offer that money as income, add it to your block. Clear? Offer that money as income and add it to your block. But if you transfer the asset beyond 8 years, what will happen? Nothing to offer as income, nothing will be added to the block. This is the provisions for 35AD. Something similar provisions are there for section 35 also. The only difference is on the provisions and the 8 years illa. Which means, what are the provisions? They are coming and saying, if you take the property of your scientific research and you directly give it outside, sale value will become taxable for you. But if you are bringing it into another business, cost is 0. That's all. Cost is 0. At this point of time, let me clarify, 35AD is also not eligible for 115 BSc. 35AD is also not eligible for 115 BSc, which means the business will now be called as a normal business. Whatever is your revenue expenses were anyway allowable. Capital expenses now you can claim depreciation. Capital expenses will now be eligible for depreciation under section 35AD for your 115 BSc cases. Clear? Yes. So we have done with section 35 also. 35AD also. Now we are getting into the small activities. Small activities is basically 35D, called as a preliminary expense. They are basically telling if you incur any expenses before the business was started. Take all the expenses together, subject to a maximum of 5% of the cost of the project. That will be allowed over a period of 5 years. Then they basically came and said that if you have any kind of VRS, voluntary retirement scheme, in that case also the capital part of the VRS will be allowed as a deduction over the period of 5 years. Next thing is, if you have incurred any kind of expenditure on family planning, for inter-level expenses disallowed. The reason why the expense is disallowed is because family planning is only allowed for companies. You are only going to have individuals or firms. So from exam perspective, any kind of family planning expenses which you have in your material will be always disallowed. For CA Inter. Come to finance, I will talk differently. In inter level, this expenses will directly be disallowed for you, no second thought. Which means there are 3 expenses. Family planning expenses, VRS expenses, preliminary expenses. Preliminary expenses and VRS expenses allowed over a period of 5 years. Family planning expenses disallowed. That's all you have to remember for your exam. Family planning expenses will be directly disallowed for you. With this, section 35 also gets done. Section 35 is done. Coming to the next section called section 36. Coming to the next part of the section called section 36. Section 36, the first thing is section 36 is borrowed capital. We have already discussed this when we did block of the asset. We already discussed it when we did block of the asset, but just to give you an overview, it basically comes and says that any kind of interest, any kind of loan which you have taken for your assets, any kind of loan which you have taken for your assets, tell me when the asset is put to use. Tell me when the asset is put to use. Any kind of interest which is there until the asset is put to use will be capitalized. Any kind of interest after the asset is put to use will be allowed under 43B. Allowed under 43B. If you have taken the loan for the purpose of working capital, 43B. Again 43B. That's all straightforward provision. Sum is over. Yes. Coming to the next part, which is the most important thing for the current attempt, it is called as contribution to PF. This PF, salaries PF. ரெண்டுத்துமே amendment இருக்கு, ரெண்டுத்துமே முக்கியம். Yes, both have an amendment in the current attempt and both are important for your exam. This provision is basically coming and saying whenever there is a contribution to provident fund, whenever there is a contribution to provident fund, check again whether it is an employer's contribution or employee's contribution. If it is an employer's contribution, it will be covered under 43B. It will be an employee's contribution covered under 43B. Basically, they are coming and saying make the payment within the due date of filing of return of income. Make the payment within the due date of filing of return of income, you will get the deduction. Don't make the payment, claim it in the year of payment. Claim it in the year of payment. But when it comes to employee's contribution is when the problem is. They have come and said that you have to make the payment on the date of the respective act. On the date of the respective act, which generally is 15th of next month. Generally is 15th of next month. Do you have to remember the date? No, the exam will give you. Yes, they will itself come and tell you what is the due date and when the payment is made. Here the provision comes and says that if the provision of employee's contribution is there, if there is an employee's contribution which you have to make the payment within the specified due date, you have to make the payment within that specified due date. If you don't make the payment within the specified due date, I will disallow add. You will permanently add it to your income. Employee's contribution to PF was never an expense you claimed. Hello. Employee's contribution to PF was never an income which you, never an expense which you claim. Employee's contribution to PF is nothing but the employee has a PF, we have taken it from him and we are giving. We are only acting as an agent. We are only acting as an agent. We don't have any kind of income or expense against it. So therefore, it will be permanently. Examiner Papa Munji. Yes, any kind of employee's contribution to PF, if there is a delay of even 1 day, it will be permanently added to your income. It will be permanently added to your income. It will not be disallowed and all. It will be permanently added to your income. Clear? Yes, this is what the provisions of section 36 is. Apart from the 36, you have the next important provision which is talking about bad debts. Provision basically comes and says, if you want a bad debt claim, you come to me and you explain me first thing. When did you offer this income? Condition number 1, offer that income. Condition number 2, write off the debt. Condition number 2, write off the debt. You satisfy both the conditions, you come to me, I will give you the benefit. You come to me, I will give you the benefit. So the bad debts provisions are very simple. Accounting is what they are asking you to follow. Accounts is what they are asking you to follow. For you to claim a bad debt, you should have offered it as income. So first to offer it as income. If you are offering it as income, current year pass the bad debts entry, which is called bad debts to debtors. Write off the debt. Claim both the satisfy both the conditions. I will give you the deduction of bad debts. I'll give you the deduction of bad debts. But they have clarified here that in case the bad debts, in case the bad debts was disallowed earlier, subsequently if you recover the money, you did not offer it again. But yes, if you subsequently recover the money and you have to offer it to income, you have to offer it regardless of whether the business is continued or not. Regardless of whether your business is continued or not. So if you have any kind of recovery from bad debts, what is the entry which you will pass? Cash account, bank account debit to bad debts recovered. Bank account debit to bad debts recovered. When you pass that income entry, check whether you have already offered the expense. If you had already claimed the full bad debts, you have to offer the full income. If the bad debts itself was disallowed for you, you do not have to offer this corresponding income. Clear? Last provision for a deduction perspective called section number 37. The next thing which you have to discuss is section number 37. Section number 37. 36, there are two more things. Insurance premium, allowable, not allowable. Any kind of bonus you pay. Any kind of tax. Bonus is also allowable. Yeah, the one-time question. Any kind of, that's and all for full course, not for this thing. Yes, any kind of bonus and all which you pay is also allowable, subject to 43B. Subject to 43B. Apart from that, they basically come and said that if there is any kind of non-monetary perquisites, if there's any kind of non-monetary perquisite which you have given to employee, and the tax on that non-monetary perquisite is also something which you are claiming. Who's claiming? Employer. Who's claiming it? Employer. They basically come and said, I will give you one option, do one thing, tax on non-monetary perquisites, let the employer take a disallowance, let the employee exempted from taxes. Let the employee exempted from taxes. Any kind of non-monetary perquisites will become fully disallowed in the hands of the employer, will be fully exempt in the hands of employee, The next thing which they are talking about is a zero coupon bond. Basically, they are coming and saying any kind of zero coupon bonds which you have, if it is spilling over 2 years, spilling over years, allow it as a deduction over number of months. Allow it as a deduction basis number of months. For example, if you have taken a zero coupon bond in February for 3 months, what will you do? There are 3 months. So February, March, April. So 2 months you claim current year, 1 month you claim that year. That's all is done. Okay provision, nothing is there. Is there anything else? All done? All done. Yes, now we are getting into section number 37. This is basically the garbage section. This is basically your garbage section, where it basically comes and says that if nothing is covered other, you cover it here. If nothing is covered elsewhere, you will come and cover it here. What are the provisions is, first of all, it should be a revenue item. It should be for business. Ella accounts down. It should be incurred in the current year. It should not be an offense or a penalty paid under a law. It should not be an offense or a penalty paid under a law. If it is a penalty paid under a contract, allowable. If it is a penalty paid under a law, not allowable. Which means basically, if you pay GST, can you claim? Yeah, Manu? You can claim GST subject to 43B. That's tax. Can you claim income tax? No, income tax cannot be claimed. You that tax da compute panna pora. Adhe claim pandradhukku eppadi? Yes. So income tax cannot be claimed. GST can be claimed. Interest on income tax cannot be claimed. Interest on GST can be claimed. Penalty of income tax cannot be claimed. Penalty of GST cannot be claimed. Penalty of GST also cannot be claimed. Late filing fee for income tax. As per ICI, you cannot claim any kind of late filing fee which you have paid for filing your return, which is 234F. Will also become disallowed for you. Apart from that, they are basically coming and saying any kind of freebies which you give to doctors, doctors, disallowed. Any kind of freebies given to doctors is disallowed. Any kind of CSR expenses, disallowed. Claim 80G. Any kind of contribution made to charitable funds can be disallowed here and can be claimed under 80G. Any kind of donations you make to political parties, disallowed here and claim 80G. B. Claim 80G. Sandoshama maga pandringa nalla. Claim deduction under 80G. Claim deduction under 80G. And the last one which they are coming and saying is any kind of interest which you pay for MSME. Any kind of interest which you pay for MSME will also be disallowed for you. This is section number 37. With this we have completed all our deductions. Now we are getting into disallowances. Talking for the disallowance, first disallowance is on account of TDS. 40A. In 40A there are two, 40AI and 40AI. Yes, so there are two types of disallowances. Basically they are coming and saying if there is an expense on which you were supposed to do TDS and you have not done the TDS, I will disallow it for you. How much? 30% if the other person is a resident, 100% if the other person is a non-resident. When will the disallowance come? If the deduction of TDS has not happened in the previous year, or if the deduction happened in the previous year but you did not deposit in the within due date of filing of return of income. The provisions are that you should deduct the TDS within 31st March, and after you deduct the TDS within 31st March, you should deposit within the due date of filing of return of income. 7th is right, that's the provision in TDS. 7th is right, that's the provision in TDS, but that will not attract disallowance for you. Disallowance will only be attracted if you make the payment within the due date of filing of return of income. If you don't make the payment within the due date of filing of return of income, it will be disallowed in the current year and allowed in the year in which the TDS is paid. Clear? So this is the first provision which talks about TDS. The second provision talks about taxes, where they have come and clarified that any kind of taxes, interest, surcharge, cess, levy, whatever it is under this act will become fully disallowed, Late filing fee will also be covered here. This is the reason why net profit after tax becomes net profit before tax. Done? Yes, I don't think anything else is important in this 40. That's all. Yes, now coming to the other part of it called section 40A. This talks about specified persons. Where basically they have come and said that if you are incurring any kind of expenses with your specified person, in that case I will check whether it is reasonable or not. If it is unreasonable, then I will disallow the unreasonable part. Who will decide whether it is unreasonable? For your exams, ICA will decide. ICA will come and decide whether the expenses are unreasonable. I'll tell you why. The provision says it's assessing officer, which means who will make the disallowance? Assessing officer. Will he make the disallowance at the time of return or at the time of assessment? When are you computing the taxes for? Return, no? You are computing total income for what? Return or assessment? How are they doing it? For inter and final level, the person who is making the unreasonability claim is ICI. In practical world, the person who will do it is assessing officer. Who is better? For the next 3 years, ICI is better. After that, you go and out. Okay. Coming back, the provisions are like this. If there is any kind of unreasonable expenditure, the unreasonable expenditure will be disallowed. What will be disallowed is unreasonable expenditure. What will not be added is unreasonable income. It should be an expense and not an income. How do you decide whether it's unreasonable? It should be paid to specified people. For your exam, only individuals are important, and the unspecified people for them is your left side of the family. Left side of the family basically means you, your siblings, your parents, your grandparents, your kids, and your spouse. So from the right side comes your spouse, from the left side comes your full family. From the right side comes your spouse. Any relative of the spouse is not covered. Any kind of payment made to the relatives of your spouse are never covered. One of the favorite questions of ICA exam is paying salary to Macha and Machinichi. That is what will keep coming. Paying salary to your spouse's brother, spouse's sister. That has to be unreasonable, only no other options. You cannot really go and ask for it. Yes, one of the favorite questions for examiner will come and say that the salary which is paid to your spouse's brother is 10,000 rupees. Market only permits 5,000. What will you do? Nothing you can do. Don't go and question your spouse's brother and all, you will be killed. Yes, no unreasonability when it comes to your Macha and Machinichi. It's everywhere reasonable only. Yes, if you want to stay blessed at home, there is no other option. It's always unreasonable only. Yes, it's always permitted, which basically means that any kind of payments made to spouses, relatives are always reasonable. It's always reasonable. It can never be treated unreasonable. And the second thing which they're coming and saying is any kind of payment made to an organization where there is a substantial interest. Substantial interest basically means all those cases where you have 20% or more of the voting power. This is 40A2. With 40A2 comes 40A3. 40A3 basically talks about your cash payments. Basically, they're coming and saying if you are incurring expenses, and the expenses is 10,000 or more to one person in Monday, 10,000 or more to one person in Monday, and the expenses is made other than by way of paid otherwise than by account pay check, account pay bank draft, electronic clearing system, or any other kind of notified payments like Beam, Aadhaar, debit card, credit card, all those cases. In that case, whatever expenses you have will be fully disallowed. Can you claim it in the future? No, it will be permanently disallowed. But yes. If you have claimed an expense in 1 year, and make the payment of that in the subsequent year, next year it will be called as an addition to your income. It will not be a disallowance. It will be treated as a deemed income. Here is where they have given certain exceptions, and the first exception they have given is that if you are doing a transport business, 10,000 becomes 35,000. If you make any kind of payment on a banking holiday, still disallowed. Any kind of payment made on a banking holiday is still disallowed. What other exceptions do you have? Any kind of payment made to your farmers directly will become allowable as a deduction. Do not make the payment to middlemen. Do not make the payment to middlemen. Middlemen and all are disallowed. Any kind of payment made directly to the farmers and everything will become allowed. Any kind of payment made to your employee 50,000, more than 15 days recreational. If he's been transferred to somewhere else and he does not have a banking facility there, in that case it will be allowable. Retirement benefits up to 50,000 are also allowable for you. These are some exceptions given. Predominantly they will check you the 35,000. Predominantly they check you the 35,000 along with the farmer's case. Or they will check you for the banking facility. All they check you for the banking facility. The moon mattum nyavagam vechikno. Nothing else is important for this. Clear? Yes. With this 40A3 is also done. With this 40 is also clear. Yes, you have something called provision for gratuity. We already discussed when we went forward. Next provision comes to you is 43A. This provision basically comes and says that if you have a capital asset, which you have purchased from outside India, and you are going to incur any kind of loss on these assets, on account of foreign exchange, whatever foreign exchange loss which you have incurred has to be capitalized. Whatever foreign exchange you have incurred is also to be capitalized. You cannot claim it as a deduction. That is what a simple provision comes and says. You take an asset has outside India, loan is also from outside India, or the payment happens later, whatever it is. If there is any kind of foreign exchange loss which you incur on these assets, that will also be capitalized. And coming to the most important provisions in this chapter, every attempt short question is 43B. Short question is 43B. This provision basically is coming and saying that, sir, there are 6 kinds of payments. I will give you the deduction of these payments only if you make it within the due date of filing of return of income. The 6 provisions are, first of all, interest. Second of all, tax. Third of all, contribution of employer to provident fund. Fourth of all, bonus. Fifth one is leave encashment. Last one is railway assets. You all these cases have to make the payment within the right time. All these cases have to make the payment within the right time. Which is the right time? Within the due date of filing of return of income. For your exam, the due date of filing of return of exam is only 31st October. For your exam, that is only 31st October. 30th November is not been prescribed, and if you are 31st July case, you will never even have this. So the only due date which you have is 31st October. 31st October kulla, if you make the payments, you will get the deduction. If you don't make the payments within 31st October, disallowed in the current year and allowed in the year in which the payment is made. Here is where they have given a clarification also to come and say that, sir, if you had any kind of interest, which was disallowed for you in the past, and then you have converted it into a loan, you will get the deduction only when you make the payment of the loan. If you make the payment of the loan is when you will get the deduction. You will not get the deduction on the date on which you convert itself. You will have to make the payment of the date of, make the payment of the loan, you will get the deduction. With this, your PGBP is done. Coming to some administrative provisions. Simple three provisions. Administrative left. First of all is talking about books of accounts. This is only MCQ. Pure MCQ question. MCQ they will come and ask who is required to maintain books of accounts. You will have to split here between business and profession. If you are into profession, they will check for your gross receipts. If your gross receipts is more than 1,50,000 in all the last 3 years, if it is more than 1,50,000 in all the last 3 years, then in that case what will happen is they will come and say that you have to maintain books of accounts which they give you. What are the books of accounts they will give you? Cash, journal, ledger, case register, daily case register, and then carbon copies beyond 25 rupees. It is not a daily cash register, it is daily case register. Check. This is an MCQ question for you. It is a daily case register and not a cash register. Okay, case register is basically that medical people ku yaar vandanga ponanga and the case register. It's not cash register. Adu paakumbodhu thappa theriyum. Yes, it's daily case register. Yes, these are the people who have to maintain books of accounts when it comes to a profession. If you are not satisfying these conditions as a profession, you have to maintain books of accounts. What books to maintain, they will not tell you, you can decide. They will not tell you, you can decide. But as long as you maintain sufficient books of accounts which can help him to correct his income, he will be happy. Coming to the business part of it, they are coming and saying, tell me whether you are an individual HUF or others. If you are an individual HUF or others. If you are an individual or HUF, they have come and told that I will check about your PGBP income, and at the same time I'll check for your receipts also. At the same time I'll check for your receipts also. If the PGBP income is somewhere around 2,50,000, if the PGBP income is somewhere around 2,50,000, or the turnover is somewhere around 25 lakhs, in that case you have to maintain books of accounts, provided this is for all the 3 years or any of the 3 years. Any of the 3 years. It is any of the 3 years. If not, you do not have to maintain books of accounts itself. If not, you do not have to maintain books of accounts itself. If you are any other case basically comes and says you should have 1,20,000 worth of profits or 10 lakhs worth of turnover. 10 lakhs worth of turnover in any of the last 3 years. If any of the conditions get satisfied, you will be maintaining books of accounts. What books of accounts to maintain? Anything which is enough for the officer, anything which is enough for the officer, nothing is required, they have not prescribed anything for you, so there is no problem there, there is no problem there. If you are not satisfying that, then you have to not maintain any kinds of books of accounts itself. That is what the provisions are. Coming from the books of accounts comes audit. From the books of accounts comes audit. This is where there is an amendment for the current item, so you have to be extra careful about it. The amendment basically comes and says you have to satisfy whether you are a business or a profession. Check whether you are a business or profession again. If you are into profession, it is 50 lakhs. If it is a profession, it is 50 lakhs. If it is a business, it is normally 1 crore. It is normally 1 crore. But here is where the amendment comes in, and they have come and said, if you do your business up to 95% in permissible modes, up to 95% of your business is done in permissible modes. What is 95%? They are coming and saying 95% of the receipts and expenses. Receipts and expenses. Expenses should also be 95% in permissible. Receipts also should be 95% in permissible. Any of the two also does not get satisfied, 1 crore will be the limit. But if any of them gets satisfied, it will become 10 crores of limit. It will become 10 crores of limit. So you have 3 limits now: 1 crore, 10 crore, and 50 lakhs. 1 crore, 10 crores, and 50 lakhs. These are what your provisions for tax auditor. These are what your provisions for tax auditor. If you are liable for tax audit, you have to file your return by. If you are liable for tax audit, when are you filing your return? Na ketadhukku badal solra, nee ketadhu velala. You have to file your return on 31st October. If you are filing your return on 31st October, you have to furnish the tax audit 1 month before that to 30th September. Na kekradhu or kelvi. This is basically like I want to go to ABC hospital. You are telling no, I only know DCF hospital. Na kekradhu solla. Yes, so it is like that. If you are liable for a tax audit, you have to file your return on 31st October. If not, now you can file a belated return. You can file a belated return. Yes, your due date for filing the return is 31st October. The due date for filing a tax audit is 30th September. The due date for filing is 30th September. This is what your provisions are when it comes to tax audit. If you are not liable for tax audit, your due date for filing return becomes 31st July. 31st July. The due date will become 31st July. Yes, sir. Now we enter into 2 small provisions called presumptives. Short questions. Most likely it comes. These provisions are called presumptive taxation. We have 3 presumptives. One is 44 AD, one is 44 ADA, 44 AE. These are the 3 provisions: AD, ADA, and AE. AD starts with the provision saying that if you are into business, having a turnover of up to, where did we learn this 2 crores? We learned it in significant economic presence. Yes. So when you are into 44 AD, which is presumptive cases, your turnover should be up to 2 crores. In which case what will happen is we will mandatorily put you into presumptive. Unless you choose to opt out. If you are putting into presumptive, we will ask you simple. Tell me how much of your turnover was by permissible modes and how much of your turnover was not by permissible modes. For whatever turnover is not by permissible modes, the rate will become 8%. For whatever turnover is within permissible modes, the permissible modes, and the money is received by you by 31st July, and the money was received by you before the due date of filing of return of income, then it is 6%. If it was a permissible mode but still you received it later, it is 8%. It is still 8%. So it is 6 and 8. 6 only happens in cases 1 where you have a permissible mode and you get it within the due date of what? Return filing. For you it is 31st July. For you it is 31st July. Any other case will be 8%. Any other case will be 8%. The moment you come into this provisions, none of them will be taxable. Sorry, no deductions, no allowances, nothing. Take it on over, directly tax it. Take it on over, directly tax it. No other provisions to be looked into. Depreciation will be taken care of. Unabsorbed will also be taken care of. Any kind of partner's remuneration and all will be taken care of. Nothing will be taxable for you. Nothing will be extra considered for you. Nothing will be extra considered for you. At the same time, the advance tax due date for you will become very good. It will become 15 March. Only one quarter will be the last quarter. Last quarter is when you have to make the payment. Last quarter is the only quarter which you have to make the payment for. No other quarters do you have to make a payment for. This is for 44 AD. Coming to 44 AD, it talks about profession. Now we have to clarify first of all what is the profession. Notified. Simple examples like engineer, doctor, accountants, cinema artists, film artists, engineers. அதான் காமெடி. நாங்கள் கஷ்டப்படுறோம், ஆனால் நாங்கள் ப்ரொஃபஷனல், அவங்களும் ப்ரொஃபஷனல் தான். நாங்களும் ப்ரொஃபஷனல். நம்ம தாண்டா ப்ரொஃபஷனலே. Any kind of accountants, auditors and all those people are professionals. Engineers are also professionals. I don't know why. Yes, medical people are also professionals. All these people are also someone from science background. Sorry, okay ma. The choice that you made to come to this profession itself says it. Anyway, yes, okay. I have my personal grudges because my brother is engineer, nothing else. Yes, anyway, the point is if you are a 44 ADA case, what will happen is as a notified professional, what will happen is they will take your gross receipts. They will take your gross receipts and directly tax 50%. Directly take 50%. Now understand the 6%, 8%, 50% is not your tax liability, it is your PGBP income. It is your PGBP income. So the revenue 50% will be treated as your PGBP income. You will add it to your normal heads of income and then you will do the taxes. Then you will do the taxes. 44 AD, அப்படியே copy paste for 44 AD. ADA copy pasted for 44 AD. Comes to 44 AE. Comes to 44 AE, talks about transport business. Talks about transport business. Basically they're coming and saying that you should be a person who's having a transport business with vehicles not more than 10 vehicles at any day during the previous year. 10 vehicles at any day during the previous year. ஒரு நாளுக்கு 10 vehicles க்கு மேல போக கூடாது. In that case you will not be eligible. If it is anything less than 10, anything which is 10 vehicles and less, anything which is 10 vehicles and less, in that case you will be eligible for 44 AE. 44 AD, 44 AE comes and says you have to split into two. Heavy good vehicles, others. Heavy good vehicles and others. If you are having an heavy goods vehicles, it is 1000 per ton per month or part thereof. 1000 per ton per month or part thereof. If it is a light good vehicles, it is 7500 per month flat. 7500 per month flat or part thereof. 7500 per month flat or part thereof. How do you decide whether it's a heavy good vehicles? There should be more than 12 metric tons. It should be more than 12 metric tons. It should be more than 12 metric tons. Basically, it should be more than 12,000 kilos. It should be more than 12,000 kilos. Clear? Yes, this is your end of 44 AE. In the middle, we left off one provision. I kept it in the last purposely. It's talking about firms. Talks about partnership firms. As such, never comes in exam very likely. As such, never comes in exam very likely. But once or twice it has been tested, so I am giving it to you. The provisions are about firms. The provisions are about firms, where they have come and clarified that any kind of remuneration which a firm earns will be taxable under PGBP. Will be taxable under PGBP. You have to split it into two. One is salaries, the second is interest. One is salary, second is interest. When it comes to interest, they have come and told us any kind of loan which you take. Who takes? Partner. Any kind of loan which the partner gives to the firm. Any kind of loan which the partner gives to a firm will not be covered here. It is only talking about interest and capital. Loan. Loan சொல்லவே இல்லையா நான். பிராக்கெட்ல கேபிட்டல் கரண்ட் மட்டும் தான் இருக்கு. My book will not match with yours. Any kind of interest which is received by a partner, the logic is very simple here. The provisions come and say to the extent the amount is allowable in the hands of partner, to the extent the amount is allowable in the hands of partner will be offered as tax by partner and will be claimed by the firm. To the extent the amount is not allowable in the hands of the firm, the partner will also become exempt from taxes. The partner will also become exempt from taxes. So coming to the interest part, they are coming and saying up to 12% of the amount given. Up to 12% of the amount given can be claimed as an income in the hands of partner, expense in the hands of firm. If it is anything beyond 12%, partner will take a exemption, firm will take a disallowance. Firm will take a disallowance. This is coming for interest. This is for interest. Coming to remuneration. They have basically given conditions. First of all is that salary should be given only to person who takes efforts, meaning working partner. The first provision is that salary should only pay to a working partner. Second provision is that if you are paying salary to a working partner, it should be prescribed in the deed. It should be prescribed in the partnership deed. If you are prescribing in the partnership deed, it is only being retrospective or prospective. It should only be prospective. If it is an interest, if it is a remuneration given prospectively only, you can claim a deduction. Retrospective will also be disallowed. 3 conditions for you. You should give it to a working partner. You should give it through a deed. Deed should be prospective. How much is the remuneration which you can give? You will calculate book profits. What does book profits mean? Book profits basically mean the whole PGBP income for you except for this salary. The whole PGBP income for you except for this salary. Since you are computing the whole PGBP, you have to also reduce your unabsorbed depreciation because that forms part of your PGBP. So you have to compute your full PGBP ignoring the partner's salary and allowing unabsorbed depreciation. You will arrive at a book profit. In that book profit, for the first 3 lakh rupees, 90% of the book profits or 1,50,000, whichever is higher, you should not do it lower, whichever is higher, because if it's a loss case, you can minimum give 1,50,000. With the loss case, you can minimum give 1,50,000. So it is 90% of the book profits or 1,50,000, whichever is higher. 1,50,000 is per partner or per firm? For the whole firm, it is not for the partners alone. It is 1,50,000 for the whole firm, which means partner have to split that 1,50,000. Partners will have to split that 1,50,000. For any profits which is beyond 3 lakh rupees, it is 60% of the book profits. For any profits which is beyond 3 lakh rupees, it is 60% of the book profits. Same slab rate model. So you have to prepare 3 lakh slab and then beyond 3 lakh slab, 90%, 60%, 1,50,000, 0. Yes, you have to prepare that, arrive at that amount which you can claim. That amount will be compared with your actual salary, whichever is lower will be claimed as a deduction. With this ends your PGBP. A word of caution when you are doing your sums. Clarification number 1. When you approach your sum, identify the person, identify the status, understand what is the requirement of the question. Step number 1. Step number 2, look at your P&L. Always start from the right side. The first thing on the right side, if it is in direct P&L, they will give you the gross receipts. Now, because you are an individual, you can either have a gross receipt from a business or from a profession. Why are you looking at the gross receipts? Is because gross receipts will help you tell you whether you have to opt for presumptive or not opt for presumptive, because presumptive itself is silent adjustment. Correct? So you will look at the right side of the P&L, you will find the gross receipts. If the gross receipts is anything less than 50 lakhs or 2 crores, you have to also check for presumptive and also check for normal. If it is anything beyond that, you will ignore presumptive and directly do normal. This is the first tool which you have to have. Come to the left side of the chart, left side of the P&L, look at your expenses one by one. As you find any kind of expenses like kind of penalties, any kind of taxes, all that has to be disallowed. Then you will go into additional information, look at your additional information, look at the item which is there in the additional information, and then go back to the P&L and then understand which ones are targeted there. Because sometimes an additional information can be targeted in more than one place. For example, a motor vehicle case will be targeted in 4 places. Cost maintenance interest everything will take a hit. So we have to look at one adjustment and then go back to the P&L and understand which of the things will be impacted there. And then you can make a note there. Say that it is point number 1, point number 2, whatever it is, and then go and approach the question. Make it a little more clearer. Do not haphazardly go. Because suddenly you will go to the P&L, you won't find something, you go to the additional information, there will be some other information. Yes, so go a little structured when it comes to PGBP questions, because that's the most important thing with you. Clear?
Yes, sir.
Yeah. The last thing which I wanted to clarify to you is, if the question comes and says that there is an income tax refund which is right side of the P&L, any kind of income tax refund which is on the right side of P&L, additional information will 100% come and tell you that the income tax refund comprises of 2 components. One is the interest and the next one is the refund. In that case, what you have to do is, first of all, P&L in the mottama thookidu. take away the whole thing from the P&L. Now you will look at your P&L, you will have an income tax refund of 100, for example. If the income tax refund is 100, remove the full 100 off. Then look at the additional information. If the additional information comes and says that the tax is 80 and the interest is 20, tax was something which you paid and got back. Tax is something which you paid and got back. That is something nothing but a principal repayment. That should not be taxed. 20 alone will go to IFOS. 20 alone will be taxable under IFOS. Clear? Let's take a break.
என்ன கன்வீனியன்ட் இருக்கோ பார்த்துக்கோ. Yes. For the people on the back and all, should I reduce my speed or something? இல்லை நீ பாட்டுக்கு பேசின்னு இருக்கேன் நாங்கள் கேட்டுருக்கோம் அந்த மாதிரி இருக்கேன். I'll try to keep it a little slow. I don't know. Someone on the YouTube has already raised a concern saying I'm talking a little too fast. But then, yeah, at the end of the day, that's how you have to read, right? There's no other options. 0.25, yeah. Anyway, yes. Last two heads of income before we break for a lunch. Yes, last two heads of income, we have exactly 1 hour to go, right? Exactly 1 hour to go, 2 heads of income, tana pogum. Yes, I am skipping one part of the provisions called 43 CA here because we'll discuss it along with the IFOS chapter. We'll discuss it along with the IFOS chapter, so I'm not doing it right now. Coming to the next head of income called capital gains. In my material, you will find capital gains into 3 different chapters. Yes, my material capital gains has been split into 3 different chapters. One is this capital gains, one is the taxation of distribution of owners, and then reorganization. Yes, the next 2 chapters are not relevant for exam. Yes, so we'll be doing, there's only one slum sale alone will be relevant for your exam, but as such, capital gains is what we're going to discuss right now. Again, the most logical chapter, and then hardly then some 5 provisions which come for exam. Other than nothing comes for exam also. So we'll read just this 5 provisions for your exam. And just to clarify, the biggest amendment of this chapter has been taken away from your syllabus. The biggest amendment for someone else wants to come and take a marathon? Guys, we have till 5. If you don't want to stay till 8, silence. Yes, I have to go outside. I have plans. Anyway, coming out, we are into the capital gains chapter. We have split this chapter into 3, but we are going to go into the first chapter right now, which talks about capital gains. Yes, the provisions are like this. They have basically come and said that any kind of transfer of a capital asset will be taxable under this head in the year in which the transfer takes place. This is what the basic definition of this charging section is. But then here also they have come and given some exceptions. The first thing is you have to understand what is a capital asset. First thing they're coming and telling is capital asset basically means every asset. Other than the asset of stock in trade, because that is taxable under PGBP. Apart from that, they have come and told that, boss, if you are doing any kind of immovable property, that is a capital asset. If you are doing any kind of immovable property, that is a capital asset. If you are doing any kind of movable property, I will come and ask you 2 questions. Tell me whether it is business or personal. If you tell it's business, it is capital asset. If you tell me it is personal, again I will ask you, there are certain kind of exceptions where I want it to be a capital asset. There are certain kind of exceptions where I don't want it to be a capital asset. These are called, my terms, BA pass. In my terms, it is called BA pass DJ. Basically, bullions, archaeological sculptures, paintings, art forms, securities, shares, drawings and jewelry. Yes, these are your BA pass. These are your BA pass DJ. If you are in these assets, this will also be classified as a capital asset, even if it is personal. Any other assets will always be classified as not taxable itself. Which means basically if you try to sell your personal car, not taxable. If you try to sell your personal iPhone, the personal iPhone has a diamond inside it. To the extent of the taxable diamond, that's how it will work. Yes, so any kind of BA pass DJ items will be fully taxable, but other than that it will become not taxable. This is what the provisions are. So this is the summary chart of it. It basically comes and says you have a property split into 2, immobile and movable property. Immobile property is always a capital asset. Mobile property, if it is a personal thing, BA pass DJ capital asset, non-BA pass DJ exempt from taxes. As much as that is there, they have also clarified that if you have an immobile property in the form of a land, if it is in rural agricultural land, it is exempt from taxes. Urban agricultural land fully taxable. Rural agricultural land they have split and so that we are doing based on population. They told do one thing, stand on the municipal board. Go to the border. From the border you go for 2 kilometers.
From the border you go for 2 kilometers. Up to 2 kilometers, if the population is 10,000 or less, it is called as in rural land. If it is less than 10,000, it is rural land. Go from 2 kilometers to 6 kilometers. If the population is still less than 1 lakh rupees, rural. If you go for a little beyond 8 kilometers, 10 lakhs. If it goes beyond 8 kilometers, it's always rural. It is always rural. This is how the table looks like. 2 kilometers variko 10,000, 2 kilometers to 6 kilometers it is 1 lakh, 6 kilometers ka mela pona 8 kilometers variko 10 lakhs, 8 kilometers ka mela pona always rural, always rural. This is what your capital asset is. With the capital asset coming into picture, you have to now split the capital asset into two. One is called as a long-term capital asset, second thing is called as a short-term capital asset. How do you decide that? It is decided based on the period of holding. It is decided based on the period of holding. How they have told us that if it is a listed security, the period of holding will be 12 months. Listed security, period of holding will be 12 months. Any kind of equity oriented fund, 12 months. Any kind of equity oriented fund, 12 months. Any kind of UTIs, UTIs is Union Trust of India, 12 months. Any kind of zero coupon bonds will also be 12 months. Apart from that, if you have an immovable property or an unlisted security, that will be 24 months. Adu thavara irukadha ella case will be 36. Adu thavara irukadha ella case will be 36. Slum sale will fall under 36. Slum sale will fall under 36 months. Business trust will fall under 36 months, final level portion. 36 months and a final level portion. Anyway, for you, slum sale is what is there as a 36 months criteria. Yes, if you satisfy the 12 months criteria, you will be treated as a long term asset. If you don't satisfy that, you will be treated as a short term asset. Starting with that, we have come and told that we have to define what is a transfer. Transfer definition not relevant for exam, ignored and leave. Transfer definition ignored and leave, not relevant for your examination. We have now been discussing the charging section, which comes and says it is taxable in the year in which the transfer takes place, but there are certain exceptions to it. There are certain exceptions to it. The first thing which we have given as an exception is insurance compensation. First exception is insurance compensation. This provision basically comes and says that if you have any kind of insurance compensation received for the destruction of a capital asset, if you receive any kind of compensation for the destruction of a capital asset, it is taxable only in the year in which you receive the compensation. It is taxable in the year in which you receive the compensation, but the tax has to be computed in the year in which the asset was destroyed. The asset was destroyed in 19, but the compensation received in 22, taxable in 22 using indexation of 19. Using indexation of 19. This is what is the first provision for an insurance compensation. The second thing which they have come and told is conversion of capital asset into stock in trade. Conversion of capital asset into stock in trade. This conversion of capital asset into stock in trade, they have basically come and said that if you have any kind of capital asset which is converted into stock in trade, it will be taxable in the year in which the stock in trade is sold. It will be taxable in the year in which the stock in trade is sold, but the taxability will be computed in the year in which the conversion takes place. The conversion takes place. That is the year in which it will be taxed. Taxability, sale value will be determined based on fair market value. Basically what is happening is one capital asset converted into stock in trade. Capital asset sold to the market, bought a stock. The same capital asset has been sold to the market and bought a stock. So sale value of the capital asset will be called as fair market value, which will become the FVOC. That will become the cost of acquisition for the stock in trade, and then you will sell the stock in trade and tax it in the year in which the sale of the stock in trade happened. Sale of the stock in trade happened, but the reverse scenario is not true. The reverse scenario is what? Stock in trade into capital asset. Stock in trade, conversion of stock in trade into capital asset. The provisions will be the same. The provisions will be the same, that the sale value will become the fair market value and the cost of also will become the fair market value. But the only problem here is that they have come and clarified that PGBP will be taxable in the year of conversion, capital asset will be taxable in the year of capital gains. So you go from capital gains to stock in trade, taxable together. You go from stock in trade to capital asset, taxable respectively. Taxable respectively. This was the second part of the provisions. The third one is what has been scrapped from your material called ULIPs. Third one has been scrapped from a material called ULIPs. It is brought as a final level portion. In case my old materials have it, please delete it off. In case my old material have it, please delete it off. You are clearing this attempt, no other options. Yes, in the attempt it is applicable illa. Adutha attempt ku enakku theriyadu. Yes, in the attempt it is applicable illa. In the attempt la mudichi kodukano. Yes, with the ULIPs getting done, we are next into compulsory acquisition. We are next into compulsory acquisition. This is basically a case where the asset has been compulsorily acquired by the government. Compulsorily acquired by the government. The provisions are basically like this. The taxability will happen in the year of compulsory acquisition. Taxability will happen in the year of compulsory acquisition, but the tax will be collected in the year in which the first installment is received. The tax will be collected in the year in which the first installment is received. But if you receive any kind of enhanced compensation, if you receive any kind of enhanced compensation, what will happen is they will ask you two questions. Tell me whether you received it by way of interim order or by way of final order. If you received it by way of interim order, I will tax it only in the year in which the final order is received. But if you receive it by way of final order, I will tax it in the year in which I receive it. Tax it in the year in which I receive it. At the same time, they have come and clarified that if you get any kind of interest on this enhanced compensation, you will be eligible for flat 50% exemption under IFOS. You will be eligible for a flat 50% exemption under IFOS. Yes, yes. And the next last part of the provisions are basically your JDAs. Last part of the provisions are your JDA, specified agreements, not relevant for exam, ignored. Not relevant for exam, ignored. So with this, your exceptions also get over. With this, your exemptions also get over. Now we have to look at those cases which are not even taxable. Look at those cases which are not even taxable. This is covered under section 47. This is covered under section 47, which basically comes and clarifies that if you are taking a transaction which I tell you, if you undertake a transaction which I tell you, it might have been taxable. It might have been taxable, but I am giving you a special exemption. First scenario they have told is gift. First scenario they have told is gift. Any kind of transfer which you do in the form of a gift will not be taxable in the hands of the transferor. Will not be taxable in the hands of transferor. In the hands of transferee, what will happen? Cost will become the cost of the previous owner. Period of holding will become period of holding of previous owner. Period of holding will become period of holding of previous owner. This is the first thing. Second, any kind of transfer by way of partition of HF. Any kind of transfer by way of partition of HF again will not be taxable. For the new owners, it will be the cost of the HUF. For the period of holding will also be period of holding of the HF. Other than nothing else is important except for the last scenario which talks about reverse mortgage. This reverse mortgage basically comes and says any kind of transfer which you have done on account of a reverse mortgage. Any kind of transfer you have done on account of reverse mortgage will also not be taxable in the hands of transferor, but yes, if you do any kind of transfer by a senior citizen, if any transfer happens by way of senior citizen, that is exempt from taxes. Any money which a senior citizen receives will be fully exempt from taxes. Any kind of transfer she does to the bank will be fully not regarded as transfer. When will the taxability arise is the case where she defaults. In case the senior citizen defaults the payment, bank will do what? Bank will take your house, sell it for you. Bank will take the house, sell it for you, and then recover the money from it. Now, when the bank sells your house, it is deemed as you are the transferor. It is deemed that you are the transferor. Capital gains will be computed on you on that day, and then you will pay tax on the full money. From that revenue, the bank will take off your salary, loan amount. Bank will take off your loan amount. These are the three transfers which are important, which are not taxable as transfers. In all cases where it is not taxable as transfer, cost will be the cost to the previous owner. Period of holding will be period of holding of previous owner. This only applies in cases where the transfer is not taxable. Meaning, for example, if even though gift is not taxable under capital gains, but you got it taxed under IFOS, what will happen? The cost will now become the IFOS income. The period of holding will also start from the date on which the transfer happened. So the provisions of your cost of acquisition and the period of holding will apply from the previous owner only in cases where the taxability is 0. How do we remember this? I have prepared a chart. We'll do it in IFOS chapter. With this, a transfer is also done for you. Exceptions is also done for you. Special scenarios is also done for you. Left off is all your some small scenarios. Before that, we have to understand the definition of a cost of acquisition, cost of improvement. You have to understand the definition of cost of acquisition and cost of improvement. They are basically coming and giving some scenarios. Scenario number 1 is where they are telling the cost of acquisition. The property was taken before 1st April 2001. What will you do? You will take FMV as on 1st April 2001 or the actual cost, whichever is higher, whichever is beneficial to the assessee, therefore whichever is higher. But if this property was nothing but an immovable property, you cannot take FMV as on 1st April 2001. You will have to compare that with SDV and take whichever is lower. So it is FMV or SDV whichever is lower compared with the cost whichever is higher. Then if you do a transfer of a bonus share, cost will be FMV adu epdima. If it's a bonus share, cost is 0. But yes, if the bonus share was taken before 1st April 2001, then in that case you will compare. Yes, bonus shares order cost is also 0 for you. If you have any right shares, cost of yours will become the price which you pay to the company. But if you got it by way of renunciation, what will happen? It will be the price which you pay to the company plus the renunciation price, Coming to the other side of the person who's transferring the rights. The person who is transferring the right. Let's say you get a right shares or a right, you are transferring it to someone else. For you, the sale value is the renunciation price. Cost is nothing. Cost is 0. Therefore, it will become full capital gains for you. It will become fully capital gains for you. Other than that, do you have any cost of acquisition to remember? No. Nothing to be done. Yes. Next, coming to the cost of improvement. Here they have come and done a little different. Here they have told a little different. If the improvement happened before 1st April 2001, it will be fully ignored. But if it has happened after 1st April 2001, you can consider the same cost of improvement. If it is for a previous owner, you can also consider the previous owner. There is no problem. Here is where I will have to clarify to you that when it comes to an STT, what is it? Securities Transaction Tax. Any STT paid on the time of cost of acquisition or at the time of sale, both will be ignored. Why are both being ignored? Because you are getting special exemption under 112A. Getting a special exemption under 112A, the rate has become 10% for you. Instead of you taxing it at 20%, now you are taxing it at 10%, therefore no benefit for you. Clear? Yes? While we started, I told every chapter has its own format. So let's understand the format. The format is like this. You have to start from full value of consideration. Allow for your cost of transfer. You will get net consideration. You will have to reduce first the cost of acquisition in case of short term, cost of indexed acquisition in case of long term, cost of improvement, indexed cost of improvement. You will arrive at your gross short term or gross long term. From that you will allow your exemptions and you will arrive at your capital gains. Yes, so we have completed what is the full value of consideration, we have completed what is the cost of transfer, we have completed what is cost of acquisition, we have completed what is cost of improvement. What is pending is indexed cost of acquisition and indexed cost of improvement. The provisions are basically coming and saying if you have a long term asset which is not covered under 112A, other cases if you have a long term asset, you will also be eligible for an inflation. This is called as an indexed cost of acquisition. The computation works like this. It is cost of acquisition into CII in the year of transfer divided by CII in the year of acquisition. How do you remember? Numerator has to be higher than the denominator. You want the cost to increase or decrease? Increase. If you want the cost to increase, the numerator has to increase. Yes. So the cost of the transfer will be the first divided by the CII in the year of first held by the assessee. And not the previous owner. Unless and until you are following Manjulasha. Yes. For your exam, you have to only remember one CII. 317. The only one thing you have to remember is 317 and FI 21-22, which is 100. FI 2001 and 2002. FI 2001 and 2, which is 100. So two CIIs to remember, 317 and 100. 317 is an amendment, 100 is always there. You want to know the next years? No, I can tell you. Not required. Okay. So you will have to remember 317 and then you will have to remember 100. Every other CII will already be given to you in the exam. So this is the CII to remember. Here is where I will have to clarify. That the denominator has to be CII in the year in which it is first held by the assessee, which means the current assessee. Let's say an example where you are talking about a 47 case. Which is a transaction not regarded as transfer, gift case. In a gift case, what will happen is your period of holding is from the previous owner. Your cost is also from the previous owner. In which case, should you take the indexation from the previous owner? No. For your ICA exams, you have to take it from the current owner. If you want to do it from the previous owner, you have to take 2 minutes of additional time and write an extra note saying that you are opting for Manjulasha's case. CIT versus Manjula. You want the number also? Yeah, you are opting for the Manjulasha's case. Yes, you have to remember the whole additional information and you have to give the whole additional information on the bottom. You have to give the additional information saying, I am opting for indexation on the previous owner on the basis of the decision of Manjulasha. If you want to spend that extra 2 minutes, go ahead. If not, follow what ICI does. ICI will do in the year in which it is first held by the current owner. They will not go to the previous owner. Both the answers are right. I am not saying anything else. But if you are writing the other option, you have to give additional note. You don't have time for it. Yes, no? Yes, sir. Yeah, you don't have time. Every minute is precious for you. Yes. So nothing is important. Everything is important for you. Every time is important for you. Yes. Everything has to be done properly. Clear? Yes, so the only thing you have to remember is CIA in the year of transfer divided by CIA in the year in which it is first held by the assessee. With this, your cost of acquisition and indexed cost of acquisition is also done. Cost of improvement and indexed cost of improvement is also done. You have completed gross long term and gross short term. Now we have to come into exemptions. We are into only 3 exemptions for exam. We are only 3 exemptions in exam. Section number 54, 54 EC, 54F. Let's complete the EC because it's easy. Let's complete the EC because it is easy. Yes. Shall we? Yes. We are completing 54 EC first as an easy part. We are completing 54 EC first because it's easy. Yes. So 54 EC basically comes and says that you should transfer any kind of immovable property. You should transfer any kind of immovable property, which should be a land or a building. If you transfer an immovable property and the asset which you have acquired is an NHAI asset or an REC asset, you should either acquire an NHAI bond or an REC bond or any other notified bonds In that case, what will happen is they will give you an exemption of your capital gains. They will give you as an exemption of your capital gains to the extent you invest. If your capital gains was 50 lakhs and you invest 40 lakhs, you will get exemption of 40 lakhs. If you have in capital gains of 50 lakhs, you invested 60 lakhs. So 54 EC has a second condition which comes and clarifies that you can claim a maximum of 50 lakhs per asset per annum. You can claim 50 lakhs per asset per annum. The full year you can only claim 50 lakhs. If you are doing it spread over the next 2 years also, still you can only claim per asset 50 lakhs only. So it is 50 lakhs per asset per annum. But the condition is that the investment should happen within a period of 6 months from the date of transfer. It should happen within the period of 6 months from the date of transfer. If it happens beyond 6 months, then it is not eligible. And it is 6 months from the date of transfer, not 6 months from the end of the financial year. It is 6 months from the date of transfer. And the next condition which they have given is if you are taking this property, you should hold it for a period of 5 years. If you are not holding it for a period of 5 years, what will happen is whatever exemption you claim will be reduced from your cost of acquisition. While doing your capital gains. Very good. There are 2 different assets here. The first asset was an immovable property. The second asset was in bonds. They do not have comparability. So what you do is whatever exemption you claimed earlier will become taxable subsequently, and whatever asset you had individually will become taxable separately. Basically, what exemption you claimed earlier, bring it and tax it now. Bonds anyway will be separately taxable. Now coming into the 2 common provisions, which is 54 and 54F. 54 and 54F both talk about the same thing. They are coming and saying that you should acquire a residential house property. Both are talking the same thing. You should acquire a residential house property. The only difference is 54 comes and says the transfer also should be a house property. 54F comes and says transfer anything other than house property. Both will tell you to acquire the same property, but 54 will come and say you to transfer a house property also. 54F will come and say acquire anything other than a transfer anything other than a house property. The second line of difference which comes here is that 54 comes and says that you will get an exemption of the capital gains if you invest capital gains. You will get an exemption of capital gains if you invest capital gains. 54F comes and says you will get an exemption of capital gains if you invest net consideration. So if your net consideration is 100, your capital gains is 50, you have to invest 100 to claim 50. If you only invest 80, you will get 40. Pro rata. Yes, if you invest 100, you will get 50. If you invest 80, you will get 40. If you invest 60, you will get 30, etc., etc. But when it comes to 54, if you have to get 50, you have to invest 50. You have to get 50, you have to invest 50. So 54F only talks about depositing net consideration. 54 and 54 EC talks about depositing the gains. With this provision in mind, what they have come and told is you have to acquire a residential house property in 54 and 54F. 54F comes and says you can acquire a residential house property. 54 comes and says you can also acquire 2 residential house properties, provided that the gains is less than 2 crores. Provided that the gains is up to 2 crores. If the gains is up to 2 crores, then you can acquire 2 properties also. But this option can be availed only once in your lifetime. It can only be availed once in your lifetime. Beyond that, you will never be able to do it again. The consideration is like this. You have to acquire the property 1 year back, 2 years forward. Meaning, if you are purchasing it 1 year prior to transfer, 2 years post your transfer. If you are constructing, you can start whenever you want. If you are constructing, you can start whenever you want, but you should complete the property within 3 years. You should complete the property within 3 years. But here, what you have done is you have violated the conditions. You violated the conditions because you have to hold this asset for a period of 2 years. 3 years. You have to hold the property for 3 years. 54, 54F both are 3 years. You have to hold the new residential house property for 3 years. If you do not do it, is where the second difference comes in. They are coming and saying in 54 what will happen? You will reduce the exemption from the new assets cost of us. You will reduce it from the new assets cost. But when it comes to 54F, they are coming and saying two different assets. So whatever exemption you claimed earlier, tax it today. New asset you transfer, tax it today. New asset you transfer, tax it today. 54F has an additional condition also which comes and says that you, at the time of purchasing the house, you should not have more than one house. Which means after you get this house, maximum you should have only 2 houses. Maximum you should only have 2 houses. These are the 3 exemptions which are there in your exams. At the Tavara in your material, you will find something called 54B and 54D. 54B and 54D, it generally does not come for exam, so I will ask you to ignore it and go. Just in case your luck is bad, someone is not happy in their life and they have given you a wrong question paper, do not worry about it. It's very simple, you have to use your head. Look at the provisions. In the provisions, if you see a question where the question basically comes and says that someone has transferred a lot of assets. And has acquired a lot of assets. Why is he transferring and acquiring? Exemption kaga. So what you'll do is ignore everything, whatever is the cost of the new assets, abdiye potu exemption close pannida mudinju pochu. Yes, let's say for example that the question comes and says that there is an industrial undertaking which has been sold. Okay, if you have sold the industrial undertaking for 100 crores and you have got a capital gains of 12 crores. You see the question, second part of the question comes and says he's also acquired new properties. Why on earth will someone sell and acquire? In a capital gains question, generally acquisition will only happen for exemptions. In a capital gains question, you will only see transfers happening. You will never see an acquisition happening. If you see an acquisition happening, the intention is to give exemptions. So you look at the exemption. No? If the exemption is for house property, it is 54 or 54F. If it is an NHCI bond, it is 54 EC. If it is anything else, it is directly, don't look up at the section. You anyway don't know the section. Take the number, directly put it as exemption, close the answer. Full marks vandrum. Don't use your head anywhere. Not required. Okay, namakku irukadhu moole ivlo dhaan irukku. Yes, we have only this much of head. We cannot remember everything. Yes, so what is 54B and 54D? I am not going to tell you because it is not relevant. Yes, look at your paper, you see and sell, you see an acquisition. Acquisition irukadhu, whatever is the price, directly put it as an exemption, close the answer. 99% it will be right. 99% it will be right. That 1% he would have played with you. That either way, if you remember also, you would have not got the right answer. No one cares. Yes, that 1%, no matter how much you try, you would have not got the right answer. So, you padichittu ponalo enna, you padikla ponalo enna, who do cares? Yes, so adanal you have a lot of better provisions to remember. Adu nyamam vachippo idu venam. Yes, these are your 5 exemptions: 54, 54F, 54EC, 2 miscellaneous for you to take care. 2 miscellaneous for you to take care. Whatever is the cost of acquisition, directly taken, tax it off, close enough. Clear? With this, the exemption is also done. 2 special provisions which you have to remember for the purpose of your sale. Two special provisions you have to remember for the purpose of sales. First special provision is called your forfeiture. The provisions basically come and say that if there is an asset which you try to sell, for which you got an income, for that income what you did? You got an advance, and for some reason you forfeited the advance. I will ask you one question. Tell me, when did you do the forfeiture? If you tell me that you done the forfeiture before 1st April 2014. If you have done the forfeiture before 1st April 2014, I will reduce it from your cost of acquisition. Before indexation, after indexation? Before indexation. Take your cost to reduce this forfeiture and then compute your indexed cost of acquisition. If you have told me that no, it is after 1st April 14, I will say very good. Ignore the thing. Because if it is only a forfeiture in the current year, you will tax it in IFOS. If it is any forfeiture of the past year, it is an ignored information. But again, next thing to clarify is when you are doing an advance forfeiture, it will be reduced from your cost of acquisition only if you were the one who did the forfeiture. If the forfeiture was done by a previous owner, that also will be ignored, which means it's a free profit for everyone. In case you did not understand, there is one example here, page number 94. Okay, there is an example in this page number 94. In this example, you will understand how this works. Okay, what you have to do is you have to do a forfeiture, check if the forfeiture is happening before 14 or after 14. If it is happening before 14, check whether it is done by you or someone else. If it is done by someone else, fully ignored. If it is done by you, it is reduced from the cost. If it is done after 2014, tax it in the year of receipt, in the year of IFOS, in the head of IFOS. This is the first special provision. Second special provision is section 50C, and the section 50C is the utmost important thing. There has never been an exam paper without 50C. There has never been an exam paper without 50C. Talks about transfer of an immobile property. Talks about transfer of an immobile property. This provision basically comes and says that if you have an immobile property, you have to ensure that you transfer the immobile property at least at stamp duty value, in which case you will get the actual consideration. But if you unfortunately transfer it at lesser than stamp duty value, SDV will be deemed to be the full value of consideration. SDV will be deemed to be the full value of consideration for you. Yes, in this 2 questions to answer, which SDV to take? There are 2 types of SDVs: on the date of agreement, on the date of registration. You can take the SDV on the date of registration normally, but you can also take the agreement provided you get token money, and the token money should be received by permissible modes. You satisfy both the conditions, you will get the SDV on the date of agreement itself and not the date of registration, Provision number 1, second provision Amarandra. The safe harbor rules basically come and say that normally SDV will become your full value of consideration, but yes, if there is a provision where SDV is within 110% of your consideration, in which case what will happen, you can still consider your actual and ignore the SDV. If it is within 110% of your consideration. So take your consideration as 100. If the SDV is up to 110 rupees, you will still consider your full value of consideration as 100. If it is anything beyond 110 rupees, it will become SDV. This provision, take just like that and copy paste into PGBP as 43 CA, which talks about transfer of immobile property as stock in trade. Yes, same provision of 50C copy pasted into 43 CA talks about stock in trade. So if you are having an immobile property, it will be 50C. If you have a stock in trade, it will be a 43 CA. For your exam, there is one small amendment in this, and only for your exam. Next exam, it is not there also. Yes, the only one thing which you have for your attempt is that they have come and said that in the quarter 1 of your exam, quarter 1 of your previous year. What is quarter 1 of your previous year? April to June. Which year? 21. If you have any kind of transfer of any kind of residential unit, which happens in quarter 1 of your year, the 110% will become 120%. Provided the consideration is less than, where did you learn 2 crores? Presumptive and SEP, one of the favorite numbers for income tax. You will do the transfer less than 2 crores. If the transfer is less than, one more place. 54. Yes, if you do the transfer less than 2 crores, then what will happen? You will be treating that 110% as 120% for the transferor. Who is the transferor? The person who is holding it as stock in trade, which means it should be some person who is creating residential units. Real estate developers who's creating residential units. If they transfer the property for anything up to 120% of the consideration during quarter 1 of that 2021, they will still be not taxable to the highest number. The actual value will still continue. If you close this exam, it is not there in the next attempt. It's only for quarter 1. So it's not there in the next attempt. This attempt is all that is there. So this can only be tested as an MCQ question for you. Other than nothing is going to come. Yes, it's an MCQ question for you, and that too it's from stock in trade perspective. So it's on pure MCQ question with no hindsights to it. Yes, this is the second provision. With this being done, I wanted to clarify one more thing in HP chapter also. There is something called as holding of an house property as a stock in trade. Where the provisions are basically coming and saying, if you hold a property as a stock in trade, it is generally taxable under PGBP. generally taxable under PGBP. But if you're taking the stock in trade and you're giving it to someone on rent, if you're giving it to someone on rent, it will be taxable under HP only. Even though you hold the asset as stock in trade, it will still be taxable under HP. But suppose you are not able to sell the stock. Suppose you are not able to sell the stock for the first 2 years from the end of the financial year. For the first 2 years from the end of the financial year, the properties will still be considered not taxable. The properties will still be considered not taxable, but after 2 years, it will be deemed LOP. It will be deemed LOP under HP chapter. It will be deemed LOP under HP chapter. The provisions are, it should be an house property held as stock in trade. House property held as stock in trade, unsold with you. Unsold with you. If you take it for within a period of 2 years from the end of the financial year, no taxability. If you still keep it with you after 2 years, then in that case, it will become fully taxable as DLOP. It will become fully taxable as DLOP. Completing this chapter with the last thing called tax rates. Completing this chapter with the last thing called tax rates. We are into the 4 capital gains. LTCG under 112A, LTCG under 112, STCG under 111A, STCG others. STCG others I am not discussing. You want me to discuss? There is no provision only. There is no provision only. Coming together, combining 2, there is called as LTCG 112A, STCG 111A. Combining 2, the provisions are like this. They have basically come and said you should earn income from a share market. You should earn income from a share market. Basically, they are coming and saying it should be a transfer of a which share? Equity share. It should be transfer of an equity share, equity oriented fund or a business trust. Equity share, equity oriented fund or a business trust. In which case, what will happen is, I will check whether you have paid STT on them or not. I will check if you have paid STT on them or not. In case you have paid STT on them, then these will be taxable under 112A and 111A at the rate of 10% in excess of 1 lakh, 15%. 10% in excess of 1 lakh or 15%. Rebates are not eligible for 112A, eligible for 111A. Can you set off both against basic exemption limit? Only for resident individuals. Only for resident individuals. Others will not get any kind of benefits on this. Yes. The next special provision under 112A is where they have clarified that there is a special cost of acquisition concept. There is a special cost of acquisition concept where they are coming and saying is, sir, I will ask you one question. Have you transferred this have you acquired this property before January 2018? I'm sorry, before February 2018. If you have acquired this property before February 2018. If you tell me no, I will tell you good, then you take the actual cost. Then you take the actual cost. But if you tell me no, I have acquired this property before January 2018, I have a special provision for you. This special provision basically comes and says this, you have to recompute your cost of acquisition. How will you recompute your cost is, you will take the sale value of the asset and compare it with the fair market value on January 2018. You will take the sale value of the asset, compare it with the fair market value as on January 2018, whichever is lower, that will be compared with your actual cost, whichever is higher. This will become your new cost of acquisition only for the purpose of 112A, and if the asset is acquired before February 2018. Read the provision. Take 1 minute of your time. Yes, what is the cost of acquisition provisions? If you have acquired the asset before February 2018, you have to do sale value or FMV, whichever is lower, compare with the actual cost, whichever is higher. That will become your new cost of acquisition. Now, in this case, the provision is to understand what is the FMV. They have basically come and told FMV basically means the highest value on the date. The highest value at which the share is quoting as on that day. Highest value which the share is quoting as on that day. But if it is a mutual fund and all, then it will be NAV. If it is a mutual fund, it will be NAV. That is all the provisions which you have to remember for 112A and 111A. With that done, the 112. The provisions basically come and say any other property which is a long term but not 112A. Any other property which is long term but not 112A, I will cover it under 112. And the tax rate will be 20%. The tax rate will be 20%. The only thing which is here is that 112A will not be eligible for indexation. 111A will not be eligible for indexation. 112 will be eligible for indexation unless and until you are a non-resident. Non-resident will not be eligible for indexation, but anyway non-resident is final level portion. Okay, inter level you only have to remember 20% with indexation. 112A will be 10% in excess of 1 lakh. With this, the chapter is over. With this, the chapter is over. The next two chapters, count with me, exactly 5 minutes. Noda. Completing capital gains. Completing capital gains in the next 2 chapters, we are discussing about taxation of distribution to owners and business reorganization. We are discussing taxation of distribution to owners along with business reorganization. Here is where we have basically split, and I have basically split this chapter to come and say that there are certain provisions which are for distribution. Yes, these are the provisions which I have come and clarified. Here is where I am discussing about taxation of distribution by companies. Distribution by companies. Here the provision basically come and says, if you give any kind of distribution by companies, you will give it in the form of dividends. If you give it in the form of dividends, it will be taxable for shareholder in the hands of, in the head of IFRS, But now I am discussing about a case where there is a liquidation. I am discussing about a case where there is a liquidation. In a case of a liquidation, what happens is you had a share in your hand. And then the company was liquidated, which means your share will be taken away from you and you will be given cash with assets. Tell me, what have you received? Cash and assets. So that becomes your full value of consideration. You had purchased shares, so that will become your cost of acquisition. This is how a simple capital gains would have been computed, but they have complicated it a little bit here. They have come and clarified that what the company is going to give you is not just the repayment of your share, but also a portion of a dividend, which means basically what they have come and told us, they will take the balance sheet of the company. Check for their accumulated profits. To the extent of the accumulated profits of the shares of the company will be taxable as dividends in your hands under the head IFRS. Now, since you have already taxed it under IFRS, do you want to tax it under PGB capital gains? No. So what the provision comes and says is you have to do full value of consideration minus amount already taxed as dividends. That will become the net consideration for you. From that, you will reduce the cost of the shares and you will arrive at your liquidation. From that, you will arrive at your liquidation capital gains. This is the first distribution. Second distribution is buyback, final level portion. Full final level portion. But the only thing which you have to remember is that buyback is not taxable in the hands of the recipient, but is taxable in the hands of the companies. This is an MCQ question for you. Where they have come and told you how to tax it. They will do what? They will compute the buyback of capital gains in the hands of shareholders and tax it in the hands of companies. So what buyback capital gains shareholder would have paid, now the company is going to pay at the rate of 20% plus 12% plus 4%. 20 plus 12 plus 4 comes to around 24.296. 23.296 comes to around 23.296. Straightforward or MCQ question, nothing else complicated about it. Yes, whatever buyback which is there by the company will be directly taxed in the hands of the company at the rate of 23.296 in the capital gains, which is what buyback price minus the cost of the asset. Chapter is over. Yes, last chapter called reorganization under capital gains. This provision of reorganization of capital gains basically has 3 things. One is amalgamation, one is demerger, one is slum sale. Amalgamation not coming for exam, demerger not coming for exam. The only thing which is coming for exam is slum sale. In case you want to read amalgamation and demerger, I'll give you one line, not taxable. If a question comes in amalgamation and demerger in exam, this is not regarded as transfer, therefore not taxable, close the answer. When it is not taxable, what will you do? Cost will be cost to previous owner, period of holding will be period of. That's all. What is amalgamation, demerger? Learn in accounts, I will not teach you. Same provisions are there, nothing different. Yes, amalgamation, demerger is done for you. Left off is slum sale. Slum sale basically means come and say that you have a business with you. You have a business unit with you. You are transferring this business unit to someone else. The provisions are like this. You need for capital gains what? Consideration and cost. So they told consideration will be computed in such a manner that you will take the actual price which you receive. Or the fair market value of the asset which you transferred, whichever is higher. So you will take the actual price which you received or the fair market value of the asset which you transferred, whichever is higher. That will become your consideration. Reduce your cost of transfer. You will arrive at net consideration. Reduce your cost of acquisition. How do you understand the cost of acquisition? They are telling understand what is the net worth of the business. How do you convert net worth? Asset minus liability. Asset meaning what? All the assets which you have. So there can be fixed assets. If it is a fixed asset, it will be liable for depreciation. So therefore they want depreciation as per Income Tax Act. So fixed assets order value will be as per Income Tax Act. If it is a non-depreciable asset, same cost. Land, same cost. Yes, this is how the assets will be. If it is a current asset, same cost. If it is goodwill,
If it's a goodwill, it is 0. If it is any asset on which you claim 35 or 35 AD, 0. Yes, liabilities, what will you do? Book value, take off the book value as it is. This is your net worth. Assets minus liabilities. Assets will be fixed assets depreciated as per Income Tax Act. Non-current assets will be book value. Any other assets also book value. Liability also book value. You will arrive at the net worth. This will be your cost of acquisition. This cost of acquisition will arrive at your capital gains as long term or short term, depending on the period on which the business was started. Period on which the business was started. If the business was started 36 months back, it will be long term. If not, it is done capital gains. 6 minutes is because I gave example. Yes, 2 small chapters of IFOS, and then we are closing for a lunch. Yes, 2 small chapters. Again, IFOS chapter in your material ICI would have been only 1 chapter. In mine it is 2. The only difference is IFOS has been split into IFOS and dividends. That's the only difference. Let's understand IFOS as simple as it is. 2 lines chapter, 2 pages chapter, that's all. 2 pages chapter. I will tell you what are the incomes, you tell me whether it is taxable or not. Yes, the first income is dividends. Second income is forfeiture. After 2014, interest on enhanced compensation, 50% will be taxable. Family pension, 1/3 of the family pension or 15,000, whichever is lower. Any kind of interest on post savings, 3,500 will be exempted. 3,500 will be exempted for you. Any kind of interest on savings bank account, fully taxable here. 80 TTA, fully taxable here, or 80 TTA, 80 TTB. Interest on fixed deposits, fully taxable here, 80 TTB, fully taxable here, 80 TTB. The next 2 most important things for your exam is gift and premium. Closing the premium first quickly. This basically comes and says that if there is a company, which company? Closely held company, a private company. If there is a private limited company which issues someone's shares, at a premium, to a resident person, I will ask him one question. Tell me how much money did you collect? He says I collected 100. I will go and check the fair market value of the asset. If the fair market value of the asset turns up to be 110, then I am safe. If the fair market value ends up being 90, I should have only collected 90. I have collected 100. Who has benefited? Company has benefited. Company will pay 10 rupees tax as IFOS. So the provision comes and says if you issue something at premium, first condition, most important condition is to issue at premium. Second thing is it should issue by private limited company. Third is that it should be issued to a resident person. In that cases, what I will do is I will come and check whether the premium is higher than the FMB. If the premium ends up being higher than the FMB, then in that case I will tax the difference. When I will not tax anything. That's all. Premium is done. Coming to the last part of the provisions, which talks about gifts. 100% question. No second thought itself. 100% one shot question will come. Gifts, which is section 56 to 10. This is where they have come and told when you receive a gift, you have to split the gift into 3. First is money. Second is movable assets. Third is immovable assets. When it comes to money, they are coming and saying for the full year, how much money did you receive? If you received more than 50,000 in the current year, it will become fully taxable. If you receive anything less than 50,000, nothing is taxable. For an immovable property, they have come and told, tell me whether you have received the immovable property for 0 consideration or inadequate consideration. If you have received the asset for 0 consideration, I will check whether the SDV is more than 50,000 per property, every property. Per property. It's an immovable property, so it is per property. If the SDV of that property goes beyond 50,000, I will tax that SDV. If the SDV goes less than 50,000, ignore. But if it's an inadequate consideration, I will ask you 2 questions. First question is it beyond 50,000? Second question I'll ask you, is the consideration, is 110% of consideration less than SDV, which means SDV should be beyond 110% of consideration. If SDV ends up being more than 110% of the consideration, SDV minus the consideration which you receive will become taxable. Again, it's per property. But coming to the immovable property, first you have to understand, coming to the movable property, first you have to understand what is a movable property. It is BA pass DJ. In my short form mnemonics, it is called as BA pass DJ. Bullions, archaeological collections, paintings, any other work of art,
sculptures, shares and securities, drawings, jewelry. All these assets are called as BA pass DJ. After that, apart from that, if you have any other kind of asset, iPhones, cars, whatever stuff, everything is not taxable. If you have these kind of assets, I will ask you one question. Tell me what is the fair market value of these assets. Tell me what is the fair market value of these assets. If the fair market value of the asset minus the consideration which you received is difference more than 50,000 per property, all property, all properties. This is the second comment which came in May exam. They told around 75% of students forgot to do all property, but they ended up doing per property. Second mistake, movable assets, it is always all property. Movable assets, it's always all property. If FMV minus the difference consideration is more than 50,000, all properties together, then in that case, I will tax the whole number. If not, I will not tax the number. If not, I will not tax the number. But here is where I have given certain exceptions. Here is where I have given certain exceptions. Exception number 1, where I have told you, if you receive anything on account of death, it's called dirt mint law. It's called dirt mint law. D stands for death. Any money received on account of death, not taxable. Any money received on account of inheritance, not taxable. Any money received on account of relatives, any money which is received from a relative. Let's understand what is a relative. You have to first start from your side. First start from your side. Self. Okay. Self, siblings. Siblings or a spouse. Self, siblings, siblings or a spouse. Parents, parents or a siblings, siblings or a spouse. Parents, parents or a siblings, siblings or a spouse. Parents or a spouse is sonnama. Parents not a spouses, parents only. Yes, parent. Oh, it can be double. Yes, parents, parents or siblings, siblings or spouse, grandparents. Yes, coming down, it is your kids and their spouse. Coming to down, it's your kids and their spouse. Coming to the girl side, it is spouse. I mean, coming to the spouse side. Coming to the spouse side, it is spouse, spouse or siblings, siblings or spouse. Spouse or siblings, siblings or spouse, spouse or parents. அவங்களோட siblings is not considered. அவங்களோட siblings is not considered. Spouse ஓட grandparents are also considered. Spouse ஓட kids, your kids. Yes, spouse ஓட kids are also your kids. This is how the chart looks like. This is how the image looks like. This is how the image looks like. You have to take self, self or self, siblings, siblings or spouse. You have to take your parents, parents or siblings, siblings or spouse. You have to take your grandparents. Come down, take your kids along with their spouse. Come to the right side, it is your spouse along with their siblings and their spouses. Come on the top, it is spouses or parents, spouse or grandparents, but spouse, parents, siblings are not considered. Spouse, parents, siblings are not considered. At the same time, spouse, siblings or siblings, spouse, siblings or kids are not considered. Spouse, siblings or kids are not considered. Nephew, niece and all is not considered. Pudu vaartha ketta ella not considered da. Yes, so this is R. Next comes T. Next comes T. T is basically trust. T is basically trust. M is basically marriage. Any kind of gift which you receive on account of your marriage will not be taxable for you. Any kind of gift which you receive on your marriage will not be taxable for you. Any kind of gift which your parents receive on your marriage will be taxable for them. Any kind of gift which you receive on your marriage anniversary will become taxable. After that, nothing is important. After that, MINTLO, everything is zero. Everything is zero. This is what the provisions are. The whole summary is there in the chart. I want you to go through this chart when you have time. Okay. This will basically cover the gifts provision in a summarized manner. If you hold it as a stock in trade, what will happen? 43 CA will apply. If you hold it as a capital asset, 50 C will apply. If you are receiving it as a stock in trade, PGBP will apply. If you are receiving it as a capital asset, 56.210 will apply. 56.210 will apply. When will it be taxable? When will not be taxable? Motto chart is there. You can go through the chart and you will understand it better. Yes. With this chapter is also done. Exactly 5 minutes we are doing dividends. Count with me, 5. Yes. The provisions basically in dividends are 5. This are 222 A, B, C, D and E. 222 A, B, C, D and E. The only thing relevant for your exam is E. Which basically comes and says that if you are a private company, which is going to give loans to your shareholders, who holds at least 10%. If you are not giving it to your shareholders, you can give it to someone else in which shareholder has 20%. Yes, or you can give it to someone else for the benefit of the shareholder. In these cases, what will happen is the loan which is being received by the shareholder will be taxable as deemed dividend, for the shareholder will be taxable as deemed dividend. How does this work is that you have to ensure that the loan is given to him. He should have more than 10% of voting power, or if he is given to someone else, that person he should have more than 20% substantial interest. In this, they have come and clarified that, boss, when you give a loan, you have to check your accumulated profits. Whose? Companies. Check your company's accumulated profits. If the company has losses, deemed dividend will be 0. If the company has profits, to the extent the company has profits, will be taxable as deemed dividends for him. The deemed dividend will apply even in case where you repay the loan. Once you have given the amount, that is a deemed dividend. The only exception which they have given is that suppose you gave a loan today. Tomorrow you also had to give dividends. Instead of you giving dividends, you set it off against the loan. That will not be taxable. That is the only provision which you have to remember when it comes to 222E. 222A basically comes and says transfer of an asset. 222B comes and says transfer of conversion of preference shares into equity. Giving of issue of bonus preference shares. 222C basically talks about liquidation. 222D talks about capital reduction. E is what we discussed right now. Yes, this is what your definition of a dividends is. In this, the last two, the thing which is left off is only one provision, where basically they're coming and saying all dividends will be taxable under IFOS. From dividends, you can only claim a deduction of interest. First of all, what you can claim is only interest, which means what you cannot claim is any kind of commission, any kind of brokerage charges. Nothing is permitted. The only thing which you can claim is interest. How will you get the interest? You should have taken a loan for purchasing the shares. You will get the only deduction of interest, but whenever you are getting an interest deduction, you can only claim it up to a maximum of 20% of the dividend income. You can only claim up to a maximum of 20% of dividend income. This is one adjustment which everyone will go wrong on. Yes, one thing to extremely be cautious about, they will give you the interest in the exam and they will give you the dividend in the exam. They will tell you what is to be done. You have to ensure that you only claim interest to the extent of 20% of the dividend income. If you claim anything beyond that, that's lost. With this, your IFOS is also done, and we have satisfactorily completed our. We are cutting down for a lunch break, exactly 1 hour. We will join back at 2, and after that we have clubbing set of chapter 6A, 10AA, AMT, TDS, agriculture, and return filing. When we come back, you will realize the speed which I catch. Yes, my request is do not have rice and all and come. Suddenly you will start sleeping on the floor, nothing else. Yes.
I think we did it in classes, no? Classes only the panadukku. சாஃப்ட் காப்பி அமைச்சிருக்கேன் குரூப்பில், அதில் பார்த்துரு. அந்த வாட்ஸ்அப் குரூப் இருக்குல்ல, அதில் சாஃப்ட் காப்பி போட்டுட்டேன், அதில் பார்த்துரு, அதில் அமெண்ட்மெண்ட்ஸ் இருக்கு. தட் இஸ் த ஃபைனல் மெட்டீரியல் விச் யூ கேன் யூஸ் ஃபார் யுவர் எக்ஸாம்ஸ். அதில் என்ன சேஞ்சஸ் இருக்கு நீ பார்த்துக்கலாம். Shall we? Yes. Okay. Great. Completing the syllabus up to the 5 heads of income. Yes, we have completed the syllabus up to the 5 heads of income. We did the basics, we did the rates of taxes, we did residential status, salaries, HP, PGBP, capital gains. IFOS is also done. Yes, IFOS is also done. In this, I think 115 BSc, some things which are to be kept in mind is capital gains does not have any 115 BSc provisions. In IFOS alone, there is one provision for the family pension. The family pension alone will be withdrawn for you. Yes, the family pension alone will be withdrawn for you. At the same time, whatever salaries MPs and MLAs get, the daily allowance and constituency allowance will also be denied for you. Other than that, there is nothing else in 115 BSc. Yes. Let's quickly go into the other part of the smaller chapters. These chapters do not take much of a time. Yes, after this, in the next 3 years, the maximum one chapter will take a time is TDS. அது மட்டும் டைம் எடுக்கும், அது தவிர nothing will take time. Let's quickly complete everything quickly. Yes, we are into first part of the chapter called clubbings. This chapter basically talks about those cases where your income is earned by someone else, but the clubbing is going to happen to someone else. Now, why is this happening? What is this happening? The intention is very simple, that you are trying to avoid any kind of tax routings. You are avoiding any kind of tax routing so that the overall tax liability does not reduce for you. Yes. So what are the provisions? The first provision they are coming and saying is, if you transfer your income without transferring the asset, if you transfer the income without transferring the asset, then the income will continue to be clubbed in your hands. You cannot just like that transfer an income without taking the corresponding asset transfer. Yes, you cannot just like that tell someone that I will keep the fixed deposit with myself, but the interest alone will fetch you. Not possible. Yes, so that is the first rule. The rule is that you should not transfer any kind of income without transferring the corresponding asset. If you are doing that, it will be fully clubbed in your hands. Whether or not the transfer happens revocably or irrevocably, it does not matter. Yes, whether or not the transfer happens revocably or irrevocably, it will still be taxable in your hands. This is rule number 1. Rule number 2, where they're coming and saying that if you transfer the asset itself, it has to be a irrevocable transfer. If you transfer it by way of a revocable transfer, it will continue to be taxed in your hands. It has to be an irrevocable transfer. But if it's an irrevocable transfer, also it can become taxable in your hands, provided the benefit still comes to you or your family. The benefit still continues to come to you or your family, and the benefit can be as small as 1% also. If even 1% of the benefit comes to you, the full income will become taxable for you. These are the two scenarios. First scenario is what? Transfer of income without transferring asset. Second is transferring of asset on revocable cases. Third one is transferring of irrevocable but with a benefit deriving. Then comes the part where you are entering into the business. Basically where the case you have a business and your spouse is engaged in that business. You have a business and the spouse is engaged in that business, in which case what will happen is the spouse the salary will become taxable in your hands. Whatever salary is received by the spouse will be taxable in your hands. If it is proved that you have substantial interest into the business and the spouse did not have a qualification. Two conditions. First condition is that you should have substantial interest in that business and the spouse should not have any technical qualification. The substantial interest which I am talking about is not just for you, but is you along with your relatives. And here again relatives means the left side. Meaning 40A2 case, same 40A2 case. Yes, you along with your 40A2 case should not have any substantial interest in that business. If that is so, what will happen is the income will continue to become taxable in your hands. Which income? Her salary will become, or his salary will become taxable in your hands in the head of salaries. Whatever head was there for her is the same head for you, which means what is going to be taxed for you is income and not receipt. Which means if that person is going to earn a salary, you have to give the standard deduction of 50,000 and then only bring that salary into your picture. What you are going to tax is the income and not the receipt. You cannot bring the whole salary and then give a 50,000 deduction. You have to give the 50,000 deduction and then bring the salary. Clear? This is the third provision. The fourth provision is basically where they are coming and saying, if you give any kind of gift
If you give any kind of gift to your spouse, if you give any kind of gift to your spouse, in that case also what will happen is the gift lende varu, the income will also be clubbed in your hands. But this provision does not cover HP. This provision does not cover HP. Why does it not cover HP? Because deemed ownership already covers it. Deemed ownership already covers it. The logic is very simple. If you deem someone as an owner, what will happen is you can have 4 properties and only 2 will be SOP and the balance will become LOP. But if you treat it under clubbing, what is going to be taxed for you is only income. So which means 2 house properties in her name will be 0. 2 house properties in her name will be 0. That clubbed in your hands will also become 0. They cannot do all that nonsense. So therefore they told, boss, I will not apply clubbing, but I will apply deemed ownership. So the provision is transfer of any kind of asset to your spouse will be considered to be taxable in your hands unless and until it is a H property, unless and until it is a house property. If you are not doing the transfer to your spouse, you can do it to your son's wife. That is also clubbed in your hands. Suppose if that is not working out, what you can do is you can transfer the property to someone else for the for the spouse or the son's wife. You can transfer it to someone else for the benefit of your spouse and son's wife. Then also it will be clubbed in your own hands. Summa and the routing mechanism and all does not work. Yes, and the last provision is where they are talking about income of a minor child. This provision basically comes and says, at the first instance, whatever income is earned by the minor child will always be clubbed. At the first instance, whatever income is there of the minor child will always be clubbed in the hands of the parent whose income is higher. You will club it. But 2 exceptions to this rule where they have come and said is, first of all, it is received by way of any kind of skill which the person has, or if the person is disabled. Handicapped, whatever you call it. Yes, the person is disabled or handicapped. Second thing which they are coming and saying is, if at all you are going to club any kind of minor child's income in your hands, you will get an exemption flat of 1,500 per child. It is not per month, it is 1,500 per child. This was the third observation in your May 22 exam where people forgot to give 1,500 worth of exemptions. This is one of the important exemptions you have to give. Any kind of income which you club in the hands of minor child will be always eligible for an exemption of 1,500 if you don't opt for 115 BSc. Which means if you are opting for section 115 BSc, you will not get any kind of exemptions. Income alone will be clubbed in your hands. This is the income of a minor child. Also includes minor married daughters. Will be clubbed in the hands of the parent. The other side parent, the spouse side is parent. They will be clubbing in their own hands. And the last provision in clubbing is where they are coming and talking about cross transfers, where they are basically coming and telling us, I am giving my asset to someone else for the benefit of my wife. I am not married. So I am giving someone else an asset for the benefit of my wife. That someone else is giving an asset to my wife for the benefit of her, for the benefit of his wife. In which case, what will happen is, to the extent the income is common, that will be clubbed in the hands of respective transferors. To that extent, that income will be clubbed in the hands of the respective transferors. This is how the chart looks like. Transferring of A to spouse of brothers spouse of brothers A, and transferring of brothers A to spouse of mine. That is how it will work. Common kind of income will be clubbed in the hands of both the people. While we are closing clubbing, one provision to keep in mind is, what is being taxed is the income and not the accretion of income. Meaning, income is what is taxable. Income on income is not taxable. Because that is something which is done by way of the efforts of the other person. That will not be clubbed, but that rule does not apply for minors. Minors, every income has to be taxed, and then you have to check for whether it is in the form of any kind of skills or any kind of disability. Otherwise, it will be fully clubbed in the hands of the parent whose income is higher. That's all is the chapter for clubbing. Clear? Completing the set off chapter in a single shot, one table. That is what I told. No, accretion of income will continue to be taxed for minor. So if the minor earned any kind of skill income, that skill income will not be taxable, but whatever is the money deposited in FD, that FD income will be taxable in the hands of parent. Accretion always comes. Yes, accretion works for minors also. Accretion does not work for anyone other than minors. Clear? Yes. Going into this chapter called set off. Nothing to be done in this chapter. 3 pages chapter completed in one single table. completed in one single table. What you have to do is you have to look your income headwise. You have to look the income headwise. So we will discuss from the loss side now. We'll discuss from what side? Loss side. Question to you: do you have loss from salaries? No. You will never have losses from salary. So therefore that provision is out. Next, loss from HP. Can you have losses from HP? Yes. Either it can be from an SOP or an LOP. But if it is in 115 BSc, it can only be from LOP. 115 BSc, it can only be from LOP. Provisions come and say that you can transfer, you can set it off intra-head first with no limits. Set it off intra-head first with no limits. If that is not working out, you can set it off inter-head up to 2 lakhs, and balance you can carry forward for a period of 8 years. Return filing on time is not mandatory. But the provisions of 115 BSc will come and say that you cannot set off against other heads. You cannot set off against other heads. You can either set off intra-head or you can carry forward. That's all. You can either set off intra-head or you can carry forward. And the rule for your inter-level exam is that whenever you have a loss from house property, the first head you will always set it off is only against salaries. The first head you will always set it off is only against salaries. After that, if it does not get exhausted, then only you will go somewhere else, because salary or income, the only loss which can be set off is HP. For inter-discussion. For inter-discussion, for the students who have been with me, they already know some other routes also. Yes, for your inter-discussion, the only loss which can be set off against salaries is HP. They can only set off salaries against HP. Coming to the next part of the incomes, which is PGBP. In PGBP, now you have to split. First one is a speculative loss. Can be set off only against speculative income. If it is not eligible, you can carry forward for a period of 4 years. Return filing on time, mandatory. Next one, we are talking about unabsorbed depreciation. Can be set off against any head other than salaries. If not permissible, you can carry forward for a period of indefinite years and set off against any head other than salaries. It will continue to be set off against any head other than salaries. This is the only exceptional case for the others. As compared to others, where carry forward you can only set off against the same head, unabsorbed depreciation can be set off against any head other than salaries for indefinite years. Return filing on time is also not mandatory. Yes, after the speculative comes specified business losses. If there is a specified business losses, it can be set off only against specified business incomes. If it is not permissible, you can carry forward for unlimited years. Return filing on time, mandatory. And the last thing is your normal PGBP losses. If it is a normal PGBP loss, intra-head you can set off. Inter-head you can set off against any head other than salaries. If that is not working out, you can carry forward and set off against PGBP income for a period of 8 years. Return filing on time, mandatory. Now comes the capital gains part. In capital gains part, we have come and clarified two kinds of capital gains, long term and short term. If it is a long term capital gain, that has lower rates or higher rates? It has lower rates. Long term capital gains has lower rates as compared to short term. Yes, so long term capital gains should not be eligible to set off against any other heads. So therefore the logic is very simple. Any kind of long term capital loss will only be set off against long term capital gains. If that is not enough, you can carry forward and set off against long term capital gains for a period of 8 years. Return filing on time, mandatory. Coming to short term capital gains, this comes and says that you can set off against any head. You can set off only against capital gains. Whether it is long term or short term. You can set off against capital gains alone. If that is not working out, you can carry forward and set off for again capital gains alone for a period of 8 years. Return filing on time, mandatory. Last provision is talking about your IFOS. In IFOS, they basically come and said one kind of loss called loss from owning and maintaining horse races. If you have any kind of loss from owning and maintaining horse races, you will set off only against income from owning and maintaining horse races. If that does not work out, you can carry forward for a period of 4 years. Return filing on time, mandatory. And the last thing is, if you have any kind of losses from your gambling, unexplained, cash credits, what will happen? You will ignore all these losses. And the standard rule is these incomes will not have any kind of set off also allowed. Clear? Chapter முடிஞ்சிச்சு. இப்படி தான் ஓட போகிறோம். Yes, getting into the last lengthiest chapter, second last lengthiest chapter called chapter 6A deductions. Chapter 6A deductions. We are into that part of the syllabus where we have completed 5 heads of income, arrived at your gross total income, and now we are going to give some kind of special deductions. The first deduction for your exam and the most important deduction is deduction under 80C. This talks about any kind of investment or expenditure allowances. This kind of talks about any kind of expenditure or investment disallowances applicable for individual applicable for individual. The first and the most important thing in this is your life insurance premium. The first and the most important thing is life insurance premium, where they are basically coming and saying is, if you have taken a life insurance premium for self, spouse, children, dependency, not required. Self, spouse and children, whether they are dependent or not eligible for parents, not eligible for parents. If you take any kind of life insurance premium, you have to split into three. Check whether the policy was taken before 2012. If the policy was taken before 2012, you will be eligible for 20% of the sum assured. 20% of the sum assured. If it is taken after 2012, you will be eligible for 10% of your sum assured. But if you are a handicapped person, it will be after 2013 eligible for 15% of your sum assured. Apart from that, they are simply giving some small items. Basically, they are coming and saying any kind of contribution to fund, any kind of Sukanya Samriddhi scheme, any kind of tuition fees which you have paid for your children, any kind of principal repayment of housing loan, these are all covered under your 80C. Either do you have to remember something? No. Look at the chapter. In the question, if they come and give you any kind of expenditure which does not look like a capital in nature, any kind of expenditure which does not look capital in nature, basically meaning any kind of investments. If it is an investment, it is section 54 and all those cases. If it is any revenue kind of expenditure, 80C. Yes, these are the items which you have to remember. Any kind of revenue expenditure which is incurring, which is not covered under PGBP or any other 54 cases, directly put it under 80C. Blinda portalo varak porudam marks. Clear? This is your 80C. Then comes 80CCC, which talks about pension scheme fund. 80CCC talks about pension fund. 80CCD talks about pension scheme. 80CCC talks about pension fund, where they come and say whatever contribution you make is eligible for deduction. 80CCD talks about pension scheme. It talks about pension scheme, where they have come and told that if you are having a pension scheme, it can be in two formats, either an employer contribution or an employee contribution. Employee contribution eligible for deduction. Employee contribution additional 50,000 eligible for deduction if it is an NPS scheme. Employer's contribution, they are coming and saying you can again claim a deduction of 10% of your salary, or if you are a government employee, 14% of your salary. What is salary here? Basic plus DA forming part, full stop. Basic plus DA forming part, full stop. That's all. Yes, this is what your salary is for the purpose of NPS. When you come to 80C, 80CCC and 80CCD, they have come and told club all the three together and maximum you can give 1,50,000. But in this 80CCD, the 50,000 will be given separately and the employer contribution will also be separate. So you can claim three things. 80C, CCC, CCD, employees contribution together. Maximum of 1,50,000. 80CCD, additional 50,000 separately. 80CCD2, which talks about employers contribution, separately. This is how the chart looks like. Ceiling limits. Okay, 80C plus 80CCC plus 80CCD1, which talks about the employees contribution, additional 50,000 separately, additional employers contribution separately. With this 80C, 80CCC and 80CCD is also done. And coming to 80D, from your exam perspective, 80C and 80D becomes most important. Yes, so 80D is most important, where the provisions are basically coming and saying if you have incurred any kind of medical insurance expense, be extra careful. The moment you find insurance premium in your exam, you have to ask yourself whether it is life insurance or medical insurance. Life insurance is 80C, medical insurance is 80D. This is where they play around with you. Be extra careful. Yes, this is talking about medical insurance. In this medical insurance, they have come and said that you have to do it for self, spouse, dependent children, any parent. Dependent children, any kind of parent, doesn't matter whether they are dependent or independent parent. So here is where the provision talks about self, spouse and dependent children in one bucket. Self, spouse and dependent children in one bucket, parents in a separate bucket. For each bucket you will be eligible for 25,000. But if you are a resident senior citizen, your bucket will become 50,000. What can you claim? And this is your medical insurances, any kind of preventive health checkup schemes, any kind of CGHS, central government schemes and all that stuff. But the rule here is that first of all, your preventive health checkup maximum you can claim for both the buckets together is 5,000. For both the buckets together, you can only claim 5,000 rupees. For both the buckets together, you can only claim 5,000 rupees. And the second rule is that the insurance premium and CGHS should only be paid other than by cash. Preventive health checkup can be paid by cash. Preventive health checkup can also be paid by cash, which means a person can have a deduction of 25,000, 50,000, 75,000 or 1 lakh. Any combination can work. Yes, any of the combinations can work. However, it is what payments can you make? You can make an insurance premium, CGHS, preventive health checkup. Preventive health checkup 5,000, both the buckets together. Every other thing individual buckets only. But if you are making a payment should be other than by cash, except for preventive health checkup. Except for preventive health checkup. And this is where you have to remember that your parents may or may not be dependent, does not matter. But when you come to ATC, parents are not even there. When you come to dependence, when you come to ATC, parents are not even there. This is called 80D. This is called 80D. Then comes 80DD. Then comes 80DD. I have merged it in my material along with 80U. I merged it along with me in the 80U. What does these provision basically come and say is, if you are maintaining any kind of handicapped person in your house, if you are maintaining any kind of handicapped person in your house, basically you are the support stick for that person. In that case, you can get a flat deduction of 75,000 or 1,25,000 regardless of what you spend. Regardless of what you spend, you spend 1 rupee also, you will get 75,000. You spend 5 crores also, you will get 75,000. Yes, how does the 75,000 and 1,25,000 work? If you are a normal disabled person, it is 75,000. If it is severely disabled, it is 1,25,000. What is severely disabled? Exam will tell you. What is severely disabled? Exam will tell you. So it is 75,000 and 1,25,000 is what the thing for handicapped people. If you are doing it for self, that is 80U. If you are doing it for dependents, it is 80DD. And if you are doing it for someone, basically if you are doing it for yourself, someone else should not claim your deduction. If you are doing it for someone else, that person should not claim their own deduction. You cannot be doing multiple things. Yes, one person claiming 80DD for someone else should not be claiming 80U by him. And if you are claiming 80U, your deduction should not be claimed by someone else. This is called 80DD along with 80U. Coming to 80DDB. Coming to 80DDB, this provision basically comes and says, if you have incurred any kind of expenses for your specified disease, if you have incurred any kind of expenses for your specified disease, I will give you a deduction of 40,000 rupees for self, 40,000 rupees for normal people, 1 lakh rupees for senior citizens, 1 lakh rupees for senior citizens. Who can be covered? You can cover yourself, your spouse, your parents, your children and siblings, everyone being dependent. Everyone being dependent, other than you, whoever is, I don't know how spouse will not be dependent, but okay, whatever it is. Yes, anyone being dependent on you will be covered into this scenario. What are the deductions? You will be 40,000 and 1 lakh rupee. This is the maximum deduction, which means in your whole syllabus there is only one place where you have a flat deduction, which is handicapped individuals. Handicapped individuals claiming an 80DD or 80U, which is 75,000 and 1,25,000. Everywhere else it is either lower, higher, maximum, up to whatever it is. This is the only place where you have a flat deduction. Yes, this is 80DD. Now we are getting into the other parts which talks about interest. We are talking about the other parts which talks about interest. 80E talks about interest on loan taken for higher education. Interest on loan taken for education. Here they are coming and saying it should be a higher education beyond 12th standard. Beyond 12th standard, if you are taking any kind of loan for beyond 12th standard, it can be claimed as a deduction, whether or not the education is in India or outside India. It doesn't matter. But when you come to 80C, tuition fee should only be paid in India. Tuition fee should only be paid in India. 80E does not have any kind of restrictions. If your parents are taking loan for yourself, if your parents have taken loan for you, or you have taken a loan for yourself, whatever is the interest can be claimed up to a period of 8 years. Up to a period of 8 years. Is there any limit? No limits. No limits. Fully will be allowed as a deduction. It should be a beyond a 12th standard case. It should be a beyond a 12th standard case. Further studies can be in India or outside India. Then comes 80EE and EE. 80EE and EE both work together. This is basically the provision which I talked about in HP. This is the provision which I talked about in HP. This provision basically comes and says that if there is any kind of interest, if there is any kind of interest which you have incurred over and above what you could claim in your HP, which is the case where you will be able to claim that? Which is the case you will be able to claim? Only for SOP. Only for SOP. And a let out you have to claim the whole deduction in HP itself. Yes, for let out you will anyway claim the whole deduction in HP itself. So you are only discussing about SOP properties. You are only discussing about SOP properties. If there was an SOP property which you have and that SOP property you are not able to claim the full deduction, in that case you can come to this section called 80EE and EE. You can come to these sections called 80EE and EE. These provisions come and say that if you have taken a loan for the purchase of an self-occupied property, whatever is the interest cost which you have not claimed in your HP, you can come and claim it here. What are the deductions? 80EE will grant you 50, 80EE will grant you 1,50,000. It will grant you 1,50,000. Clear? These are the two provisions, but what are the conditions? 80EE should be taken between previous year 16-17. 80EE should be taken from 2019 to current year. 2019 to current year, whatever it is. Yes. And the second thing which they are coming and telling is whatever is the loan, whatever is the property value, whatever is the property value in your 80EE should be less than 50 lakhs and in the EEA should be 45 lakhs. EEA should be 45 lakhs. You satisfy these conditions alone is when you will get this kind of deduction. And just to clarify, this whole section is a silent adjustment question. Yes, in your exam, if they give you any kind of interest, they give you the loan date and all that, you have to be smart enough to realize whether that falls under 80EE or EEA. You have to be extra careful about it. This is a silent adjustment for your exam. Clear? Yes, if you are not having any, if you are having an SOP property, if you are able to claim the full interest there, good, leave it off. But if you are not able to claim it, you have to check whether it is eligible for 80EE or EEA. Clear? Yes. Next provision is 80EB, which talks about interest and loan taken for electric vehicles. Interest and loan taken for electric vehicles. If anyone has taken an electric vehicle and they have taken a loan against it, you can claim a maximum of 1,50,000 on that interest also. You can claim a maximum of 1,50,000 of that kind of interest also. This is 80EB. This is 80EB. Comes the next part and the most important part for your exams called 80G. Comes the most important part called 80G, which is called donations, Donations is basically those cases where you have made a donation to someone. Rule number 1 in donation is that it should be made donation in monetary value. Donation should be in monetary value and not should be in kind. If it is a donation made in kind, not allowed. The donation which you are making in monetary value should be in permissible modes, which means it should not be in cash. If it is in cash, if it is more than 2,000 rupees in cash, that will be ignored. That will be ignored. Only if it is beyond if it is less than 2,000 rupees, you will get a deduction for a cash item. But anything which you make other than by way of cash will be allowed as a deduction. How do you remember this 80G? There are 4 categories. Remembering all those categories looks a little difficult. So I have something in green in your material.
10,000 in cash, not 2,000.
No, nothing. Fully gone. Yes, I have 4 categories. How do you remember these 4 categories? Simple short. They are basically coming and saying that if there is any person with the name national or minister, if there is any kind of fund with the name of national or minister, directly 100% with no limits. You look at the categories, you will understand. Any kind of person with category national or minister in it, always it will be global national thing, and therefore it will be 100% without any limits. If there is any kind who is coming from the Gandhi family, anyone who's coming from the Gandhi family or Nehru family, in that case it will be 50% with no limits. Anyone coming from a Gandhi or Nehru family, 50% with no limits. Anyone coming from a national or minister family, it will be 100% without any limits. The only exception given is Prime Minister Drought Relief Fund. Prime Minister Drought Relief Fund is the only category which, although has the name minister, comes under 50%. Prime Minister Drought Relief Fund is the only person which comes under 50%, although his name has a minister. Everyone else where you have a minister or a national inside it, it will always be categorized under 100%. Apart from that, the other 2 categories are very simple. They are telling in these other 2 categories, you have the family planning or Olympics. Where it will be 100% with limits, 100% with limits. And the last case is any kind of charitable organizations you make, it is 50% with limits. Now, what is this limits? They are basically coming and saying it is 10% of your adjusted gross total income. It is 10% of your adjusted gross total income. Basically, they are coming and saying, do one thing, boss. Keep 80G as a last item. Compute your gross total income, reduce all your deductions, and remove off all those items which are never eligible for 80G. Remove all those items which are never eligible for Chapter 6A. What are those items? LTCG and all, you cannot claim 80G. LTCG, any kind of special income tax rates, all these are not eligible for Chapter 6A itself. Yes, so the full special rate incomes, everything will be excluded. So take your gross total income, exclude all those special rate incomes, and then allow for all the deductions which you have except for 80G, except for the full 80G. This will be your adjusted total income. In this you will take 10%. This is the amount which you can contribute. Meaning, indha nee contribute panna mudiyum. Idukku mele you will get a deduction. Yes, so simple example, if let's say for example your adjusted total income comes as 1 lakh rupees, you can contribute only 10,000 rupees. Let's say you contributed 12,000 rupees to charitable. You contributed 12,000 to charitable. What will happen? 10,000 is what they will allow. 10,000 could 50% is 5,000 rupees is what you will get a deduction. Purida? Yes, 10,000 is what they will allow as a contribution made, and in the 10,000 you are eligible for 50% only. So therefore the deduction which you can claim is only 5,000 rupees. Don't make this mistake to understand that 10% is the allowable amount. 10% is the contribution amount. 10% is the contribution amount. Adukku after you have to find out the allowability. You have a full-fledged sum in this paper, I mean in the material itself. You can go through the full-fledged sum in your material and you will find how to do it. Yes, or full adjusted total income ku vandadukku appuram eppadi compute panna, everything is given here. You can go through it yourself. Yes, great. After 80G comes 80GGA. This and all is not coming for exam much. This and all is not coming for exam much, but just in case it comes, it is any kind of contribution made to research development and all. If you do not claim 35, come and claim it here. Same provisions, nothing else. Next thing is any kind of donation to political parties. If you cannot claim it there, you will come and claim it here. Yes, if you cannot claim it there, you will come and claim it here. The only rule is that you should not make cash payments. Nee political party ka cash payment kodutale illegal da. Yes, you give any kind of cash payments to political parties, that is straight out illegal da. No one will give any cash payments to political parties unless and until it's an illegal money. Yes, so no payments are eligible if it is made by cash. No payments are eligible if it is made by cash. The next provision is called as 80GG. Simple ah solran. 80GG exam la vanda not allowed. 80GG exam la vandale not allowed. I will tell you why. The rule in 80GG is that whenever you want to claim 80GG, you should not have a house property in the same place. You should not have a house property in the same place. You should be receiving you should not be receiving HRA also. You should not be receiving HRA also. The house should also not be in the same place. And if you're doing this, you should not have any other property somewhere else also. Yes, when all these conditions are there, no one can claim it. No one can claim it. So 80GG, 99% exam la vandittu number vandale is not eligible now. MCQ la question vandale 0. Nothing to be looked into it. Yes, don't remember all these extraordinary numbers. Too many numbers to remember already for you. Yes, so 80GG is out, not to be remembered. Coming to the income part of the definition, one of the most important sections in this whole chapter is 80JJAA. The most important provisions in this chapter is 80JJAA. Straightforward provisions nyamag vachame, there is a step ladder. Straightforward. Do not remember any kind of provisions. Follow the steps. You have to first come to the steps and look for whether you are a tax audit person. Are you eligible for tax audit or not eligible? If you are eligible for tax audit, then you stick to this provision. One it is 0. Then come and ask me one simple question. Rahul, you are giving this for new employment, which means there should be new employment, which means there should be a net increase in employees. So which means from last year to current year, there should be a net increase. Have they tested this in exam yet? No. They will itself tell you there is a net increase. Suppose now you have a net increase. The next rule which they will come and say is, okay boss, if there is a net increase, tell me one simple thing. Are they contributing to PF? If they are contributing to PF, they are eligible. Not contributing to PF, remove it off. Not contributing to PF, you will remove it off. After you get a filter of those employees who are contributing to PF, you will ask them whether they have stayed in, whether they have worked in this, organization for more than 240 days. Whether you have worked in this organization for more than 240 days. If they have worked in this organization for more than 240 days in the current year, then you are eligible. If not, you will please carry forward them. Since I am carry forwarding this to the next year, I will bring from last year to this year. Yes, so you will also bring those employees who did not get eligibility last year but are now satisfying 240 in the current year. But here is where there is an exception also, which comes and says 240 will become 150. 240 will become 150. When does it become 150? It will become 150 in case of a leather, apparel, shoes industries. Leather, apparel and shoes industries. All those cases will become 150 days and not 240 days. Hey, on the switch, the projector switch. Except for that switch, try everything else. And the D motto touch panirada. Adu touch panirada solranda. Kekran pathiya. And the comedy na sonna nyamuk irka. You tell someone to not do something, adna first time. Anyway, listen to me. You have your materials in your hand, go through it. Yes, the provisions, where were we? JJAA. Yes, you are going to step number 1, check for the tax audit applicability. Step number 2, check for a net increase. Step number 3, check for contributions. Step number 4, check for 240 days. Carry forward 240 days, bring forward 240 days or 150 days as the case may be, If that is also working out for you, then you will come and ask them whether the salary of that person is more than 25,000 or less than 25,000. If the salary ends up being more than 25,000, those employees will also be rejected. Any employee with less than 25,000 is what you will consider. These are your final set of employees. Take these employees, multiply with the salary which they have received in the current year. multiply it with the salary which they have received in the current year. That number is called as your additional employee cost. That amount is called as your additional employee cost. This you will give 30% as a deduction. This you will give a 30% as a deduction for how many years? 3 years. Current year with the next 2 years. Current year with the next 2 years. 100 rupees is what you got as an additional employee cost. 30 current year, 30 next year, 30 next year. This is what 80JJAA talks about. Clear? Yes. With this comes to the last provision of this chapter, talks about 80 TTA and TTB. We will discuss that later. We are talking about 80 TTA and TTB. These provisions basically come and say that if you have any kind of deposits made, then in that case I will give you the deduction of the interest. How does it work is, if you are a non-senior citizen, you will fall under 80 TTA. If you are a resident senior citizen, you will fall under 80 TTB. In 80 TTA, you can only claim deduction for post office savings or savings account. Subject to a maximum of 10,000 rupees. If you are a resident senior citizen, whatever deposit you make, everything is eligible. The full interest of that can be up to 50,000 rupees. The full interest can be up to 50,000 rupees for you in that scenario. Yes, sir. Yes, this is what your 80 TTA and 80 TTB is. The last provision of this chapter 6A is called as 80 QQB RRB. 80 QQB and 80 RRB. Both talk about royalty. The limit in royalty is 3 lakhs. They have come and said that whatever royalty income you have earned, that royalty income you will get a deduction of maximum of 3 lakh rupees. But how do you have to compute this is that they have come and told one condition is, if you are receiving a lump sum payment, then no problem. But if you are receiving a recurring payment, 15% is what you can receive on the royalty value. 15% is what you can receive as a royalty value. If you receive anything beyond 15%, that will be ignored for the purpose of deduction. Income still is taxable. You will tax the full 18%, but you will give a deduction of only 15%. So step number 1, remove it to 15%. Step number 2, they are coming and saying you should bring this money into India within a period of 6 months. From the end of the financial year. So whatever money you did not bring within 6 months from the end of the financial year will also be ignored. After that, if you claimed any kind of deduction there in IFOS chapter, you will have to remove those deduction in current chapter also. You have to remove that kind of deduction in current year chapter also. At the mudichadukapram, you will give a limit of 3 lakh rupees. That 3 lakh rupees is what you can claim under 80 QQB or 80 RRB, as the case may be. Yes, you might have taxed the whole 5 lakh rupees in IFOS, but what you will give a deduction here is only maybe maximum 2 lakh 40, 2 lakh 30, whatever it can be. Anything is possible. Yes, sir. Yes, so this is what your 80 QQB and 80 RRB is there. With this, your chapter 6A is also done. But to clarify to you, in chapter 6A, you cannot claim any kind of deduction of chapter 6A on your special tax rate incomes, which means it can only be claimed on your Finance Act incomes. No capital gains, no unexplained income, no casual income, and 115 BAC and no 115 BAC. Now coming to the 115 BAC scenario, 115 BAC basically comes and says one full chapter 6A is not eligible. 115 BAC says full chapter 6A is not eligible except for two. One is 80 JJAA. And the second one is employer's contribution to NPS, 80 CCD2, the 10% of salary. The 10% of salary or 14% of salary. These are the only two items which you are eligible under 115 BAC. Other tavara, whatever chapter 6A you have will become fully ignored. Under section 115 BAC. Clear? Yes. So we are done with the gross total income. We have now claimed chapter 6A also. Comes the next kind of deduction called as 10AA. Comes the net kind of deduction called as 10AA. This see, by the time we start TDS, no, I will tell you that you close your books and sleep. Yes, we are in 10AA. We are in 10AA. Yes. Two kinds of deductions which you have against your gross total income. First deduction is your chapter 6A, second deduction is your 10AA. 3 lines. That's all. 3 lines of this chapter. It comes and says 3 lines is on a word solla. 3 lines of the chapter, provision basically comes and says, if you have an SEZ unit, you will get a deduction in 3 brackets. For the first 5 years, it will be 100% of the export profit. Next 5 years, it will be 50% of the export profit. Next 5 years also, it will be 50% of export profit, and the subject to conditions not relevant for exam. So basically it means for the first 5 years you will get 100%, for the next 10 years you will get 15%. The only one rule you have to remember is that what are you eligible for is export profits. Export profit means profit of the undertaking into export turnover divided by total turnover. Of which undertaking? Full company or the undertaking? Only of that undertaking. If you have a DTA unit and an SEZ unit, you will take the DTA unit and tax it fully. SEZ unit, you will come here, you will first add it in IFOS or PGBP. Then you will come here, take the profit of that undertaking, multiply it with export turnover divided by total turnover. For the purpose of export turnover, they have come and said that export turnover means all those turnovers excluding any kind of expenses which you have paid outside India. When you are removing any kind of expenses from export turnover, you also have to remove it from your total turnover. So the provisions are that it is profit of undertaking into export turnover minus expenses incurred outside India divided by total turnover minus expenses incurred outside India. Chapter is over. 10AA is also not eligible for 115 BSc. 10AA is also not eligible for your 115 BSc. Yes, with your gross total income arrived, you have reduced your chapter 6A, you have reduced your 10AA, you will now leave yourself with total income. On the total income is what you compute your taxes. After rounding it off to nearest to 10 is when you complete your tax liability. But now you have computed your taxes as per normal. You have a now special extra provision called AMT. 115? JC. Okay. It's called 115 JC, alternate minimum tax. It's called as AMT. This provision basically is coming and saying that, boss, I want some tax from you. What is the tax? I want minimum 18.5% as tax from you. You give me that much, I'm happy. You give me anything lesser than that, I will ask you for 18.5. But in the future, when you have higher taxes, you can set it off. How does this provision work is that you have to first figure out whether you are eligible for AMT or not. That is the fourth mistake which happened in the May attempt. In the May attempt, there was an AMT question, and unfortunately, people computed normal tax rates. They forgot to compute AMT tax. Question went for a toss. Okay. So the provisions are like this. They have basically come and told you that if you are a person who's earning some special incomes, what are the special incomes? Either you're earning 10AA, or you're earning 35AD, or you're earning heading C. What is heading C? QQB, RRB, JJA. Yes, either you are earning any kind of 5 incomes. What are the 5 incomes? 10AA, 35AD, QQB, RRB, JJA. If you are claiming any of these deductions, and your adjusted total income is beyond 20 lakhs, you are covered under AMT. If you are covered under AMT, what you will do is you will compute a concept called adjusted total income. What does this concept come and say is, take your total income. These are the 5 issues which caused problems. Take off the 5 issues, which means you will take your total income, add back 10AA, add back 35AD, add back QQB, RRB, JJA. And JJA, but what happened is, since you added back 35AD, that now became a normal business. Now, because that became a normal business, that is eligible for depreciation. So you can claim depreciation on the 35AD assets. You will arrive at something called as adjusted total income. This adjusted total income, government is expecting 18.5% from you. As a minimum tax. So let's say your adjusted total income is 100. Government expects Hey, when I say 100, don't come and say me, Rahul, 20 lakhs is the limit. This is 100 lakhs. Government expects 18.5 lakhs as minimum tax. You started computing your taxes and you found that your normal tax is coming as 10 lakhs. Your normal tax is coming as 10 lakhs. Government will ask you to pay 18.5. Government is asking you to pay 18.5. Sumava kutrivinga. What will you tell? You are telling him that today I am paying you 18.5, but I should have paid you 10. So the balance 8.5 is something which I am paying out of my pocket. Balance 8.5 is something which I am paying out of my pocket. This difference will be called as AMT. Very good. This will be called as an AMT credit. Now what will happen? Next year I will look at my tax again. Next year I looked at it and I found my AMT is 20 lakhs. I found my AMT is 20 lakhs. My normal is coming as 30 lakhs. How much is my normal coming to? 30. Government will be happy with 30. Will you give him 30? No, what will you tell him? Sir, I am supposed to pay 30, but from this 30 I already paid 8.5 in the past. Why the hell should I pay it to you today? Correct? So you will tell him, sir, I have already paid 8.5 in the past. Therefore, please allow 8.5. Number will come as 21.5. 21.5. Assuming this normal was 25 lakhs. Assuming the normal was 25 lakhs. Will the government claim 8.5? Why can you only claim 5? Because if you claim 8.5, what will be the number? Tax class calculator illama ukkandirukkinga adha gaandu 16.5. How much is it coming to? 16.5. If you tell the government that you will only pay 16.5, government will come and say you have to minimum pay 20. How the hell did you pay 16.5? So government will say at least pay me 20. So what will you do? You will only be able to claim 5. You will only be able to claim 5. Therefore you have to minimum pay 20. What will happen to the balance 3.5? So the provisions in AMT says that AMT credit will be carried forward for a period of 15 years. AMT credit will be carried forward for a period of Purilama. If you reduce 6.5, what will happen? How much you have to minimum offer? Yes. So what will happen is government will come and say whatever is the AMT credit which you have got right now, you have to carry forward for a period of 15 years. You have to carry forward for a period of 15 years. 15 years kulla set off pannittinga great illana lapse. Yes, this is what your provisions of AMT is, and to clarify to you, AMT is not applicable if you opt for 115 BSc. If you opt for 115 BSc, AMT provisions will not apply to you. You can directly pay only tax under 115 BSc and close the answer. You can directly pay tax under 115 BSc and close the answer. You were at gross total income, reduced to chapter 6A, reduced to 10AA, came at total income, computed taxes as per normal, computed taxes as per AMT, computed taxes as per 115 BSc. You will check for normal. Normal or AMT, whichever is higher. Very good. Normal or AMT, whichever is higher, that will be compared with 115 BSc, whichever is lower. That will be compared with 115 BSc, whichever is lower. You have to give the lowest of the taxes. You have to give the lowest of the. Sorry, ma. That's okay. That is why the provisions are not applicable. No. 115 pannamodu AMT is not even applicable. You paakave maatinga. Correct? That is why it is step 9 and step 10, whichever is higher, compared with step 11, whichever is lower. Yes, step 9 or step 9 then. Step 9 or step 10, whichever is higher, compared with step 11, whichever is lower. That is how it works. Yes, you will compare normal with AMT, whichever is higher. That will be compared with 115 BSc, whichever is lower. You have arrived at your tax liability also. But when you are computing this tax liability itself, you had one special kind of income which came out of blue, called as agriculture income. There is one special income which came out of the blue called as agriculture income. This agriculture income caused problems for you, because what happened is you came and said agriculture income is not taxable under Income Tax Act. Agriculture income is not taxable under Income Tax Act, but department came and said, okay, let it not be taxable. But if your main stream of business itself is agriculture income, why should I not collect higher tax from the other incomes? Why should I not collect higher taxes from the other income is what the concept came with. So let's first understand what is this agriculture income. The provisions are like this. They have basically come and said any kind of operations which you do on a land, will be called as an agriculture income. But what land are we talking about? We are talking about rural agricultural land. Any kind of operations which you do on a rural agricultural land alone will be called as an agriculture income, because if it was an urban agricultural land, it is taxable under income tax. It is taxable under income tax. So there should be the first condition that you should do an operations on that land. Second, you are doing operations. Suppose you have to grow rice. You have to grow rice. First of all, you will grow wheat. Wheat, na? Paddy, yeah? Yes, sir. You will grow paddy. Yes, you will grow paddy. But what happened is, when you started growing the paddy, you realize that the paddy which you are excluding is very dirty. So therefore, you have to do cleaning. You have to do cleaning, processing, you have to make all the changes, any kind of pesticides and all which you have to do. Now, are these operations also agriculture? Yes. So they told whatever operations which are required to ready this thing for your market will also be considered as an agriculture income. Whatever is ready, whatever is required for getting this ready for the market is also called as an agriculture income. These are the two items which will be called as an agriculture income. But apart from that, they have come and told, let's say you have an agriculture land. You have an agriculture land, but you are not able to do agriculture. You are ready to give it to someone else for agriculture. You will be earning rent. You will be earning rent. The rent which you earn is agriculture, not agriculture. It is agriculture. It is agriculture, because at the end of the day, the other person is going to do agriculture on it. At the end of the day, the other person is also going to do agriculture on it. So the rent received from an urban agricultural land will also be treated as an agricultural income. The rent received from subletting of agricultural land.
He uses for agriculture land.
Same thing. What happens is, you have taken your land, given it to someone else. That someone else has given it to someone else. If that final person is using it for agriculture, both the people will be called as agriculture income. Both the people will have it for agriculture income. At the same time, they have clarified that, I'm sorry boss, no poultry and all, no poultry farming and all, that is all fully taxable. Any kind of spontaneous growth, whatever land you have, suddenly trees are growing there, you cut the trees, you give it off, that is also taxable. That is not an agricultural income. That is not an agricultural income. And the last thing which they have clarified is, if in case you have any kind of saplings which you grow in a nursery, any kind of saplings which you grow in a nursery will continue to be an agricultural income, even though it is not happening on a land. Even though it is not happening on a land, the reason you put it in nursery itself is because it was not growing on a land. So therefore, that will also be categorized as an agricultural income. Having classified that into agriculture income, now you have to split. Now you have to split and try to understand as to how this agricultural income works. This is where the concept of PGBP also comes into picture. This is of the concept where the PGBP also comes into picture. They told, boss, simple. If you have a case where you are doing the paddy, you are doing the rice, you will itself create it into basmati rice and then sell it off. Now what is happening? You are doing agriculture also, you are doing business also. You are doing agriculture also, you are doing business also. How do you decide whether how much to split into agriculture and how much to split into business? Simple, they told, do one thing, split your business into two. Split your business into two. One business is called as agricultural business, one business is called as a normal business, basmati order business. How will you do it? It will be assumed that you are selling from your agricultural business to normal business at FMV. At FMV, you might have learned it in costing, right? Process costing, la ingil sell pannita and the process ka porom. That is the same concept. So what will happen is, you will take the cost which you have of the paddy. Assume that you sold it to your factory for FMV. So therefore, the FMV minus the cost will become your agricultural income. Now, because you sold it to your factory at FMV, the cost for factory will also become FMV. That will become the cost of the raw material. Add your further processing cost, add your final sale value of basmati rice, and that total will become PGBP. And the total will become PGBP. So how do you do it in a simple format is that you will assume that you are selling it from your land to your factory. At what rate? FMV. We discussed the same thing somewhere else. Very good. Conversion of capital asset into stock in trade. Selling of your capital asset into stock in trade. You sell and you buy a stock in trade. Same concept. You are selling from your land and you are buying it from a factory. But this thing did not work out so well for some special cases. What are the special cases? Tea, coffee and rubber. These three cases did not work. So they told, boss, nothing doing. I will give you the mechanism. You do one thing. You compute the PGBP for the full year. Agriculture indalo enna, factory indalo enna, take everything together. If it is a business from rubber, 35 will become PGBP, 65 will become agri. 35 PGBP, 65 will become agri. If it is from tea, 40 will be PGBP, 60 will be agri. Agri. 40 will become PGBP, 60 will become agri. If you are into coffee, split into two. Check if there is 2 words or 4 words. If there is 2 words, it is 25, 75. What are the 2 words? I don't know. Growing? Curing. Acha, growing and curing is 25-75. Then? If I am roasting you, that is higher. Yes, if it is 2 words, it is 25-75. If it is 4 words, it is 40-60. That's all I remember. That is how I passed my exam. Yes, if it is 2 words, it is 25-75. If it is 4 words, it is 40 and 60. That's all as the provisions. Yes, you will take your whole PGB for the year and you will split it into 25-75, 35-65, 40-60. Whatever it is, that lower will become PGBP, higher will become agricultural income. Higher will become agricultural income. Here is where they have again clarified one more item for you. They have come and told that, let's say you have an asset which you have used in the tea business. You have what? You have an asset which you have used in tea business. Now you are going to claim depreciation. You are going to claim depreciation. When you are going to claim depreciation, 40% of that will become taxable, but 60% of that will become exempt. So in that case, will you claim depreciation only for 40? No, you have to claim depreciation full. You have to allow for the full depreciation. This is an exception to the motor car case which we discussed. In the motor car case, personal load case will become ignored and you will claim depreciation only for the official thing. But here, you will have to claim depreciation for the full thing. Correct or not? Here you will have to claim the depreciation for the full thing. With this getting over comes the last concept called as partial integration. This concept basically comes and says that if you have normal income and you have agriculture income, tell me one simple question. Are you having slab rates or are you having fixed rate? If you have a fixed rate, taxable, exempt. If you have a fixed rate, anyway this provision will not apply. Whatever is your agriculture income, take it and exempt it off. If you have slab rates, tell me, are you earning poor agriculture or are you earning rich agriculture? Which means if your agriculture income is 5,000 or less, or it is more than 5,000. If you have earned only pennies, 5,000 rupees, now I do not want to check with you. Agriculture income will continue to be exempt. But if you have earned more than 5,000 rupees, I will introduce a new concept for you called partial integration. Pure silent adjustment, exam li எப்பவுமே வராது. கொடுக்க மாட்டாங்க எக்ஸாம்ல கொடுக்க மாட்டாங்க, நீ தான் பண்ணணும். Yes, the provision will work like this. What they are coming and telling is, first of all, take your incomes and add the agriculture income to it. Take the incomes and add your agriculture income to it. Now compute taxes. Generally agriculture income would have been exempt. But now what you will do is you will take your normal income, take your agriculture income, club both together and compute taxes. Step number 2, take your basic exemption limit and include your agriculture income and then compute taxes. Take your basic exemption limit, add the agriculture income and compute taxes. Step number 3 is what? Step number 1 minus step number 2. That's all is the provision. Step number 1 basically comes and says, take your total income, add agriculture income and compute taxes. Step number 2 is take your basic exemption limit, add agriculture income and then compute taxes. Step number 3 is step 1 minus step 2. What will happen with this is that the income to the extent of agriculture income will become exempt, but anything, the slab will change for you. For the normal income, the slab will change for you and you will end up paying higher taxes. But here is when I want to clarify to you, this provision again only applies in case your normal income is higher than basic exemption limit. This only applies in case where your normal income is higher than basic exemption, because if that is not the case, what will happen? Step 2 will become more. Government will not give you single refund and all. Government எதுமே கொடுக்க போறதில்லை. Yes, your case only happens to increase taxes. It cannot end up decreasing taxes. Step 1 should always be higher than step 2. Step 2 cannot be higher than step 1. A full sum on that is there in the material. You can go through the material, you will find the sum in that as well. Clear? Yes. So now we are done with agriculture income also. Gross total income, chapter 6A, 10AA, total income, 115 BAC, normal, AMT, agricultural. What is left? Now you have your tax in your hand. What will you do with the taxes? You will have to pay. You can pay by way of 4 items. We are into the chapter called payment of taxes. In the payment of taxes, you have to pay these taxes. How will you pay these taxes? Either you can pay the taxes during the previous year or you can pay during assessment year. If you are paying it in the previous year, which means you are paying in advance. Therefore, the tax name will be called as advance tax. If you are not paying it but someone is paying on your behalf, this is called TDS. So the two things which can happen in previous year is TDS or advance tax. If that is not happening in previous year, you will come to assessment year and you will pay self-assessment tax. You will pay self-assessment tax. If that is also not happening, assessing officer will open your books and he will ask you for regular assessment tax. Assessing officer will open your books and ask for regular assessment tax. These are the 4 taxes which you will pay for inter-level. These are the 4 taxes which you will pay for inter-level. Either a self-assessment or regular assessment is not there for syllabus. Self-assessment, regular assessment is not there for syllabus, which means you have to read only advanced tax and TDS. You have to read only advanced tax and TDS for November attempt. For November attempt, there is a new tax coming in. There is a new tax coming in. Are you bothered? Don't be bothered. Yes, you have 2 taxes right now for your November attempt, which is advanced tax and TDS. You have advanced tax and TDS. We will cover advanced tax. Go to return filing. Then I will ask you to sleep, and then we'll do TDS. Yes, so we'll now do advanced tax. This is basically where what is happening is you are asking someone to pay taxes in advance. You're asking someone to pay taxes in advance on an estimate basis or an actual basis. Estimate basis. You're asking someone to pay estimate basis. So basically what they have come and told is you should be a person who has to have an advance tax liability more than 10,000 rupees. You should have an advance tax liability of more than 10,000 rupees. If your advance tax liability is more than 10,000, you have to pay advance tax. How many quarters? 4 quarters, except for presumptive AD and ADA. Except for presumptives AD and ADA. In these cases, you can only pay in the 4th quarter and close it. You can only pay it in the 4th quarter and close it. Other cases, you have to pay advance tax in 4 quarters. But they have given an exception to you. They have come and said that if you are a resident senior citizen not having PGBP income, you should be a resident senior citizen not having PGBP income, don't pay advance tax. Don't pay advance tax, meaning you should not pay anything. You can also pay by way of self-assessment tax. Even if you pay by way of self-assessment tax, I will not levy something called as interest. I will not levy something called as interest on you. So you can continue to pay taxes. You have to pay taxes, just that I will not levy any kind of interest. For those people who have to pay advance tax and don't pay advance tax, what will happen? Nothing. The only thing which I'll tell you is now you have to pay interest to the government. This interest will happen in 3 models. 234 A, B, C. You want to go A, B, C or CBA? CBA. Let's go CBA. You start from 234C. This happens in the previous year itself. Where what has to happen is you have to check for your 4 quarters. You have to pay on the 15th of the last month. Meaning April, May, June you will pay. 15 June, July, August, September. 15 September, October, November, December. 15th December, January, February, March. 15th March. These are the 4 quarters. You have to pay it on those days. How much do you have to discharge is that you have to discharge minimum 15% in the quarter 1. Up to quarter 2, you have to totally pay 45. Up to quarter 3, you have to totally pay 75. By quarter 4, you should pay fully. Question to you, if you pay any kind of payment during 16th March to 31st March, it will be called as? It will continue to be called as advance tax for the purpose of 234B. But for 234C, you will still have interest. So the numbers are 15, 45, 75, 100. You have to minimum discharge 15, 45, 75, 100. In your exam, they will give a simple mokkyaaro question. 4 mark. 4 mark enna question varo theriyuma? You have been given a tax liability. How much tax should you pay in every quarter na kepa? How much tax you have to pay in every quarter? So your tax liability is how much? Your tax liability is 100. They are asking you how much tax to be paid every quarter. Quarter 1 you will pay 15. Quarter 2 you will pay 30. How much will you pay? That's 4 mark. How much will you pay? You will only pay 30 because you have already paid 15. If you pay 45 here, how much will you end up paying? So you have to pay 30. How much you have to pay? You have to pay 30. Quarter 3, how much you have to pay? 30. Quarter 4, how much you have to pay? 60, 75, 25. This is what you have to pay. This is how the question will read. That's all. In the question, correct panna 4 mark avladhaan. Thana pooram. Yes. So how much will it come is you have to understand the English properly. If they come and say what is the minimum tax to be paid, that is 15, 45, 75, 100. How much you have to pay? You have to pay this much. How do you check? You have to cumulatively pay 45. Let's, for an instance, assume that you were supposed to pay how much? 15. What happened is you unfortunately ended up paying 11. You have a shortfall of 4. You have a shortfall of 4. What will happen is they will come and say, and the 4 rupees I want interest at the rate of 1% for the next 3 months. I want interest at the rate of 1% for the next 3 months because you have not discharged your advance tax on time. For the next 3 months, you are going to withhold my payment. அதான் பண்ணமா ரெண்டு ஒன்று தான்டா 1 into anything is that number only da. Yes, you have done into 1% into 3. Next one, what happened is you have to pay 30. Cumulatively you have to pay 45. You had already paid 11. You had already paid 11. You ended up paying another 30. Which means totally you paid 41. You should have paid 45. Should have paid 45. Interest on this will be 0. Very good.
36.
Very good. Interest on this will be 0. This is where the next concept comes in, is where they have come and told your minimum liabilities are 15, 45, 75 and 100. Your minimum liabilities are 15, 45, 75 and 100. But for the first 2 quarters alone, I have given you a concessional of 12 and 36. 12 and 36. If you have minimum discharge 12% in your first quarter, no interest on you. If you have minimum discharge 45% in your second quarter, 36% in your second quarter, no interest on you. Quarter 3, quarter 4 you have to pay. Quarter 3, quarter 4 you have to pay. So let's for example assume that you have paid only 10. You have paid only 10. Totally you have paid 21. You should have paid 45. You should have paid 45. Minimum you should have paid 36. Did you pay 36? No. Which means you look at 45. So 45 will be compared with 21. Number 24 at the rate of 1% into 3. For the benefit of others, it is into 3%. For the benefit of others, it is into 3%. Coming to quarter 3, how much have you already discharged? 21. You end up discharging another 50. How much did you discharge? 71. You should have discharged 75. Ended up paying loss of 4. So again 4 into 1% into 3. 1% into 3. What happened? How many you have discharged? 71. You have ended up discharging another 10. You should have discharged 100. You ended up discharging 81. Balance is 19 at the rate of 1% into, very good, 1 month. 1% into 1 month because you are in March. 15th March lende 31st March ku 1% da. Yes. So this is how your 234C works out. This is how your 234C works out. But there is an exception to this where they have come and clarified that if you are under 234C, and you are receiving any kind of one-time incomes, in that case you do not have to pay from quarter 1. You can cumulatively pay from the corresponding quarter. Let's say for example, you have a capital gains. Which came to you in quarter 3. What will happen? Will you discharge the capital gains in quarter 1 and quarter 2? No. In quarter 3, cumulatively pay 75. Don't pay 100, pay 75. Cumulatively pay 75. What are these cases? It is capital gains, winnings, dividend income, and any kind of one-time income from business, first time business, any kind of one-time business income. What are the 4 cases? Capital gains, winnings, dividends, one-time businesses, any kind of one-time businesses. All these cases you can end up discharging in the quarter in which you received the money. Capital gains, casual income, dividend income and PGBP income which you have received for the first time. All these cases you can discharge it from the quarter in which you first received the money. Question is like this. You have come and received a capital gains. But you received it in 19th March. When did you receive? 19th March. Could you have discharged it on quarter 1? 2, 3, 4?
19th March, 30th March we can pay.
Could you have discharged it in quarter 4? No. You had to pay it by 15th March. This is 19th March, which means what they will ask you is, in this case, please pay it before 31st March. Even if you don't pay before 31st March, will 234C come to you? No. 234C cannot apply to you. Only 234B will apply to you. If you end up with the capital gains in the quarter 4, post 15th March, you can pay the advance tax by 31st March. Even if you don't pay the advance tax, 234C can never apply. They will capture you in 234B. Yes, these are the provisions for 234C. Coming to the next part of the provisions, which is 234B. This provision basically comes and starts from the assessment year. This provision is basically coming and saying, I asked you to discharge how much of your advance tax? 100% of your advance tax. I asked you to discharge 100% of your advance tax. I gave you the full previous year to do it. You still did not do it. Starting your April of the assessment year, I will start charging 1% interest. I will start charging 1% of interest. What I will charge on? I will charge on the advance tax you have still not paid. I will charge on the advance tax you still not paid. So the advance tax which is in shortfall into 1% into number of months pending. Number of months pending. But they have given an exception here also. They have come and said that if you have at least paid the advance tax of 90%, if you have at least paid the advance tax of 90%, then in that case no interest for you. You can discharge it by self-assessment and close the answer. But if you have anyway discharged anything lesser than 90%, start from 100. Start from 100 and check for the shortfall. Don't start from 90 and check for the shortfall. Start from 100 and check for the shortfall. 90 is only a checkpoint. Correct? If your advance tax to be paid was 100, you ended up paying 91. Will interest come? No. You paid 89. Will interest come? Yes. On 11 or 10? 1. 11. It will come on 11. It will not come on 1. It will come on the 11. Your 90 is only a checkpoint. Your 90 is only a checkpoint. If you do not satisfy the 90, ignore that start and start from the top. Ignore it off and start from the top. This is how the provisions of 234B also works with you. Clear? Yes. With 234B coming out, you last have 234A. What is 234A? Return filing chapter. What is 234A? Return filing chapter. So in this chapter, you predominantly have 234C and 234B. While we have been discussing about advance tax. What the hell is this advance tax? How do you compute what is your advance tax liability? Estimate your total income. Compute the estimated tax liability. Reduce TDS deductions. Next, any kind of reliefs and all which you have, any kind of credits and all which you have. What you have to reduce is TDS deducted, not a deductible. That's the 4-mark question. And the Mokyana 4-mark question, what happened is they gave you tax liability as 150. They gave you tax liability as 150 and they said reduce TDS deductible but not deducted. TDS deductible but not deducted 20. Will you reduce 20? No. You will have to discharge the whole 150 into 4 quarters. This is 4 mark. Yes, sir? Yes. Ignoring that provision. And the second one is how much are you paying? They are not asking you cumulatively. They are asking you how much you should pay in every quarter. You should ask for how many have you pay in every quarter. This is one of the most mockiest chapter. It comes as the 7th question. You have that compulsory question and then 5 questions out of which 4 you have to give. No, this comes in the last question. This is like a giveaway. Okay, suppose fail the aga porana in the question mudichirana maadhiri irukku. Appadina they will give it to you. Yes. So the last question will be there where it will have it. My general thought which I tell to people is that keep the last question on the last. Keep the last question on the last because what will happen is this is the easiest question to crack. Yes, you start with the other questions, you try to complete it. Look at your calendar, look at your time when it is almost at the end of the end of your exam. If you feel that you do not have any more time left, shoot up this question, whatever answers you can solve it and close it off. You will easily fetch your 2, 3, 4 marks at least, whatever it is. Yes, because that also question will be 12 marks. And the 12 marks in the at least or 8 marks will be theory questions. What theory? In the theory. And the EIS madri illa, in the theory. It will be like this theory. Who can file return? When should you pay advance tax? What is the advance tax you have to pay? How much to pay advance tax? And the mari mokke question 4 mark kuthirpa. They will basically be like, "Dey paavama irukada unnu moonji paathu ipdi eludru." Appadina irukum. Yes. So this question is something which I don't prefer you to do in the first instance because neenga first instance le pannitingna extra confidence vandrum. Adukapra the other paper will go for a toss. Yes, you do those questions. When you feel deprived, then you come here. When you feel deprived and you feel like everything is lost in the world, come to this question, answer this question off. Okay, or boost vandra vera onnilla. Yes, keep this question always in the last. And there is one other question. So I think the pattern looks something like this. Your first compulsory question will be a full-fledged question. Your first compulsory question will be a full-fledged question. Second question, they'll somewhere play around your salaries and all those cases. Third question, predominantly will be brought forward losses and clubbing. Clubbing and brought forward irkom. Yes, this is one of the giveaway questions. Brought forward loss and clubbing will be a giveaway question. Eppo paathalu giveaway question. That question you don't have anything except for that one attempt where clubbing went worse. And the question taniya kaamikiram. Except for that one question where the clubbing went worse, that was a different story altogether. But anyway, all that aside, clubbing and brought forward losses, one question, sure 12 marks done for you. So 12 marks anga vandrum. 12 marks anga vandrum. Adu thavara unoda MCQ la you can at least fetch how much marks are MCQ for tax? 18. In that 18 you can easily fetch 10. 10, 12, how much? 22. You come to the 7th question, another 12 marks. 34. Yes, 34. After that you have 5th question. In the 5th question you will have somewhere around residence status irkom. The fifth question will be somewhere around residential status. Along with that, there will be this tedious question. Tedious question you are going to ignore only. No second thought, you are going to ignore only. Yaarku indalo tedious question you are going to ignore only. Yes, so around third or fourth question will be the tedious question. That part of the question you are anyway going to ignore. So 4 mark anga poradha porudhu. Balance irukku 8 marks. That 8 marks will be either a HP question or a capital gains question. HP question or a capital gains question. அதே முடிச்சிட்டா உங்களுக்கு DTல எக்ஸாம்ஷன் வந்துரும். உங்களுக்கு அதுக்கு அப்புறம் IDT இருக்கு பார்க்கலாம். பேசுறது ஓவரா இருக்குல்ல? See, that's fun. See, that's what is the fun, you know. When you're sitting on that side of the table, no, you feel like everything is lost. When you come to this side of the table, you'll be like, "Hey." Now you go to foundation students, no, you'll be like, "Hey, nee dana படிச்சின்னு இருக்கேன். நாங்க foundation எல்லாம் அசால்ட்டா clear பண்ணோம். அப்படி தான இருக்கும். அதுதான்டா. Same thing I am doing right now. அதான் difference. When you go and you short lift your foundation students, I am short lifting you as an inter student. அவ்வளவுதான் difference வேற ஒண்ணும் இல்ல. But trust me, honestly speaking, syllabus is easy. You just have to clear it right. Okay, and this tax paper, the one best thing about the tax paper is you will get step marks at any given point of time. Yes, as long as you are strong on your provisions and you can write the theory also properly, they will definitely give you step marks. Tax is not a paper to fail. Solra, tax is not a paper to fail because you have another paper there. I will not tell you.
Yes.
That's group 2. There is one other paper to fail in group 1. Yes, so the only paper you can score an exemption and you can set it off is that paper only. Vera vali illa. Yes, ITT is also a scoring paper. There's no second thought about it. ITT has a straightforward scoring paper. You can easily score around 40 lende or 20 marks vandrum. Ingla or at least or 30 vandalu you can easily pass off. But other 30 ku mele irukadhu, that additional thing is just your additional inputs which you have. I am not telling that someone has to be extremely brilliant to get that extra 30. You have to use logic avladha. Yes, and the exemptions padikame paatittu expenditure irka 54 BD podu avladha gali. That is how the logic you have to play. Yes, income tax, most likely when you open the question paper, you will find that everything is a giveaway. Avan question la kuthirpan idudanda nee pannanom idu pannittu tholana solvan andha mari irukum. Avan mottaya kuthittan this is the expense, they have not deducted TDS, enada pannom disallow dana pannom avladha. This is the expense, this is the cash payment, enna panna pora disallow dana pandra. That is how the provisions are. Most likely 100% of the question, 12 marks oda first compulsory question la 11 marks will be something which will be a giveaway, and the 1 mark they will play. They will play, no other options. And the 12 marks in the 1 mark they'll definitely play. Someone somewhere in the world they would have thought something about income tax and they will feel they are right. யார் அவனுக்கு லாஜிக் கொடுத்தா யாருக்குமே தெரியல. சடனா திடீர்னு வந்துட்டு they will come and say, okay, final level portionல இன்டர்ல போட்டுடலாம், போடு தள்ளி. அந்த 12 mark questionல suddenly one AMT provision with AOP will come. என்னடா AOP எல்லாம் நாங்க படிச்சதே இல்ல மாதிரி இருக்கும். அதுக்கப்புறம் திடீர்னு வந்துட்டு suggested answers will come. This AOP was a final level portion. If a student has attempted it, we will give marks. ஆனா ஸ்டூடெண்ட் என்ன பண்ணிருக்காரு, அந்த AOP பார்த்துட்டு இந்த கொஸ்டின் பண்ண முடியலையே, கஷ்டமா இருக்கு, 12 marks பண்ணோமா, சரி ஸ்கிப் பண்ணிடலாமா, மொத்தம் ஸ்கிப் பண்ணிடுவாரு. இதுல you will think about it, you will think you know the syllabus, you forgot to do it. அதனால you will suddenly, in your head you will start, அந்த 189 pages இருக்கு, chapter number 1ல இருக்கா, chapter number 2ல இருக்கா, 3ல இருக்கா, 4ல இருக்கா, வரலையே. You will sit and waste 40 minutes on that. And examiner என்ன சொல்லிருப்பான், தப்பு क्वेश्चन பா, உனக்கு 2 மார்க் நான் இப்பவே கொடுத்திருப்பேன், அந்த 2 மார்க்னால நீ 40 minutes waste பண்ணிருக்க. ICI exams are a matter of game. You have to play the right card, that's all. You have to play the right card, there is no second thought. I always tell one thing to my students, do not spend more time than what you have in your head. If you have not got the answer in the first instance, you will never get the answer. நீ எவ்வளவு யோசிச்சாலும் வராது. If you cannot find the answer, see the point is ICI works on guts. Straightforward நான் சொல்றேன், நானும் பாஸ் பண்ணது gutsல தான். Okay, you have to play with your gut feeling. அந்த gut feelingல உனக்கு அந்த ஆன்சர் தெரிஞ்சதா போடு, அவ்வளவுதான். நீ அதுக்கு உட்கார்ந்துட்டு இன்னும் 5 நிமிஷம் யோசிச்சா அதுக்கப்புறம் உனக்கு 4 வார்த்தை இன்னும் வரும். You will suddenly feel like, அந்த 5 நிமிஷத்துக்கு you will sit and you will suddenly, PGBP ல இருந்து சடனா கிளப்பிங்க போய்டுவே, கிளப்பிங்ல இருந்து IFOS க்கு போயிட்டு இது இன்டைரக்ட் டாக்ஸ்லயும் இருக்குல்லடா, TDS சாப்டர்ல போடு. தேவையா இல்ல. Go to your question, 1 mark question, 1.5 minutes for you. அந்த 1.5 minutesல உனக்கு ஆன்சர் வரதா போடு, வரல காலி விட்டுரு, வேணாம் அந்த மார்க்கே வேணாம். அந்த 1 mark most likely if you are strongly well, you will realize that the suggested answer will come and say it's a wrong question. You have to have that kind of confidence. The confidence which I ask my students to have is that when you enter the exam hall, if you see the exam paper and you know the answer, you know the answer. You don't know the answer, that is out of syllabus.
Because no matter how much you try, it is not going to come to your head. It's not like the other person is going to tell you, because the other person is already crying there. அவன் என்னதான் பேச போறான்? அவன் anyway he is ready to shut this paper and leave. அவன் என்னதான் பேச போறான்? உனக்கு nothing is going to talk. Play with your gut. Straightforward play with your gut. உனக்கு கரெக்ட்னா கரெக்ட், தப்புனா தப்பு, முடிஞ்சு போச்சு. You cannot sit and waste time. You don't have 3 hours is what you are deciding for 6 months. Do you want to spend your 6 months for the 3 hours? Play with your guts. Get the answer, close it off. The one thing which I always tell someone is to come in the exam hall, come outside and tell, I have completed 100 marks. I have completed 100 marks, not by writing. By telling that 80 marks is what I knew, 20 marks is out of syllabus. அப்படிதான் இருக்கும், வேற வழி இல்லையே. பிகாஸ் உனக்கு தெரியலன்னா சிலபஸ்க்கு வெளியில தான் அது. That is how it is. Yes, you cannot help it out, and that's how you have to play confidence. No other options. That is why I keep telling people tax is easy, because it is only easy to the extent you know. What you don't know is never easy. அது வர போறதே இல்லை anyway. Doesn't matter. Yes sir. Play with that kind of confidence. You have to enjoy life and go. That's what I tell people. When you enter the class, you have to enjoy life as it is, because this will never come back to you. The kind of the thrill which you have in an inter class will never come back in a final class. I can guarantee you that. The thrill which you have in your articleship will never come after you qualify. நான் சொல்லிட்டு இருக்கேன், காண்டா இருக்கு. அப்படிதான் இருக்கு. I suddenly feel like going back, but then I realize no திருப்பி clear பண்ணோம் வேணாம். This is a different ball game altogether. The thrill which you have right now is something which you are going to miss for all this while. So enjoy life as it is. It is okay. The depression will come, the difficulty will come. Doesn't matter. Doesn't matter. It is all important. Everything is a part of life. No one has cleared with wonders. No one will come and say today, and ஒரு ரெண்டு மனுஷன் இருக்காங்க பாருங்க, அகர்வால் வச்சிட்டு இருக்காங்க லாஸ்ட்ல, we have cleared it like 10th standard, 12th standard, எல்லாம் கூத்தம் தான், nothing else. There is a 2 people sitting in some Faridabad, I don't know where nonsense they are sitting. They come and they give open statements on the media channel saying CA is as good as 10th standard. நான் 10th standard க்கு இவ்வளவு கஷ்டப்படல, CA க்கு கஷ்டப்படல. I did more difficulty for 10th standard than CA. அசிங்கமா மிஸ்டர், எனக்கு வந்துட்டு இதை அடிச்சிருமே மாதிரி இருக்குது. முக்காவாசி பார்த்தா அந்த ஆள் ஆர்டிகல்ஷிப் கூட பண்ணல, டம்மில பண்ணாரு எல்லாமே. அவனுக்கு ஈஸியா தான் போக போறது. அவன் he sat for the whole 3 years sitting and mugging up finals. அவனுக்கு என்னதான் ஈஸியா, எல்லாத்துமே அப்படி தான் இருக்கும். What is the point of life? Nothing. அவன் இப்போ ஃபேக்கல்ட்டியா இருக்கா, அது வேற விஷயம். Anyway, all that aside, coming back to the syllabus. Yes, we are wasting a lot of time on this. Clear? Done. We are done with the one chapter called payment of taxes. We are done with the one chapter called payment of taxes. Go through your material and tell me how many are left off.
Return filing TDS.
அவ்வளவுதானே. Return filing TDS, exemptions. Return filing TDS and exemptions there. I am quickly closing exemptions in 3 lines. I am quickly closing exemption in 3 lines. Exemption number 1, any kind of share of profit for a partner is exempt. Any kind of share of profit for an HUF is exempt. Any kind of awards which you get from a government is exempt.
Pension for partner.
adanda. And the fourth thing is, if you are a Sikkimese person, whatever Sikkim income you get or whatever other passive income which you get will become exempt. But if you are a Sikkimese women marrying non-Sikkimese person, that will become chapter over. அது தவிர இருக்கிற exemption chapterல உனக்கு whatever is there is all useless. That exemption chapter has 3 pages, I think. 3 or 2 pages are. 2 pages. In that exemptions 2 pages. First, second, நடுவுல வந்து அந்த லாஸ்ட் வந்து and நடுவுல வந்துட்டு அந்த awards. அது மட்டும் ஞாபகம் வச்சுக்கணும். இந்த 4 மட்டும் ஞாபகம் வச்சா மத்ததெல்லாம் useless. Everything is ignored. Clear? And then the நடுவுல வந்துட்டு அந்த MPs and MLAs இருக்கு. நடுவுல வந்துட்டு MPs and MLAs இருக்கு. That is anyway not coming for your exam. They will never question MPs, MLAs. வேணாப்பா. அந்த பக்கமே போ தேவையில்லை. Never MPs and MLAs are coming in your exam. நீ பை மிஸ்டேக்கா கூட ஒரு தப்பான ஒரு பேர் வச்சுட்டு நான் காலி தான். I still remember final level there was one my exam there was a final level FR paper, accounts paper la they gave a consolidation question. என்ன question? Namu and Ragava. Namu Limited got merged with Raga Limited. Namu is our current prime minister. Raga is the fighting prime minister. They gave a question saying Namu and Raga are planning to merge together. Sama politics. And the paper went for a toss. ICI வந்துட்டு எங்கே போயிட்டு ப்ளீட் பண்ணாங்க. ஏன்னா BJP and all came down. சரி வேணாம். Yes. So all these fun will happen. Never they will test MPs and MLAs in your exam. You can rest assured, be confident about it. You can rest assured, be confident about it. Individuals, firms coming for your exam. That's all. That is what is coming for your exams. நான் சொன்னது provision மட்டும் தான் வரப்போகுது. அது தவிர anyway if it comes out of syllabus now. Clear? Yes. Last 2 chapters for you. We are getting into the last 2 chapters. I will take 1 solid hour for TDS. And I'm going to take 10 minutes for return filing. ரிட்டர்ன் ஃபைலிங் அப்புறம் பிரேக் தான்டா. அதுக்கப்புறம் பிரேக் தான் உனக்கு. நீ நான் தூங்க போகிறேன், நான் பேச போகிறேன். நீ தூங்க போகிற, நான் பேச போகிறேன். அப்படி தான் ஆக போகிறது. கிளியர்? We are into return filing chapter. Yes, we are into return filing chapter. This is the chapter which comes and tells you that once you have paid your taxes, you have to go and disclose it to the government. You have to go and disclose it to the government. How do you disclose to the government what is your tax, how much have you paid, how much is left over? By way of return filings. By way of return filings. So the provisions are like this. They have basically come and told, I want to understand whether you are liable for return filing or not. I'm asking you whether you are liable for return filing or not. How do you check? They have told that you check and tell me first who are you. Check and tell me who are you. If you are a firm or you are a company or any other kind of people, do you have any basic exemption limit? No, which means you will be ending up paying taxes every time. So therefore return filing for you is mandatory. Return filing for you is mandatory. Left off is slab rate people. Left off is slab rate people, individual HUF, AOP, BOI, AJPs and all those people. They have basically come and said, do one thing boss, what is your gross total income? What is your gross total income? From that you remove off all your exemptions under capital gains. Remove off all your exemptions under capital gains. Take this income and tell me whether it is more than basic exemption or less than basic exemption. What will you check for? You will check for gross total income, removing all your basic exemption or removing all your exemptions, and check whether that is more than your basic exemption or less than basic exemption. Why are we doing this? Can we not check directly total income? Because anyway, if you file a return for this, what is your tax liability? Zero then. If you are going to take gross total income and check for his basic exemption limit, finally total income, if it comes as less than 2,50,000, then you will anyway have to pay no tax. Then why are you filing returns? Because our officer wants to check. The officer wants to check whether the exemptions which you claimed is right or not, whether the deductions which you claimed is right or not, whether the exemption which you claimed is right or not, and the deductions which you claimed is right or not. So they basically came and said your gross total income excluding your exemptions under capital gains, if it is more than your basic exemption limit, I want you to file returns. I want you to file return. These are your general provisions. These are your general provisions. But starting your November attempt, you have some more amendments. Starting a November attempt, you have some more amendments. These provisions basically are coming and saying that even if you do not have any kind of basic exemption limit satisfied, even if your basic exemption limit is not satisfied, if you fulfill these conditions, I still want you to file a return. I still want you to file a return. What is this condition? This first condition they told, if you are incurring any kind of electricity expenses, if you are incurring any kind of electricity expenses, the electricity expenses which you incur should be more than 1 lakh. If you are incurring expenses of more than 1 lakh in electricity, how the hell do you not have so much income? Question number 1. Yes. So first thing which they came and told us, your electricity expense should be more than 1 lakh rupees. Second thing they came and said is, for foreign travels and all, you have incurred more than 2 lakh rupees. For foreign travel, you have incurred more than 2 lakh rupees. Whose foreign travel? It doesn't matter. It doesn't matter. You should be the one paying. You should be the one paying. Even if it is a foreign travel of someone else, if you are the one paying, you have to file return. They will not file return. So whoever is paying, if the person who's paying has paid more than 2 lakh rupees for a foreign travel, in that case also I would like you to file a return. In that case also I would like you to file a return. Third case is where they're coming and saying, if you have deposited more than 1 crore rupees in your current account, how much have you deposited? 1 crore rupees in your current account. If you can deposit 1 crore in current account itself, then where is the question of you not filing returns? So you have to mandatory file your return. What are the 3 we learned till now? Electricity of 1 lakh rupee, foreign travel of 2 lakh rupees, 1 crore in current account. This was what was there till May attempt. This was what was there till May attempt. November attempt has 3 more. November attempt has 3 more. Current account you told 1 crore. Savings padi. Savings padi. So savings becomes 50 lakhs. If you deposit more than 50 lakhs in savings, then also it becomes mandatory return filing. Then also it becomes mandatory return filing. And then they went into PGBP parts. They went into PGBP parts where they came and said, if your aggregate turnover, or gross receipts is more than 60 lakh rupees for a business, is more than 60 lakh rupees for a business, or 10 lakhs in case of a profession. 60 lakhs for business, 10 lakhs for a profession, then also I want you to mandatory file a return. I want you to keep this as very important because this just came for November. This just came for November, 100% being tested. And the problem is in the numbers, tally pannona theriyadu. How do you remember 10 lakhs? How do you remember 60 lakhs? I don't know. Some random number came. Yes, normally for every number I will give you a logic. In the number can logic illa.
புதுசாக கொண்டு வந்திருக்காங்க. Yes, so your gross receipts of profession has to be more than 10 lakh rupees and your gross receipts of business has to be more than 60 lakh rupees, in which case what will happen is I will still ask you to file a return mandatory in the current year. And the last thing is where they're coming and saying whether or not you're filing return. Whether or not you're filing return, I open up your TDS return. I open up your TDS and I find that for other people, have actually deducted more than 50,000 rupees in case of a resident senior citizen, or half of that 25,000 in case of other senior citizen. You anyway have to claim a refund. Refund can be claimed only by way of filing a return. Appa, how did you not file a return? File a return. Clear? So these are the new 3 things. What are the 3 things? First is that you have to have a deposit of more than 50 lakhs in savings, turnover more than 10 lakhs in business, 10 lakhs in profession, 60 lakhs in business. 10 lakhs in profession, 60 lakhs in business. And the last thing is you should have a TDS in your return. TDS in your return for more than 50,000 in case of resident senior citizen, 25,000 for other people. In that case, you have to mandatory file your return. Apart from that, they are basically coming and saying, if you are a person who's having accounts outside India, if you are a person who's having bank account outside India, asset and all outside India, I want you to file returns in India. But if you are not the beneficiary of it, if you are not the beneficiary or beneficial owner can file the return, beneficiary does not have to file a return. Whoever is the beneficial owner can file the return, in which case the beneficiary does not have to file a return. This is what the provisions are when it comes to filing of return of income. With this filing of return of income, the next question which you have to ask yourself is when to file return. You have to file your return on 31st You have to file a return on 31st October. If you are liable for audit. If you are not liable for audit, you can file it by 31st July. Other than that, the third limb is not applicable for you. 30th November is not applicable for you. That has been clarified as final level portion. For your exams, there are 2 due dates, 31st October and 31st July. If you opt for presumptive, you have to opt for 31st July. If you don't opt for presumptive, you have to opt for 31st October. Suppose if the firm is liable for audit, the due date for the firm becomes 31st October. What will happen to the partner? Partner also will become 31st October. Although partner may individually not be liable for audit, because the firm is liable for the audit, the partner will also become liable for audit, because partner order income is basis the firm's income. This is what the provisions are when it comes to due date of filing of return of income. The next part of the provisions we have already discussed in set of chapter. In set of chapter, we have already discussed that for every loss which you want to claim, you have to file a return on time. If you don't file a return on time, what will happen? It will lapse. Only for those 2 cases you will not lapse. HP and unabsorbed, that will not lapse, that you can still claim even if your return filing is done late. Let's say for example, you were supposed to file return, you forgot to file a return. Will you sit silent? No. What will you do? You will file a belated return. Belated return is covered here, and they basically come and say if you forgot to file your return on 31st July or 31st October, starting May and November, you have to do it on 31st December. This is an amendment for the current attempt. You have to do it by 31st December of the current year itself. Last year it was something else. Next year it is something else. Vanama? Seri, okay. Yes, if you do not file your return on time, you can end up filing your belated return on 31st December. You can file your return by 31st December. But if you are filing a return late, you will have certain problems. First problem is loss will go. Second problem is because you did not file your return on time, you will have something called late filing fee. What does this provision come and say is, if you are not filing your return on time, I will levy mandatory late filing fee of 5,000 rupees. But if you are a poor person having total income less than 5 lakh rupees, if your total income is less than 5 lakh rupees, you will have to pay 1,000 rupees. Why are they telling that? Total income less than 5 lakh rupees, generally rebate la tax 0 vandrum. The only case where it cannot happen is when you have a 112A case or you have a special tax rate case. And the case la mattum unga tax payable irukum, adu generally you will have 0. Therefore they told pay late filing fee of 1,000 rupees. So first problem which you will have is loss is gone. Second problem which you will have is you will have to pay a late filing fee. Third problem which you will have is your heading C of chapter 6A is out. Meaning 80 JJAA, QQB, RRB. These deductions are out for you, you cannot claim it. And the fourth thing is that you will have an interest under section 234A. This provision basically comes and says that if you failed to file your return, If you failed to file your return and there was a tax liability in that return, what should be there? There should be tax liability in that return. Then in that case, what will happen? From the date on which you had to file your return, which means 31st July or 31st October, till the date on which you file your return, you will be levied 1% per month or part thereof. 1% per month or part thereof. Absolutely no exemptions, directly interest. No 90%, no 12%, no 36%, nothing. Interest etcha abdiye gali. And all these interests are disallowed also, PGBP. All these interests are also disallowed for you under PGBP. So these are the 4 problems which you will have. Let's say, for example, you filed your return. Let's say, for example, you filed your return, but later on found out that there is a mistake in the return. You can file a revised return. You can file a revised return. This revised return due date is same as belated return. This due date is same as belated return, which means you can file it by 31st December. You can file it by 31st December. Belated return is also 31st December. Revised return is also 31st December. 31st December, now what date? 31st December 2000. Which previous year are you writing exam for? Which assessment year will you file return for? When will you file your return?
31st October 22.
You will file your return on 31st October 22, for which the belated return will be 31st December 22, and revised return will also be 31st December 22. These are the dates which you have to remember. Next exam, next dates will come. Next exam, next dates will come. This is your belated return and your revised return. This is a belated return and your revised return. Question to you: can you revise your belated return? Can you revise an original return? Can you revise a revised return? Yes. Any number of returns can be revised as long as it is done within 31st December. As long as it is done within 31st December. After this, I think nothing is there in the syllabus. The chapter is kind of done. Apart from that, one simple question, MCQ tape. MCQ questions I am asking you. Yes, you are an individual. Who will file your return? Self. If you are a firm, who will file your return? Partner. If you are a company, who will file return? Company secretary. MD. MD is the owner of the company. Who will file the return? MD will file the return. MD not available. Any other director can file the return. Designated partner not available. Any other partner can file the return. Company is in liquidation. Liquidator will file the return. You are a non-resident. You are a non-resident. Either you file yourself. If you cannot file yourself, you appoint someone and do power of attorney. You appoint someone else and he will be a power of attorney agent basically. Yes, agents will file your return. In a simple straightforward question. Yes, with this your return filing is also done. PAN and all I am not going to discuss. In the numbers limits it comes once in 4 attempts. It comes once in 4 attempts. It comes in once in 4 attempts in the 7th question. In the 7th question, once in 4 attempts will come where they will ask you what is the limit in which you have to denote a PAN. What is the limit in which you have to quote a PAN? Numbers and all, even I cannot remember, even you cannot remember. If you can remember, you are Devta. I am not going to teach you. I am not going to teach you. I don't know how to remember it also. Yes, all these provisions are not important for your exam because this keeps changing. This keeps changing. What are they basically coming and telling? You have a PAN number, you can link it with your Aadhaar. You can link it with your Aadhaar. What do? Every year you keep amending it. Every year you keep amending it, but now they put a hard stop. Now they put a hard stop. There is a, now they put a hard stop where they have come and clarified that by 31st March of 2022, your previous year, by 31st March of 2022, you should have linked your PAN and Aadhaar. You should have linked your PAN and Aadhaar. If you did not link your PAN and Aadhaar, no problem. Link it on 23. If you did not link your PAN and Aadhaar, no problem, link it on 23. But the problem is, after March, I will levy something called as late filing fee. After this, I will levy something called as late filing fee. Last year, I was keeping on extending it. This year, I told boss, stop. I will extend it, but I will ask you fees. So now they have put in a new fees. This is an amendment for your new notification. The amendment has come and said that you have to now pay 500 rupees if you do it by the quarter. You have to pay how much? 500 rupees if you do it by quarter 1, which means April, May, June. April, May, June. After June, if you do it, pay 1000 rupees. That's all. Yes. Whether it is coming for exam or not, most likely no. Most likely no. Most likely no. Most likely. Suddenly, or MCQ Rahul unnale or mark pochna. Yes. Clear? Done. Let's go for a break. We will be back at 3:50. You can all close your books. Jaliya ukkaranga na pesran. He is doing the same thing I told in the class, remember? Huh? You go and ask 5 more questions to someone else, he will get depressed and he will not attend next time. நீ ஒரு 4 கான்செப்ட் கேளு. Yes, shall we everyone? Close your books, relax, no problem. Close your books and relax. Honestly speaking, close your books and relax. See, I understand this is one chapter. 1 second. Yeah. Close your books and relax. I understand this is one chapter which is not easy. Yes, the name itself is tedious. The name itself is tedious. It's supposed to be tedious. There is no second thought about it. What I'm going to do is that I'm going to tell you there are certain sections which you have to remember for your exam. Yes, I will skim through only those certain sections for you in the exam purposes, and we will close with that. That's all is what I'm going to do. I do not want you to open your books or anything and keep, because it is not going to help. It's not going to help. I'm going to run like hell. Yes, and you are going to listen like hell. That's all is the problem. Yes, my only request when it comes to TDS is that once I've done the marathon right now, go home, take some break, enjoy your life. Tomorrow, sit back on this chapter alone once again. Go through the material, read it once again. This marathon anyway, this is going to be there on the online. Okay, I will sit on the night and I will prepare that story timeline. So I will prepare the story timelines and I'll give you TDS or a story timeline. You go click on the TDS story timeline and then you start from there. Okay, I will do all that efforts for you. My only request is go home, read through this chapter, and then go back to the marathon again and see if you understand it better. Because right now I understand you people have come blank faces. Moonjile theridu. Yes, so no matter how much I talk, it doesn't matter. Because if you have not read through it, it's anyway not going to help. Okay, so it's going to be more like a story for me and more like a listening for you. That's how it is going to be. Yes, so the only thing which I'm going to request is, anyway, it's okay. We have already done a good amount of syllabus. Yes, we've already covered 56 marks of the syllabus. There is nothing else to do. 56 marks of the syllabus is done. Left off is only 4 marks, which is in TDS chapter. Yes, this 4 marks, whether you attend or not, is your choice. I'm not going to push you. 4 marks is whether you attend or not is purely your choice, and it's going to be a part of the non-compulsory question. So which means you just have to take a chance with the other 2 questions. If the other 2 questions are also something which you don't know, leave and go, great enough, which means you're already knowing 60 marks. If you feel like no, the other 2 questions are something which is strong enough, then you'll have to take a chance with the 4 marks. Does the 4 mark make an impact? Inge pass ke mukkurdu. Correct then? Yes, keeping that in mind, let's start with this chapter. I will basically tell you as to how to go through it. First I have to open it. Done. Yes, we are going into the chapter. I'll tell you the same logic which I told last time. I'm going to talk what I know. எனக்கு மைண்டில் என்ன வருது நான் அதுதான் பேச போகிறேன். தட் இஸ் வாட் இஸ் ஃபைனல் ஃபார் யுவர் எக்ஸாம் ஆல்சோ. அது மட்டும் படிச்சுட்டு போகணும். அது தவிர எதுவும் வந்துச்சுன்னா அவுட் ஆஃப் சிலபஸ். அப்படி தான் படிக்கணும். எஸ், பிகாஸ் இஃப் ஐ நோ சம்திங் தட் இஸ் கமிங் ஃபார் எக்ஸாம், இஃப் ஐ டோன்ட் நோ இட் இஸ் நாட் கமிங் ஃபார் எக்ஸாம். Yeah, that's the same logic for you also. Yes, this is how we are going to approach the chapter. Be calm, that's okay. See, never come and question Rahul saying that, Rahul, you're telling me to do this, you're telling me to do that, what if I fail? Anyway, things are going bad only. Might as well try this. Yes, I've already tried your harder approach, never worked out. Try the softer approach, I will say. Yes, anyway, that thing did not work out, why not try this? No, there's nothing to lose anyway. For every May, there is a November. For every November, there is a new faculty. A lot of people sitting here is because there is new faculty only. I am a new faculty for them.
Yes. Anyway, all that jokes aside, on a serious note, this is one of the important chapters because it's logical based. Now, as much as it might not be relevant for your exam, the moment you enter your market, this is one chapter which everyone will test you for. If you enter this field for tax, I mean, if you do enter the field for taxes, TDS is the one chapter basis which you will be tested. So you don't have a thought. You have to anyway crack this paper with the TDS chapter involved. Okay. There is a lot of provisions. I do agree. There is a lot of limits and all to be agreed. What we'll do is we will understand only some smaller limits and we'll try to club everything together and do it. Let's understand first what the chapter is about. Chapter is basically coming and saying that, boss, instead of you paying advance tax, instead of you paying self-assessment tax, instead of you paying regular tax, whatever it is, let me do one better thing. Let me tell the other side of the party to do something as form of TDS. This is called as a tax deducted at source. I am telling the other party for the expenditure he is going to incur, he is going to deduct something called as TDS and give it to the government, which means before he makes the payment to you, he has to ensure that he will split the payment into two. One payment will go to you, the other payment will go to government. If you look at itself, you will realize that the person has now been given two obligations. He has to do it to you as well as to government. Two payments he has to make. Why will he take all that efforts? Because there is a disallowance for it. The provisions basically come and say, I have put an obligation on you to do TDS. I have put an obligation to you to do TDS. If you do the TDS, great. If you don't do the TDS, I will attract something as disallowance under section 40A and 40A IA. What are the disallowances? It is basically for a resident person 30%, for non-resident person 100%. For non-resident persons 100% will be disallowed if you do not deduct in the 31st March. If you deduct but you do not pay it by 31st October. Whenever you do the payment, you will get the deduction. That is what the synopsis of this chapter is. Keeping that in mind is when we'll go forward with this chapter. Clarifications to here is that you do not have non-residents for your exam. Except for 194E. The most provisions which you have is only resident cases here, in which you have 3 where amendments are there, which means 99% adhaan varaporudhu. So on the 4 mark lende 3 mark amendment da varaporudhu, 1 mark is some which will go for a toss. So amendments மட்டும் தான் முக்கியமா படிக்கணும். மொத்த சாப்டரை முடிச்சிட்டேனா அதான். Yes. So what you have to do is you have to take the TDS chapter and then you have to first figure out some ground rules. Ground rule number 1. They will come and ask you why to do, who to do, when to do. Why to do, who to do, when to do. Why to do is what we address right now because it is a disallowance. Who to do is the question. Which is where they have come and clarified that every person has to do it. Except for one person called as an individual or a HUF. Where individual and HUF normally has to do TDS. But I am giving you some specific sections where if your turnover does not exceed 1 crore in case of business and 50 lakhs in case of profession, you do not have to do TDS. What is this 1 crore and 50 lakhs? 44AB. 44AB 1 crore and 50 lakhs is that same court brought forward. Yes. So if you are having an individual or an HUF who has a business or a profession, if the turnover is less than 1 crore or the turnover is less than 50 lakhs, certain sections you do not have to do TDS. But the question is, this 1 crore and 50 lakhs has to be looked for which year?
Last year.
You have to look for the last year. You are right now writing exams for 21-22. So you look for 2021. There are 2 cases where we have discussed. Last year has to be checked in TDS. Last to last year has been checked in. Very good. Last to last year has to be checked in company tax rates. 19-20 will be checked in company tax rate. 2021 will be checked in TDS. What are the 5 cases which are covered here? It's called hijack. HIJAC. 194H talks about commission. I talks about rent. J talks about us. Professionals. J talks about professionals. A talks about interest. C talks about contract. That's all. C talks about contract. For your November attempt, it is hijack. For the next attempt, it is something else. For your attempt, it is hijack. H, I, J, A, and C. These are the 5 cases where individual and HUF do not have to do TDS if the business or the profession turnovers are less than 1 crore or 50 lakhs in previous year. 2021. In the previous year, 2021. But here is where they took a checkpoint and they came and said, sir, wait. For 194H, 194H, J and C, H, J and C, I will give you a new section called 194M. If you are under 194I, it will be covered under 194IB. The only case which is not covered is A. So with this we have now understood who has to deduct TDS. Last thing to understand is when to do.
TDS. When to do TDS? This is where they come and clarify. TDS has to be done on payment or credit, whichever is earlier. Payment or credit, whichever is earlier is when you have to do TDS. But in some cases, they have come and told you have to do only on payment. You have to do only on payment. First case is salary. Second case, they are telling salary related withdrawals, salary related withdrawals. Then any kind of government in the obviously, which means compulsory acquisition. Then any kind of winnings. Kaila vandadana kaasu. Yes, any kind of winnings. And the last thing is any kind of cash withdrawals. Anything of cash withdrawals. These are the cases when you have to do it on payment or credit, whichever is earlier. Payment or credit, whichever is earlier. And then one other thing which we have discussed in IFOS chapter called dividends. One more thing which is called dividends. So with this you have completed who to deduct, when to deduct, why to deduct. Yes, with this you have completed who to deduct, when to deduct, why to deduct. Next thing is how much to deduct. Next thing is how much to deduct. Here they are coming and saying, I will give you a percentage. I will give you a percentage. This percentage is flat, no surcharge, no cess. This percentage is flat. Take this percentage, multiply it with the revenue, give me the number. Take the percentage, multiply it with revenue, give me the number. If you are going to pay interest of 10,000 rupees and the rate is 10%, you will deduct 1,000. You will deduct 1,000, no surcharge, no cess. No surcharge, no cess. But surcharge and cess will only apply in case of salaries or will apply in case of non-residents. Will apply in case of salaries or will apply in case of non-residents. Every other case it is flat. Every other case it is flat. Second question. How much length we should deduct? The point is, you have told 10,000 and 10%. Do you have to deduct 10% of the full 10,000 rupees, or if I give you a limit of 10,000 rupees, do you have to start from 11,000 rupees? I mean 10,001 rupee. You have to start from rupee 1. You have to start from rupee 1. TDS starts applying from rupee 1 except for two cases. Except for two cases. One is cash withdrawals from cash withdrawals from banks, cash withdrawals from banks. Any kind of cash withdrawal which you have from a bank will be liable for TDS only from the number which I have given you. Only from the number which I have given you. And the next thing is your amendment for the current attempt called 194Q. 100% coming question is 194Q. Straight out 2 marks will definitely come for that 194Q. Yes, so 194Q is the next scenario where what will happen is any kind of payment which you do for any kind of purchase of goods. Any kind of payment which you do for purchase of goods. In that case you will have a TDS. In that case you will have a TDS. Yes, so how much to do is when the next question came. Now I told you how much to do with the percentage is given in the act. How much to do is the percentage which is given in the act. But somewhere they came and said, no sir, there is a problem. There is a problem. I am doing this TDS also to understand whether the person is doing proper income offering or not. That person is deducting TDS for me so that I offer the income on time. For me to offer my income, that person should know my PAN number. That person should know my PAN number, which means only if I quote my PAN to him will he know how much to deduct. If I don't even give my PAN number, how will he link? Yes, so they told boss, if in a scenario I am asked to give the PAN number to him and he does not get the PAN number, I do not give the PAN number to him, his rate will double. It will not double. So his rate will become what? It will become actual rate or 20% whichever is higher. It will become actual rate or 20% whichever is higher. This is the first case. This is the first case where it is come and said that if you are supposed to furnish a PAN number and you furnish, great. Don't furnish PAN number, it is actual rate or 20% whichever is higher. But then comes the amendment of the current year. Then comes the amendment of the current year. In the current year, they have come and said that if you are defaulter in filing your returns, if you are a defaulter in filing your returns, then also I have a problem. Then also I have a problem. What he will come and say is, if generally you are not filing your returns on time, or you are not filing at all, if you are generally not filing your returns on time, or you are not filing at all, for which years? Last 2 years. Last 2 years for which the return filing due date is over. Return filing due date is over. Starting on 1st April, which return filing due dates are over? You are in previous year, 21-22. So 1st April 21, which means for previous year 2021, will you file return now? No. Previous year 19-20 you would have filed return. Previous year 18-19 you would have filed return. So 18-19 and 19-20, did you file your return on time is the question. If you had filed any one return on time also, no problem. If you ended up filing both the returns also not on time, then I will come and check in your 26 years, are you having TDS more than 50,000? Are you having TDS more than 50,000 in each of the cases? If yes, then in that case I will tell you are a return defaulter and you have higher numbers to come also. You have a higher number to come also. Your TDS rate will double. Your TDS rate will double, meaning what is the actual rate will become twice or 5%, whichever is higher, whichever is higher. But here is where I have a checkpoint. I am a useless person. I am not giving my PAN also, I am not filing my return also. I am not filing my return also, I am not giving my PAN number also. What will happen? He will take the highest of all. He will take the highest of the all the three, and whatever is the highest will become the tax rate for you. Clear? Clear? Yes, this is your synopsis of TDS. This is your synopsis of TDS. Starting this now, I will tell you which sections to remember, which sections to not remember. Section number 192, ignored. Section number 192, purely ignored. Provision simply comes and says, if you are making any payment to a salaried person, whatever is his tax liability, deduct TDS. That's all. That's all is the provision. Nothing to be remembered. Ignore it off. Next thing is 192A. Next thing is 192A. This talks about withdrawal of Provident Fund. This talks about withdrawal of RPF. Not important for your exams. Next is 193. Not important for your exams. Next is 193. Not important for your exams. It has come once. Let me clarify. It has come once. 193 has come once, and that question was the worst of the questions. That question was the worst of the questions, some 10,000 rupees. That was the day when the examiner was not happy in life. Something went wrong in his home, he took it out on you. That's all. Yes, that is the one-off scenario in 2019 or 18, I don't remember. That one-off scenario, 1 mark question came for 193. And that question was such a question where no one was able to answer. Everyone wrote it wrong. Everyone wrote it wrong. You can't help it. Yes, that was that one day when the examiner was not happy at all. Something went wrong definitely at home. Yes, anyway, whatever happened. The point is, I will clarify you how to read 192, 192A and 193. Straightforward, look at the question. If the question has any weird kind of bond, if the question has any weird kind of bond, 193 padachale paathale national defense bond, in the bond and the bond ella irukku. Yes, you see a weird name which you don't know the answer for out of syllabus now. What will you do? If you see a bond which you don't know, other than NHA and REC, obviously. NHA and REC you should know. NHA and REC you should know. Adu thavara you find any new bond, first of all, adula vandu income exempt. Adukku pudikudhu TDS not liable. Mudinju pochu. Chapter e gali. This is how you have to read. Yes, this is how you have to read. If you get any kind of income from that, that becomes exempt. Do you do TDS on that? Not TDS. That is how you have to read. That was an exception question. Doesn't matter. Doesn't matter. For your exam purposes, you hear any kind of weird names, gold bonds, NPS bonds, this bond, that bond, everything is exempt. Nothing to be read into. Do not remember names and all. In the 4%, 5%, unike theriyala, enako theriyala. When happened this bond, no one knows. Yes, so 192, 192A, 193, not relevant for exam purposes. Coming to 194A. Coming to 194A. This is the first of the hijack cases. This is the first of the hijack cases which talks about interest. Which interest? Other than 193 interest. Other than 193 interest. This talks about interest from deposits. This talks about interest from deposits. 2 limits to remember in this. It comes and says that if you are receiving any kind of interest from banks, if you are receiving any kind of interest from banks, they will come and check whether you are a resident senior or a non-senior citizen. If you are a resident senior or an other scenario, if you are a resident senior citizen, the number is same as TTB. 50,000. The number is same as TTB. If it is anyone other than that, it is 40,000. If it is anyone other than that, it is 40,000. What will happen is, if you have a limit, meaning an interest which you receive in the current year, if the interest which you are going to receive in the current year is 40,000 per annum, in that case TDS will apply. If it is 50,000 per annum, TDS will apply. This is how the provisions are. What are the rate? It is 10%. No, beyond 15,000. Beyond 50,000. 40,000 ka beyond, 50,000 ka beyond. The rate will become 10% of the interest. 10% of the interest. This is what the rule is. This is what the rule is. But the clarification here is, this interest which I am talking about is only your time deposits, which means interest on savings, no TDS. Interest on savings, no TDS. Any kind of interest which you pay to government, no TDS. Government can TDS, putcha galida. Yes, any kind of interest which government takes from you also, no TDS. And any kind of interest which you pay to the partner, no TDS. All these cases are not. But the most important thing in 194A is to understand you are talking about banks, 40,000 and 50,000. The provision works on CBS model. The provision works on CBS model. What is the CBS model? Is core banking solutions. Core banking solutions. The provision basically is coming and saying, if the bank has a core banking solution, what does this core banking solution mean is that the bank level, wherever branch you go, everything will be formulated into a main branch. Everything will be accumulated into a main branch. So if there is a main branch for that bank, meaning if the bank has a core banking solutions, they will look at this 40,000 and 50,000 limit for full year bank fully. For full year, every branch included. For full year, every branch included. But yes, if the bank does not have a core banking solution, 40,000 and 50,000 is per branch. 40,000, 50,000 is per branch. Meaning, if you have a Kotak bank, one in Pushwakam, one in T Nagar. One in Pushwakam and T Nagar. Pushwakam gives you 40,000 of interest. T Nagar gives you 40,000 of interest. You will go and ask Kotak one simple question. Are you liable for CBS? Are you liable for CBS? Kotak says yes. Both together becomes 80,000, TDS applicable. He says no. Inge 40,000 not applicable, Inge 40,000 not applicable, answer over. Clear? This is called a core banking solution. This is what is being tested in 194A. 194A, the only thing to be remembered is interest, 10% is the rate, 40,000, 50,000 limit, 40,000, 50,000 for the full bank if core banking is there, not for the full bank per branch if no core banking there. And it is applicable only on fixed deposits, does not apply on savings account. Clear? Yes, this is 194A. Next comes 194B and BB. 194B and BB, bade log, bahut bade log. Bade log and bahut bade log. You're talking about winnings and horse races. You're talking about winnings and horse races. The rate is the same as the special tax rate, 30% flat. The only difference is that in tax rate you will do 30 plus surcharge plus cess. In TDS you will only do 30%, meaning that surcharge and cess has to be done by way of advance tax, not by way of self-assessment, but by way of advance tax. Yes. So the next provision is talking about winnings, where they come and say if you have any kind of winnings, then if the winnings is more than 10,000, same number. No, same number. If the winnings is more than 10,000, in that case what will happen? They will be liable for TDS at the rate of 30%. They will be liable for a TDS at the rate of 30%. You gave winnings in the form of car.
And collect TDS.
Collect to TDS, then only discharge the car. Collect to TDS and then only discharge the car. You cannot come and say no car. Collect to TDS, then discharge the car. Cannot take a wheel and give it off. Yes, cannot take a wheel and give it off. Give the car only after you collect the TDS from 194B and 194BB. After B comes C. After B comes C. We are in the second limb of our hijack cases. C talks about contracts. C is contract. Yes. What does this provision basically comes and says that you have to be a deductor who is not liable for the limits, and you should be entering into a contract of work, not contract of sale, meaning there should be a works contract happening, job work and all those stuffs. This is a contract of work, in which case what will happen is I have given you two limits. One limit is per transaction, the second limit is per annum. One limit is per transaction, second limit is per annum. Per transaction you should not have a not have a payment more than 30,000. Per year you should not have a payment more than 1 lakh rupee. Per year you should not have a payment more than 1 lakh rupee. If these limits are breached, you will be liable for TDS. At the rate of 1% if the other side person is an individual or an HF. Who is the other side person? Deductee. If the deductee is an individual or an HUF, it will become 1%. If it is a deductee other than individual or HUF, it will become 2%. In the whole 194C, you have to remember a couple of things. The first thing is that it is liable only for a contract of work and not contract of sale. Meaning, for example, if I have to purchase an iPhone, if I have to build an iPhone, I go to a contractor and I come and say, you have to build an iPhone for me. If the contractor is buying the raw materials on himself, then this is a contract of sale. If I am giving the raw materials to him and he is making the iPhone, then this is a contract of work covered under 194C. This can also be duplicated in a scenario that instead of me giving the raw materials, it can be my relatives also. What relatives? 42 relatives. So either me or my relatives can give raw materials to that person. If the person gets the raw materials from me, then this is a 194C case. If it is not getting raw materials from me, this will become 194Q case. It will become a 194Q case. Apart from that, the second thing which they are coming and telling is, if this is a transport operator, if there is a transport operator, if the transport operator comes to you and he comes and says, sir, I do not want TDS on me. You have to tell me once, are you covered under 44AE? Meaning, I will ask him that whether you are having vehicles less than 10. If he says yes, I will tell him, give me your PAN number, I will not do TDS. So the provision basically comes and says, you should be a transport operator who gives a declaration saying that I do not have vehicles more than 10. And here is my PAN number, If you give both, then TDS will be 0. You do not give your PAN number, it will become 20%. You do not give your declaration, PAN you have anyway given, so it is 1% or 2%. Clear? Yes, this is your 194C scenarios. Is there anything else important here? No, nothing of those is important. Directly getting into 194D, ignored. 194D is ignored. Coming to the next part of the provisions, which is 194DA. This talks about life insurance proceeds. This might come, might not come. Okay, this has come once in a while. How this works is that you are looking at a life insurance proceeds. First of all, they are coming and telling you check whether the proceed is taxable or not. You check whether the proceed is taxable or not. How do you check? Go for the ATC limits. Go for the ATC limits. If your premium was less than what the limit is given in ATC, then the proceed is also exempt. Then the proceed is also exempt. If the premium which you are going to pay is higher than the ATC limits, then the premium or the proceed also becomes taxable. What does that mean is basically, let's say you have taken a life insurance policy in 2019. You've taken a policy in 2019 for a value of 1 lakh. For a value of 1 lakh, on that the premium you are paying is 11,000 rupees. You are paying a premium of 11,000 rupees. You could have paid a premium only of 10,000. So deduction on ATC will be 10,000. Adhe madri, the whole proceeds will also become taxable. The whole proceeds will become taxable. What they are basically coming is, why is it not loading? What are they basically coming and saying is, do one thing. Tell me how much is the money which you received. How much is the money which you received? Let's say for example, this proceed was 1 lakh. Sorry, the insurance was 1 lakh. How much are they going to give me? They're going to give me 1,10,000. So they'll ask you how much is the proceed first. I told my proceed is 1,10,000. I told my proceed is 1,10,000. They told okay, 1,10,000. Then you are liable for TDS. Then you are liable for TDS. But on what number? It is not on 1,10,000 because 1,10,000 is your revenue. They told 1,10,000 minus the premium which that person has paid you. Minus the premium which I have paid you, basically the income element. Basically the income element. So from 19 I would have paid how many premiums? 3. 19, 20, 21, 22. 4. So 4 premiums I would have paid. I should have paid 10,000. I have paid 11,000, which means 4 premiums I paid of 44,000. So 1,10,000 in the 44,000 reduce panna. Huh? 66,000. So 66,000 is your income. On that 66,000 worth of income, you will do TDS at the rate of 5%. Yes. So here is where the challenge comes. You have to understand that the proceed which you receive is liable for the 1 lakh limit. The proceed which you receive should be checked for the limit, but the TDS should be done on the income. Limit will be checked on the proceed, TDS will be done on the income. Clear? And that will only apply in case where the proceed is taxable first. If the proceed was not even taxable, that's a different story. Then no TDS will come itself. If the life insurance itself was not taxable, there is no TDS coming into the picture. Clear? Yes. Next provision is your non-resident provision, which talks about 194E. Talks about 194E. Basically comes and says you are a sports person or an entertainer. You are a sports person or an entertainer. Should be a non-resident, should not be Indian citizen. Should be a non-resident, should not be an Indian citizen. In that case, if you come to India, do any participation in sports or do any kind of advertisements, do any kind of journals or play any entertainment, I will liable for a TDS of 20% plus surcharge plus cess. For inter-level, they never apply surcharge. So therefore, it will be 20 plus cess. Therefore, 20.8%. 20.8%. This is 194E. After 194E comes 194G, not relevant. Come directly to 194H. Okay, just to clarify, the F, the E which all we left, no, the commission parts and all, everywhere the same limit is there, 5%, 15,000. You remember H, automatically others will come. Same limit, same numbers, 5% and 15,000. So what is 194H coming and saying? This is the third part of your hijack. This provision basically comes and says that if you are giving any kind of commission, that commission, if the commission exceeds beyond 15,000 per annum, TDS will be applied at the rate of 5%. This should be a commission, meaning there should be a principal-agent relationship. If it's a principal-principal relationship, no TDS. If it's a principal-principal relationship, no TDS. That is what you have to remember. 194H is also done. 194H is also done. Coming to 194I, we are into hijack fourth. This talks about 194I talks about rent. Basically, they are coming and saying if you give a property on rent, and if the limit exceeds 2,40,000 per annum, then in that case TDS will apply at the rate of 2% or 10%. When does it apply for 2%? It applies for a movable property. Any movable property 2%, immobile property 10%. Movable property 2%, immobile property 10%. This is the limits which has been given to you. How does this work is that you have to check for the 2,40,000 per person. Meaning if that same person is giving you a house and a plant and machinery, you will check for 2,40,000 for the whole case. But you will do TDS at 2 and 10 respectively. That is what you have to remember for this. That is all done. That's all you have to remember for 194I. That is what you have to remember for 194I. Since we are in 194I, let me cover 194IB for you. 194IB basically comes and says that if you are not liable for 194I, you will come under IB. Who are those people? individual HUF not covered in the limits. Individual HUF not covered in the limits. In those cases, you will come under 194 IB. This provision basically comes and says that if you are paying rent to someone, what are you doing? You are paying rent to someone. If the rent exceeds 50,000 per month, till now we have been discussing per annum. Now we are discussing per month. If the rent exceeds 50,000 per month, they are basically coming and saying you have to do TDS at the rate of 5%. You have to do TDS at the rate of 5%. What will happen is that they will not do TDS every month. They will not do TDS every month. They will do it on the last day of the year. They will do it on the last day of the year, which means it can either be 31st March, or in case if you vacated earlier, then it will be on the vacated day. If it is done, Puriliya? Okay. So it is done on the last day of the month, last day of the year. What you have to do is the whole TDS in a single shot will be deducted in the last day of the year. Suppose, for example, it will be done on the last day of the year, basically the last rent payment, of that year. The question which will come like this: let's say, for example, you do not furnish PAN, and unfortunately the TDS rate became 20% for you. The TDS rate became 20% for you. For the full year's rent, you are going to do in the last month's payment. So let's say for the full year, the TDS came around 2 lakh rupees. The TDS came around 2 lakh rupees, but the last month's rent is only 1 lakh 50. You will deduct TDS at the rate of 1 lakh 50. They basically came and said, boss, I cannot help it. If the last month payment itself was 1 lakh 50, where the hell will I go for the balance 50,000? You ensure that you deduct the whole 1 lakh 50 and you give it off, that is enough. Okay. So the provision here comes and says that if you have to deduct from the last month's payment, but the last month payment suddenly ends up in a scenario where you are not able to recover the full TDS, no problem, restricted to the amount of rent which you are going to receive from that person. This is called 194 IB. This is called 194 IB. Coming in the middle, it is 194 IA. Coming in the middle is 194 IA. This basically talks about your capital gains. Where they are coming and saying if there is any kind of transfer of an immovable property, and the value of that immovable property is beyond 50 lakhs, which value? Actual sale value. You want SDV next attempt? Yes, for your attempt, it is actual consideration. If the consideration goes beyond 50 lakhs, then in that case you will do TDS at the rate of 1% on the consideration, ignoring the STV. Next attempt things have changed. Next attempt SDV is also coming in, not relevant for your exam. For your exam it is actual consideration. From capital gains chapter perspective, you will do SDV for the purpose of capital gains. But when you are talking about the TDS part of it, you will have to do on the actual consideration. You will have to do it on the actual consideration. It is 1% of the actual consideration. Actual consideration should be 50 lakhs or more, and you have to do 1% of that 50 lakhs or more. With me? Yes, when you are talking about the consideration means every kind of income. If he has given you for the property, for the parking charges, maintenance charges, whatever charges, all put together it should be 50 lakhs. We are in 194 IA, with IA getting over. Next is alphabet is J. Next alphabet is J. We are into the last part of our hijack. This last part of the hijack basically comes and talks about you and me. Talks about professionals, where they have come and said that if you are having any kind of payment in the form of fees for professional service, fees for technical service, royalty or non-compete fee, or director's remuneration, then in that case they have given limit of 30,000 rupees per annum. But the catch point here is the 30,000 is not per annum, it is 30,000 per annum per nature. Meaning FTS ka separate 30,000, FPS ka separate 30,000, royalty non-compete together 30,000, director remuneration no limit. Director remuneration will be fully liable for TDS. Rate is given as 10%. A 10% limit. Clear up? Yes. But there are other limits also. There are two rates. One is a 10% rate, one is a 2% rate. How do you check? If you are an auditor like me and you, it is fees for professional service, the rate is 10%. If it isn't fees for technical service, it is 2%. Fees for technical service, it is 2%. Royalty, if it is cinema, it is 2%. Non-cinema, 10%. Royalty cinema is 2%, non-cinema is 10%, and director's remuneration is 10%. Director's remuneration is also 10%. For your exam, you just have to remember two. FPS Pona 10%, FTS Pona 2%. FPS pona 10%, FTS pona 2%. This is what 194J completes. With this, your predominant hijack is over. With this, your predominant hijack is over. Before I come to the next part of it, I will cover the dividends also. I will cover the dividends also, which is there in IFOS chapter. In IFOS chapter, there is a dividends called 194. It's a dividends chapter called 194. This basically provision comes and says that you have to do TDS only on payment basis. You have to do TDS only on payment basis. Rate is given as 10% and the limit is given as 5,000 rupees. The limit is given as 5,000 rupees only for individual and HUF, meaning any other person who receives dividend, TDS will mandatory apply. If the dividend is given to an individual and HUF, limit is 5,000 rupees, provided the 5,000 is given other than by cash. Other than by cash. If you give the dividends in the form of cash also, the limit is 0. The limit is 0, which means you have to do TDS from rupee 1. You have to do TDS from rupee 1. Only if you give a dividend in the form not by cash, dividend in the form not by cash, then only it is not liable for TDS, provided the limit is 5,000. Provided the limit is 5,000. With 194 getting over, now we have to cover the exception. You have to cover the exception. Since your hijack is over, if hijack does not apply, you will come to 194M. You will apply for 194M. Basically, 194M comes and says that, sir, if you are not covered under 194H, 194J or 194C. If you are not covered under 194H, 194J or 194C, please come to my camp. Please come to me. I will do a new TDS for you. I will do a new TDS for you. When will this apply? If you are not satisfying the limits or you are not satisfying the threshold. You are not satisfying the limits or you are not satisfying the limits. And one more thing, that if you are under 194C or if you are under 194J, if you are under 194C or under 194J, you are making a personal payment, because 194J and 194C only applies for business payments, does not apply for personal payments. So if there is a personal payment, that also will come under 194M. That will also come under 194M, and under 194G also. It is 194J also, you can only have TDS on FTS and FPS. You cannot have TDS on royalty and non-compete. Anyway, not coming for exam. Anyway, not coming for exam. Coming to 194M. Coming to 194M, this covers 194H, J and C. H, J and C, where either you have not satisfied the limits or you have made a personal payment, They will come and ask you one simple question. Tell me how much is the total payment which you have made to that person in the current year. If the total payment which you have made to that person in the current year exceeds 50 lakh rupees, TDS will be applying at the rate of 5%. This 5% is same as commission and 194 IB. So 194 IB and 194M are the exceptions. 194 IB and M are exceptions. Both will have 5%. Both will have 5%. Yeah, clear? Yes. So this is talking about a 5% case, where if you are not covered under H, J and C, you will have to come and do TDS here at the rate of 5% on a limit exceeding 50 lakhs per annum. There, if you check, the limit was 30,000, 1 lakh rupee. Here the limits are very high. Very high. This is your 194M. This is your 194M. After this comes your small sections called 194N. Comes 194N. This talks about TDS on cash withdrawals. Whenever you withdraw any kind of cash from your bank, then the bank will now come and ask you one question. Please tell me, did you file your returns on time for the last 3 years? Did you file your return on time for the last 3 years? If you tell yes, bank will come and say, good. If you withdraw more than 1 crore, I will ask TDS of 2%. If you withdraw more than 1 crore, I will ask for a TDS of 2% on beyond 1 crore or less. On amount exceeding 1 crore. It is not from rupee 1, it is from amount exceeding 1 crore. But if you come and tell him, no, sir, I have not filed my returns on time. On any year or all the years? All the years. If I have not filed my return on time for all the years, then in that case they will come and say, sir, if you withdraw more than 20 lakhs from me, starting 20 lakh rupees, I will charge TDS at the rate of 2%. That 1 crore became 20 lakhs now. The 1 crore became 20 lakhs right now. But then they have also come and said, sir, no, hold. If you do withdrawal more than 1 crore, over more than 1 crore, 1 crore ka mala irukkudu, payment will be liable for 5%. 1 crore ka mala irukkudu case will be liable for 1%. Other than that, exceptions and all is not important for exam. None of these is important for exam. The only thing you have to remember is if it's an ATM machine. If it is an ATM machine, you obviously cannot do ask ATM to do with TDS. So therefore, that will also not be liable for TDS. Adu thavara 194N la irukkudu ella exception is not relevant for exam. You can ignore all these. This is the only provision which you have to remember for your exam purposes. Clear? Yes. Coming to the next part of the thing, which is 194O. This talks about your e-commerce transactions, where basically they are coming and saying, if you are entering into an e-commerce transaction, Basically, if you go and buy something from Amazon, what will happen? Will you be able to do TDS on the person who's selling in Amazon? No, not possible. Yes, there is one other person selling on Amazon, you are buying from Amazon. How do you do TDS on that person? Do you know that person? Do you have a SPAN number? Who can know? So they told, boss, do one thing, hold it off, you do not have to do TDS. Who does not have to do? I do not have to do TDS. Amazon will do TDS on your behalf. This is what is 194O. They have provided no limit. They told whatever is the sale which happens from Amazon to that person, Amazon will deduct TDS at the rate of 1% before he discharges the money to him. Now this is where they have clarified that, boss, no matter what happens, if you are doing an e-commerce transaction, this is the only section which is applicable. But I did not do from Amazon. I did it from OLX. There was another person who came to my home. He itself made me the payment. What should I do?
Person making the e-commerce operator should collect from
There is no option. OLX will go back to that person. and he'll come and say, I have to do TDS on you. So you do one thing. Don't ask that person to do TDS on you. I will do TDS from you. How will he do it? He will collect the money from him. Same like 194B. So the only two things to remember in 194O is that you have to do TDS. Who has to do? E-commerce operator has to do TDS on the seller. E-commerce operator has to do the TDS on the seller. But if the payment happens directly from the buyer to seller, even in that case, e-commerce operator is still liable for doing TDS on the seller. That is what the provisions are. And then there is given an exception which they have come and said this: if the e-commerce participant is an individual, and if the total sales which is doing from Amazon is only 5 lakh rupees, small person, don't ask anything much from him. Sale itself is 5 lakh rupees, revenue is going to be even lower. So therefore, TDS on them is not required. With this, 194O gets over, and you have two more sections which are your amendments for your current attempt. The first amendment for your current attempt is your senior citizens, which is 194P. Talking about 194P. This section basically comes and says that if you are a resident senior citizen aged 75 years, generally we have been discussing about senior citizens being 60 or 80. Here we are talking about 75. Yes, 3/4. He has left 3/4 of his life. And the golden jubilee, diamond jubilee, solvangla. So he's already done his diamond jubilee. Yes. So if he is a resident senior citizen who has at an age of 75 years or above, I will ask him a simple question. Please tell me, what is your source of incomes? If he comes and tells me I have business, this and all that, normal TDS. He comes and tells me, no sir, I have completely retired. The only income which I have is pension. I will go and tell him, okay, do one thing, tell me, do you have pension in one bank account or do you have two bank accounts? If he tells me I have only one bank account, which means one pension, one bank account, pension goes to the bank account, that's all is the provisions, then they will come and say, hold everything, go and call the bank. Bank will be called and bank will be said, sir, he has only pension from you and he only has one bank with you. He only has pension with you, he only has one account with you. Going forward, you are liable for his TDS. What is the limit? No limits. Whatever is his actual tax liability, ask him to deduct. Alternatively, what happened is, no, that person came and said, sir, I have two bank accounts. Can you go and ask one bank account to talk to other bank account? Not possible. He told, ignore the section itself is not applicable, go back to the old sections. Yes, so the only provision in this chapter is that resident senior citizen aged 75 years should have one pension and should have from one bank account. Should only deposit in one bank account. In these cases, you will not be liable to do TDS. Who will not be liable? Other sections will not be liable to do TDS. 194P will kick in, bank will do your TDS and deposit on your behalf, computing your actual tax rate after giving you rebate. If possible, or the higher basic exemption limit, whatever is there. The next section is 194Q. I'm going to hold it because I'm going to do it along with TCS. This is the end of your TDS chapter. In this TDS chapter, you only have to discuss one more administrative provisions. The only thing we have to discuss is one more administrative provisions. That administrative provisions is, you have deducted TDS. Now, will you keep it with yourself? No, you have to deposit it to government. When do you deposit to government? You have to deposit by 7th of next month. But you can also deposit for the month of March by 30th April. For March alone, you can deposit by 30th April. For every other case, you have to deposit by 7th of next month. What if I don't? Is the always question. So they told two cases. If you forgot to deduct itself, If you forgot to deduct itself, for the period you did not deduct, I will ask a TDS, I will ask an interest at the rate of 1%. For the period which you deducted but you kept my money with you, for the period for which you deducted but you kept government money with you, I want higher money, I want higher rate, so they told 1.5%. So for the period where he has not deducted, it will be 1%. For the period he has not paid to the government, it will be 1.5%. Please do not confuse this with your PGBP chapter. In PGBP, you can deduct up to 31st March also, you can pay up to 31st October also. But if you do not deduct and pay on time, this chapter will kick in and they will levy interest on you. This chapter will kick in and they will levy interest on you. The interest part of the question is this MCQ question. The interest part of the question is an MCQ question, and for some reason there is only one MCQ which they love to test. Adhe number change panna matanga. Somberiya irukanga. That same 5,000 rupees, that same 13,000 rupees, I say study material ஒரு question இருக்கு உங்களுக்கு. அதே question அப்படியே எல்லா attemptல copy paste பண்ணிட்டு தான் இருக்காங்க. Yes?
540 sir.
The same number keeps repeating again and again. Yes? No other question keeps changing also. உன்னோட MCQ bookல அதே இருக்கும், உன்னோட study material அதே இருக்கும், examல அதுதான் வரும். Same number. They are very lazy to change the numbers also. அவ்வளோ கேவலமா இருக்கு. Anyway, the point is that is only one question, and I think I don't know. I have to check with my May students. It looks like that question is already tested in May, which means the chances of it coming in November is very unlikely. Anyway, all that aside, yes, so you have already had an interest payment also. With this ends your TDS chapter. Quickly closing your TCS. There are around 5 provisions in TCS. Okay, here, just in case you are looking at my material, there are too many English. Yes, too much English is there. Ignore every English. This full special points fully to be ignored. Okay, in the administrative provisions, the only thing to be remembered is the first table. Everything else to be ignored. This motto tavare unake 201 interest. After that, you have to remember 201 interest. Everything else ignored. Everything else completely ignored. There is only too much English in my book. Because the material has it. I don't have an option. But if I short down the material, you suddenly come tomorrow and come and say, Rahul, you're not teaching everything, then again the problem. I have given everything in my material. What is important is what I am telling you right now. Yes, so this is what is there in the material. Nothing of that is important. Just to understand, ICAI has also put it in the material, but they have also clarified it. That these are administrative provisions which will test in finals, we will not test in inter. So they have itself clarified, saying it is not relevant for your exam. Yes, coming to the next part of the chapter called TCS. Last 10 minutes, TCS chapter alone done. Yes, what is this provision is ulta of TDS. This provision is exactly opposite of TDS. In TDS, what happens? Someone is making a payment and he is going to do TDS. In TCS, what happens? The person who's collecting the money will collect more money. Basically, payer has to pay double now. More now. Basically, if the payer had to pay 100, now the payer will pay 110. Earlier, what happened? If the payer was to receive, if the recipient was to receive 100, he would have received 90. 100 would have become 90. Now 100 is becoming 110. So what is happening is the person who's incurring an expense is incurring more expense. Why would you do that? The only intention is very simple, because you want to avoid those transactions. So most probably the initial, when they were introduced this chapter itself, the intention was to avoid any kind of activities which you don't like people doing. And the first thing which they don't like people doing is smoking and drinking. And that is what we say. You go and ask Tasmak, no, they will be very happy. State government will come and say you should not drink, but they will only own the shop. The person who's having the person who's selling the cigarette itself is giving you a hospital also. We will only promote your cancer also. We will also tell you not to do cancer. Yes. Anyway, so the point is they are only talking about those kind of activities which are not very beneficial for the society. The first activity is your liquor. Which liquor, pa? The one which you use in medicine or one which you drink? The liquor which you use for home consumption. This is where the concept is. They are coming and saying any kind of liquor which you have for home consumption, when you make the payment for that liquor, you have to pay 1% extra. Basically, what happens is when they are going and taking a liquor, they have to pay 1% extra over and above what they are paying. Second is Tendu leaves. Tendu leaves are basically those items which are used for cigarettes. All those things have a rate of 5%. Then there is something called timber and forest produce at the rate of 2.5%. Then there is scrap of 1% and coal of 1%. In exams till now, this has come and this has come. In exams, this has come, but this has come only once. Only once. I don't expect it to come anymore also. I don't expect it to come anymore also. Scrap is what you might remember. Scrap is what you might have to remember. Scrap is TDS at the rate of 1%. Yes, whatever payment you make, you have to make an additional payment of 1% to the person for whatever things you do. But there is an exception given to this where they have come and clarified that I will not make this payment of TCS. I will not make the payment of TCS if I can prove it to that other person saying, I'm sorry sir, I'm going to use the scrap for further business. I'm going to use it for further business. If I'm going to use it for personal purpose, then I have to pay TCS. But if I'm using it for further business, then there is no TCS. Then there is no TCS. Clear? When I'm purchasing the good itself, if I come and clarify to him saying that I'm using it for business, then in that case, no TCS will apply. Apart from this is when everything went haywire. The problem was that now TCS became everything in the world. Even if you are doing a genuine transaction, now they wanted TCS from you. So the second genuine transaction became a case where you are buying a car. You're buying what? A car. They came and said if you buy a car going forward and the income from the car is more than 10 lakhs, which means it's a luxury car it seems. If a car is having a value more than 10 lakh rupees, now it is called a luxury car. If you buy a car for more than 10 lakh rupees, government will now withhold 1% of that as TCS also, which means when you buy a car, you have to also give additionally 1%. And this car, whether you do it for business, whether you do it for personal, it doesn't matter. You have to still pay that 1%. And this 1% is per car. 1% is per car, meaning the 10 lakh rupees is also per car. 10 lakhs rupees is also per car. These are your clarifications. Clarification number 1 is where they are coming and saying 10 lakh rupees has to be checked per car or per year. It is per car. 1% is per car. 1% is also per car. Whether you make the payment by cash, you make the payment by killing someone, doesn't matter. Everything is liable for 1%. Yes, any cash, non-permissible modes, doesn't matter. TCS will apply at the rate of 1%. With this, you came to the next part of the provisions from which there was an amendment came in. This amendment came in last year. Where they came and said, sir, if going forward you go for a honeymoon trip, when I say honeymoon, foreign tour. Yes. If going forward you go for a foreign tour. If you are going for a foreign tour, they are coming and saying, sir, you have to pay additional 5% as TCS. When you go for a foreign trip going forward, to the person from whom you have purchased the foreign trip, you have to pay an additional amount as TCS. ஏற்கனவே honeymoon trip க்கு காசு ஆக போறது. அதுக்கு மேல ஒரு 5% கொடுக்கணும். Yes, so whatever trips you go for foreign going forward, you have to pay an additional amount as 5% as a TCS. You have to pay additional amount as 5% of TCS. Second is where they are coming and saying, sir, no, hold. I have not gone for a foreign trip. I am not going for a foreign trip. I have money to send outside India. I have what? I have money to send outside India. If I have money to send outside India, I'll send it through bank. This bank is called as a special name called AD bank, called authorized dealer banks. If you're doing a transfer from India to India, it doesn't matter. But when you do a transfer from India to foreign, there will always be one person in the middle called as AD banker. Yes, so the provisions which they have come and clarified is that if you want to transfer any money outside India, through an AD banker, the provisions are that if the money is up to 7 lakh rupees, no TDS, no TCS. If the money is up to 7 lakh rupees, there is no TCS. But if the money which you transfer is beyond 7 lakh rupees, you will have to pay TCS at the rate of 5% on the money exceeding 7 lakhs. You have to pay TCS on the money exceeding 7 lakh rupees. But yes, if you come and you go and beg before him, come and say that, sir, I am sending this money to my daughter for her education, daughter, son, whatever it is. Yes, I am sending this money for higher education, then in that case the 5% will come down to 0.5%. The 5% will come down to 0.5%. With this comes the last two of your syllabus called TCS and TDS under goods. TDS and TCS under goods. Background is very simple. Last year they introduced TCS on goods. Where they came and said if a person sells goods more than 50 lakh rupees, then in that case what will happen? He will have to collect an additional money in the form of TCS at the rate of 0.1%. Provided the person who's collecting the money has a turnover more than 10 crores. But now is when they brought it and came and said, I'm sorry sir, hold the TCS. We will bring a new section called TDS. This is 194Q. Same provisions ulta. If a person is selling any kind of goods for value more than 50 lakh rupees, the buyer will now deduct TDS at the rate of 0.1% exceeding 50 lakh rupees, provided the turnover is less than more than 10 crores, provided the turnover is more than 10 crores. Whose turnover? Deductors, the buyer's turnover. Buyer's turnover. How do you understand this in this format? How do you understand it in this format? You have to understand 10 crores is for the person who's going to do the obligation. In TCS, who will do the obligation? The one who's collecting the money, meaning seller. In TDS, who will do the obligation? The person who's paying the money, which means buyer. So in case where the buyer has a turnover more than 10 lakhs, 10 crores, in case the buyer has a turnover more than 10 crores, TDS will apply. In case the seller has a turnover more than 10 crores, TCS will apply. But in case both have turnover more than 10 crores, TDS will apply. In case where the turnover is more than 10 crores for both the people, TDS is what will apply, meaning it is TDS or TCS. TDS is the higher. TDS is the higher. If TDS is applicable, TCS will never apply. If TDS is applicable, TCS will never apply. But then the problem is this provision was introduced from 1st July. This provision was introduced from 1st July, meaning any transaction which takes place before 1st July, TCS will apply. Any transaction which takes place after 1st July, you have to check for turnover of both, and in that case, you will have to compare and check which one's turnover is higher. You have to check for both the turnovers. If both the turnovers are higher than 10 crores, in that case 194Q will apply. In that case 194Q will apply. And the second exception is that when it comes to TCS, the TCS happens only on payment. The TCS only happens on payment. But in case of TDS happens on payment or credit, whichever is earlier. Meaning. Let's say for example, you undertake a sale. When did you undertake a sale? You undertook a sale in June. And the money for that received in July. What will happen? In case of TDS, it should be payment or credit, whichever is earlier. So the credit happened on June. On June, was TDS applicable? No. So therefore, what will happen? This will come under 194. See, TCS. This will come under TCS. Alternative number 2. What happened is you did a payment in the month of June. And the service was provided in August. The moment the payment happened in June, what would happen? TCS would have already applied. When TCS is applied, will TDS apply? No, TDS will not apply, which means the scenario can only be such that the payment and the credit should happen after July. If the payment and credit happens after July is when 194Q will kick in. If the payment or credit happens before July, always TCS will apply. Clear? Yes. How to understand that better? I have given sums and all here for you to go through. Yes. Here. There are 2 illustrations for you covering both the ambits. First illustration will come and tell you whether you should apply 206 or whether you should apply 194Q. Second illustration will basically come and tell you if it's a scenario where both are applicable. What will happen before July? What will happen after July? What will happen before July and what will happen after July? Clear? Yes, I wanted to practice this sums. That's what I told you. I am telling a story right now. You're listening the story with me. I wanted to go home, read through the material again. The marathon is anyway uploaded online. I wanted to go through the marathon over again. Yes, and when you're reading the material itself, try to recollect as to which provisions did I tell is relevant and not relevant. Okay, if you go to every section, you will find multiple notes. But I would have told you only this note is relevant, this note is not relevant. Everything which I told you is not relevant is not relevant. Everything which I told you is not relevant is not relevant. Nothing has to be remembered for your exam purposes. What I told you is relevant is what is relevant. In case you missed out, no problem. The marathon is there. You can always check it in the marathon. Clear? Yes? Great. With this, we are done with the whole direct taxes. You want me to check how much it is done? With this, we are done with direct taxes. Look at the bottom. No, I stopped my recording on 7 hours 35 minutes. I stopped my recording on 7 hours 35 minutes. Don't check out the live da. That is all the lunch time and all which you had. Yes, I stopped my recording on exactly 7 hours and 35 minutes. In this 7 hours 35 minutes also is where I am sitting and explaining you things with illustrations and all that. Yes, if you ignore all those stuffs and if you already know certain provisions which you are already aware about, you don't have to go that much time also. Which means effectively speaking, you can easily shoot it off in 6 to 7 hours. This is what you have to target. I am clarifying it to you. You have been given a boon this time. For 2 days. Never happens. Never going to happen also. Yes, never going to happen also. You have to utilize this as much as possible. Yes, 2 days solidly given to you. 1 day full for IDT pa. 1 day full for IDT, no second thoughts. 1 day take a full day for IDT. I don't know which faculty you have done. You might have 150 pages, 250 pages, 350 pages material. That will take time. Yes, so IDT take 1 full day, no problem. When it comes to DT, the request is very
கிளம்புறதுக்கு ஆசை இருக்குல்ல. Yes, when it comes to DT, you have one solid day. 6 hours in the morning. 6 hours in the morning, sit, close it off. 6 and close it off. Take a lunch break, whatever it is. Come back. 6 hours will become 3 for you. 6 hours will become 3 for you. That's all done. 6 hours will become 3 for you. Go in the night before you sleep, exactly half an hour. Go in the night, exactly half an hour. Just to skim through the material. You already know good amount of it. 6 hours, 3 hours. You just have to read what you don't remember. And that too, the material already has codes and everything. So on the codes mattu parcha porom. Yes. So you only have to remember that much. Exactly before you sleep, half an hour. That's all. Yes. My recommendation: do IDT first. First day do IDT. Second day do DT. So that DT score more. Yes. Second day you do DT because IDT anyway things are easy. You can easily clear it off. Numbers mattu da irukum, sums mattu da podra mari irukum. DT la provisions ஞாபகம் வெச்சது கஷ்டம். Yes. So in the second ஏன்டா நான் பேசுறேன், நான் டிடிஎஸ் பேசும்போது எவ்வளோ சைலண்டாக இருந்தது பாரு. எஸ், செகண்ட் டே சிட் பேஷண்ட்லி டிடி, மார்னிங் 6 hours, 3 hours, நைட் தூங்குறதுக்கு முன்னாடி ஒரு half an hour. That's all is what you have to do. Next day you can choose whether you want to do IDT or DT the day before exam. That's all. Go for the exam, crack it, nail it, conquer it and come back. That's what I would say. Yes, nothing else to be worried about. It's as easy as you take it. It's as easy as you take it and it's as difficult as you worry about it. That is what I always tell my students. It doesn't matter. It doesn't matter. It might be the attempt which you are cracking this time, but that does not mean that this is the end of the world. Does not mean that the end of the world. I am telling you that you try your best and you crack it off. But if things go wrong also, that's okay. Okay, so don't worry about it right now because the worry is not helping anyways. Okay, you try too much efforts also, things are not going to work out. You don't try also, things are not going to work out. Nothing is working out. Yes, so it is simple. Take life as it comes. That's okay. Okay, enjoy life as it comes because this is the journey which you will never forget. Okay, and if you go and talk to someone else in the future and you come and say, I spent my journey sitting at home, wasting 20 hours a day, crying over the corner, doesn't help. No one is going to be happy about it. Okay, no one will come and look at you respectfully. If you go and tell someone that I cleared CA with a lot of pain and everything, he will say, okay, I knew that already. What is the new thing about it? Yes, instead if you go and talk to him like me, where I come and say that I enjoyed the life as it came. I did not study much. I did whatever fun I wanted in life and I cleared the exam with easy and efforts, with no problem at all, with absolutely no worries and all. People will look at you very differently. Adnapa Ajay Agarwal. Yes, you go and tell someone no, that you are doing it easier than 10th standard, you will respect more. அதுக்கு என்ன கேவலம் அது வேற விஷயம். Yes, the point is very simple. I am telling you, I understand the pain. I understand what you have gone through. I have gone through that phase and I can tell you it is difficult. There is no second thought about it. But is that something which you should worry about? Probably not. Yes, that's what the code says, no? Somewhere it is written. Is it seen? Prepare பண்ணிட்டு வந்திருக்கேன். Yes, you might go through a lot of struggle, but that does not mean that the struggle has to be painful for you. Does not have to be. Okay, what you can tell is you can enjoy life as it comes, but still you can go in the future and tell someone that I had miserable life. They will still respect you. But if you are going through a miserable life, you don't have anything to boast about. Yes, so enjoy life as it comes. It doesn't matter. You have to pass. There is no second thought about it. But do not worry so much about it because anyway that's not helping you to read. Yes, read as it comes, enjoy as it comes, love the subject. That's what I would say. Love the subject as it comes. Okay, tomorrow once you clear also, you have to pick one of the A subjects. You don't have an option. Yes, you're obviously not doing this course just for the brand value of it. I'm hoping so. Is there someone who's doing CA because they'll get a big dowry or something? No, right? Yeah. So everyone here is doing CA with the intention that you want to do something in this future. Correct? You want to do something great about this future, which means one of the 8 subjects is something which you have to love. There is no second thought about it. Yes, so you have to already pick your subject, but that does not mean that you do not have to excel in everything. Yes, love every subject as it comes today. In the future you can always make a decision as to which one is better for you. Yes, but today as you speak, everything is important for you because you still don't know which one you like. You still don't know which one you like. You're still experimenting with everything. So love every subject as it comes and enjoy everything as it comes. It doesn't matter. Okay, things might be difficult. It's supposed to be difficult. Did you enter the course saying you wanted it easy? Did someone come and tell you CA is easy, so join the course? Huh? When you entered the course, what was someone telling you? You still joined, no? Appa, who's the mad person here?
If you knew that it's going to be difficult and you still made the decision, then why are you worrying about it right now? Correct, Dhanam? When you already made the choice, when someone was telling you, that time you showed off, no, saying that no, I will do it, I will do it. Ipo enna achu? Kinjadala? Adan. Yes, it doesn't matter. See, understand, when you were in 12th standard and you made that hasty decision and you wanted to join the course, you were very clear to say that I will crack it no matter what. Don't lose the fear. Don't lose that thing. You still want to go back to that person and come and tell him that I cleared it. When I said you, I will clear it. Adada mukyam. If you fail today and you don't well, that person will again stand on your face only and come and say, "Dey, pesarada periya vaatha pesta. Enada kichana solvan." Don't come to that scenario. Yes, you have to love the course and do it for the sake of don't do it for the sake of doing it, but for you to grow in this market. Yes, that is what the intention is. We do not clear this course with, we definitely have to clear this course, but at the end of the day, the result is something different. What you are going to do in the market is what people are going to impact you about. So what attempts you take does not matter, but least you give, better it is. For whom? Because every exam fees which you give is a bonus, is a bonus only for ICI, nothing else. Yes, do you want to give more bonus to ICI? They're already rich enough. That is why we are getting money. Yes, ICI does not pay us. That's a different story. But anyway, the point is, don't give extra bonus money to ICI. They already have enough money. Yes, keep it very simple. I give you once, I will recover it back fully. Yes, sir. Yes, can we go with that thought? Clear. Great. For those who have been with me, thank you everyone. I have a certain known faces, but I know there's a lot of unknown faces with me. I don't know how I've impacted you today. I hope it is well. Yes, I hope it. You don't have an option now. Yes. Any case, keeping all that aside and an honest thought, thank you everyone for sitting with me for this 9 hours. I know it's painful. I know it is painful sitting in one place and doing the 9 hours. Trust me, I'm standing for 9 hours. Yes, I can understand what the thrill is, but I am doing this for the simple reason that I love to do it. Yes, the face which I see, the glitter which is there in your eyes is something which excites me a lot. So I can run for more 10 hours also, doesn't matter. I have done a lot of classes, people know with me. Yes, so I can do all that things. I want that same kind of zeal from your side also. Keep that thrill running, keep that fire running and go forward with it. Yes, with that said, one small thing. I wanted to personally thank Shankara first of all, because when we were in our older academy, there were certain restrictions. We could not really gather a lot of crowd there. Yes, because there were certain rules and restrictions. But I think the one request which I made to Shankara 1 week back, just to say that I wanted to do this for the sake of everyone. There is absolutely nothing which we have earned from you people also. Yes, it was a pure intention to keep it good for you people and to help you in last whatever corner it is. I made only one small request to this academy, and without a second thought, they told, let's put up a flyer and let's do it. Yes, so that kind of efforts which we have taken for this academy, and I think this academy is trying to grow its best. We are also doing our best for it. The one thing which I can tell you is that the panel is very nice. Yes, they are very sweet people is what I can say, because no one at the last minute will come and say, let's float a free batch and do everything for everyone. Yes, they also incur cost, but they were still ready to do it, and that's one thing which I'm very commendable about Shankara. So that's one thing which I wanted to thank them personally. Second thing, for those who have been with me and for those of your friends who are there, in case you had any difficulty with the subject, in case you are still having any difficulty with the subject, because I understand we did a marathon, we have not completed the detailed part of it and we have not understood the logic behind it. If you still want to understand the logic and you still want to crack this exams in a more better manner, we are also going to float a fast track batch. Okay, I'm going to be the faculty, no one else is coming. I'm not going to cheat you suddenly. Yes, I'm going to be your faculty for a fast track course also. Absolutely no compulsion. I'm not telling you that you have to join for the course. It's very simple. In case you want to also practice sums and you feel like you're not strong on the concepts and the marathon did not help you so much now, the intention is very simple. We are going to float a fast track batch somewhere in the first week of October. You'll be enjoying Dasera with me. Saraswati Puja also, no? We'll enjoy Saraswati Puja sitting here. Yes, we will do all that things here. Yes, you want to bring fireworks, everything, we'll do everything here. Yes, you will enjoy all that fun with me. October first week is when I'm going to plan a course. The point is very simple. When I take a full course thing, that goes for a good amount of time, because I ask a good amount of questions. I torture people left, right, center. Yes, but when it comes to fast track, I'll keep the concept as crisp as possible, but at the same time, I'll explain you everything which we discussed here, whatever mnemonics we use, whatever logics we use, and at the same time, we'll try to cover most of the questions which are there in the exam with absolutely no drawback. Yes, we will not, I do not have the concept of telling people that it's fast track, we'll do 40%, 60%, nothing. Panna tanga panu. 100% is what we'll crack, and that's why we'll close. Yes, so if anyone is interested for it, you can always reach out to the academy and they can always help you. Same place, same premises, we will all have fun together. October first week. Anyone else who has a material in your hand, if the soft copy is working well for you and you can learn from it, great. No problem at all. But the hard copies are already ready here. We're going to use the same hard copies for crash courses also. If you feel like you think that the soft copy can have a challenge for you, you want to write down and everything, the materials are ready. You can always reach out to the academy and they'll give you the material for your preparation purposes. Absolutely no income on it. That's what I told you. It's a pure floater free batch. We are just recovering the printing cost. What we gave is what we are recovering, is what I'm telling. You can try in outside market. If you're able to get it for cheaper, go ahead. No problem at all. If you can get it cheaper in the outside market, please go ahead. If not, you always have the hard copy of the material here. You can always collect the hard copy of the material from this academy and go. Clear? Great. This WhatsApp group is going to be enabled for you until your exams are closed. So what we'll do is, after this exam, if you're not planning for the fast track, my request is take the May 22 question paper and solve it at your home. Yes, within a month's time, within 2 weeks' time, I will ensure that the May 22 suggested answers are uploaded. I will go through the whole suggested answers and I will upload a YouTube video for you. After you're done with the syllabus, you can go through that paper. If you are coming back with me for the fast track course, the fast track order question paper will be May 22 only. Because the fast track order question paper will be May 22 only. I would not recommend you to do that paper. You come with me, complete the fast track with me, and then I will give you that paper to solve in the class, and then we will discuss it in the class itself. Clear? Apart from that, I will also be putting some RTPs, MTPs discussion and all. So I will try to keep it as engaging as you for possible. Yes, I will try to keep it as engaging as possible. Either my channel, personal one, or the Sankara channel will have the videos and it will always be available for you. Don't lose the group. Don't lose the group until November. After November, you do whatever you want with that group. You throw your material also, I don't care if you pass. Yeah. If you pass, you throw the material, it doesn't matter also. But if you're not passed, keep it with you. Yes, unless you know what the answer is, don't make a chance with it. Don't make a chance with it. Clear? Clear? Yes. Anyone has any doubts? Any doubts? No? Can we cut for the day? Sure. Thank you, people. Have a wonderful day ahead. I look forward to seeing everyone's messages. My number is there on the group. For Miss Moni, whoever is there, my message would have come. You can type on that message and you can message back with me. I would love to hear from every one of you after this marathon also, in case there is any suggestions for me or for the academy, and at the same time after you clear your exams. Yes, after you clear your exams, I would love to hear back from you people saying that you have cleared your exams. Whether it was because of me or for any other subject, it doesn't matter. As long as you have cleared your exam, I will always be happy for the first person to clear. Yes? Yes, sir. Thank you, people. Have a wonderful day ahead. Take care.